Tap Dancing to Work. Warren Buffett on Practically Everything, 1966 to 2012. A Fortune magazine book by Carol Loomis. Are Jimmy and Warren Buffett related? June 21st, 1999. By Tyler Maroney.
We'll begin to answer this question of blood ties between the Oracle of Omaha and the Minstrel of Margaritaville by pointing out their similarities, which are haunting. Both play stringed instruments. Jimmy, a tropical guitar, Warren, a mean ukulele. I've probably had worse musicians in my band, jokes Jimmy. They've both cashed in on unlikely investments. Warren bet on furniture, insurance, and vacuum cleaners, and is now worth $35 billion. Jimmy bet on the illusion of a colada-drenched beach bum and forged a multi-million-dollar brand with over 30 albums, 8 movies, a clothing line, nightclubs, a custom record label, 3 best-selling novels, and hundreds of gift shop gimmicks. Jimmy's a Capricorn, adept at accumulating money. Warren's a Virgo, with a creative musical mind. Both keep it real by sticking to what they know. Warren by avoiding tech stocks, Jimmy by milking a song he recorded more than a generation ago. Both attract cult followings. Parrot heads flock to Jimmy's summer concerts. Investors flock to Warren's Berkshire Hathaway shareholder meetings. Warren himself calls it the capitalist's Woodstock. Both avoid changes in latitudes and changes in attitudes. Warren's a die-hard Husker. Jimmy's still wasting away in mythical Margaritaville. Lethargy bordering on sloth is how Buffett describes the cornerstone of his style. That's Warren on investing, not Jimmy on chilling. In his classic Cheeseburger in Paradise, Jimmy croons, "Heaven on earth with an onion slice." Hamburgers are Warren's favorite food. But really, are they related? Fortune believes, but cannot prove beyond a doubt, that Warren and Jimmy are kin. It was Warren's sister Doris, the family genealogist, who first raised the subject. 2 years after mailing out questionnaires to all 125 Buffetts in the U.S., she got a call from a curious Jimmy. He said, "I want to be related to your family because they're rich and famous." Doris recalls, and I said, "That's funny. We want to be related to you because you're rich and famous." Doris's research has unearthed 3 possible ancestral links. John Buffett, a poor 17th century pickle farmer from Long Island, a Newfoundland sailor whom Jimmy honors in Son of a Sailor, and Norfolk Island in the South Pacific, which is inhabited by hundreds of Buffetts, as well as a good many descendants of the mutineers of the Bounty. When Doris and Jimmy discovered that Norfolk Island used to be a penal colony, however, they lost hope. Centuries of inbreeding have blurred family lines. Despite the lack of absolute proof that they're related, as of press time, no DNA testing has been conducted. Warren and Jimmy have become friends. While Jimmy insists Uncle Warren doesn't slip him any investing tips, the two have been known to break out in song. "I think he's angling to get into my will," the billionaire Buffett jokes. "But the way things are going, I'd rather be in his."
And the final answer is 8 years and many scientific advances later, Jimmy and Warren did the requisite spitting into small receptacles and submitted to a DNA analysis, carried out by 23andMe, a company co-founded by Anne Wojcicki, who happens to be the wife of Google co-founder Sergey Brin. The results showed, alas, that Jimmy and Warren are not related. To find common ancestors for the two, you'd have to go back 10,000 years, which is before surnames, and that doesn't count. Case closed. CL. Put Bite into Audit Committees, August 2nd, 1999, by Carol Loomis. In the days before Sarbanes-Oxley became law, regulators struggled to end cooking the books, and Buffett weighed in on the issue. C.L. Eager for boards to have better audit committees than they do, Arthur Levitt got a special panel to make recommendations for improvement and now wants them adopted. But when the New York Stock Exchange asked its listed companies to comment on the recommendations, back came bullets. The companies especially disliked a proposal that would have required audit committees to do their homework and then attest in annual reports that the financial statements therein conformed to GAAP. Some protesters thought such a rule would invite lawsuits against audit committee members. Others saw role confusion. Attesting, said one letter, is what the external auditor is hired to do. A related objection came from Warren Buffett, who, up to the minute he put up his hand on this one, had publicly and warmly applauded Levitt's campaign against earnings management. Here, though, Buffett disputed the thought that an audit committee, meeting for a few hours a year, could attest to anything meaningful about a company's financial statements. Instead, he said, the committee needs to learn what the outside auditors know, something that frequently does not occur, even, perhaps especially, when major shortcomings exist. Buffett said the committee should require the auditors to give detailed answers to 3 questions. 1. If the auditor were solely responsible for preparation of the company's financial statements, would they have been done differently, in either material or non-material ways? If differently, the auditor should explain both management's argument and his own. 2. If the auditor were an investor, would he have received the information essential to understanding the company's financial performance during the reported period? 3. Is the company following the same internal audit procedure the auditor would if he himself were CEO? If not, what are the differences and why? Buffett then said, in italics, that the auditor's answers should be spelled out in the minutes of the meeting. The point, he said, is to hang monetary liability on the auditors, that being the only thing that will drive them to truly do their job instead of becoming subservient to management. Fortune asked Olivia Kirtley, chair of the American Institute of Certified Public Accountants and also chief financial officer of Vermont American Corporation, for her opinion about Buffett's ideas. He'd boiled down his questions, she said, but they were in the spirit of what the AICPA's own audit committee asks of its outside auditors. Whether her auditing firm constituency would like a plan that seeks to get them either to do their job well or to accept monetary responsibility for failure is doubtful. Auditors have eased their legal troubles in the past decade, managing to establish that financial statements are the responsibility of management, and also getting help from new laws and a friendly Supreme Court decision. As a result, the number of suits auditors are having to defend is sharply down. Of course, it is also during this decade that managements have learned all the subterranean routes for meeting expectations. Is that simply coincidence, or has the slimming of monetary consequences made auditors less diligent and more compliant than was once the case? That question is unanswerable. Buffett's 3 are not. Mr. Buffett on the Stock Market, November 22, 1999. A Buffett speech that Carol Loomis converted into an article. Warren Buffett almost never talks publicly about the general level of stock prices, neither in his famed annual report, nor at Berkshire's thronged annual meetings, nor in the rare speeches he gives. But in the last half of 1999, on 4 occasions, Buffett did step up to that subject, laying out his opinions, in ways both analytical and creative, about the long-term future for stocks. I heard the last of those talks, given in September to a group of Buffett's friends, and also watched a videotape of the first speech, given in July at Allen & Company's Sun Valley, Idaho Bash for Business Leaders. From those extemporaneous talks, the first made with the Dow Jones Industrial Average at 11,194, I distilled the following account of what Buffett said. Buffett reviewed it and weighed in with some clarifications. Buffett's central message is contained in the first words of this article. Investors in stocks these days are expecting far too much. As for the nascent Internet, whose promise swelled investors' hopes, he proceeded to emphasize how few people got rich from two other transforming industries, auto and aviation. In his speeches, Buffett certainly did not anticipate the low interest rates, treasury bills that pay pennies, for example, prevailing currently. Neither was he quite as grim about stock market returns as reality has proved them to be. But he was absolutely right in his general bearishness about the market, so much so that he says today, "I wouldn't change a word of what I said." He was speaking at a time when investors had grown used to an average annual total return of 12% on their holdings. He expected instead that 7% was a reasonable estimate as to what investors, before inflation, could earn annually in total returns over the 17 years from 1999 to 2016. The article explains why he selected that oddball number of years. And that was a gross figure, before the heavy transactional costs that investors bear, commissions, sales loads, and management fees, for example. After these costs, Buffett thought that a reasonable expectation for the return would be about 6% annually. In lamentable fact, the total return of the Dow Industrials, compounded annually, was from the end of 1999 through mid-2012 only 3.32%. The comparable figure for the S&P 500, which is not as dividend-heavy as the Dow and suffered much more than the Dow when the Internet bubble burst, was absolutely abysmal, 1.26%. As this book is published, there are still 4 years to go, of course, before the 17 years end. But they will have to deliver superb results if investors are to speed across the ground they've lost and end up with even a 6% annual total return. C.L.
Investors in stocks these days are expecting far too much, and I'm going to explain why. That will inevitably set me to talking about the general stock market, a subject I'm usually unwilling to discuss, but I want to make one thing clear going in. Though I will be talking about the level of the market, I will not be predicting its next moves. At Berkshire, we focus almost exclusively on the valuations of individual companies, looking only to a very limited extent at the valuation of the overall market. Even then, valuing the market has nothing to do with where it's going to go next week, or next month, or next year, a line of thought we never get into. The fact is that markets behave in ways, sometimes for a very long stretch, that are not linked to value. Sooner or later, though, value counts. So what I'm going to be saying, assuming it's correct, will have implications for the long-term results to be realized by American stockholders. Let's start by defining investing. The definition is simple, but often forgotten. Investing is laying out money now to get more money back in the future. More money in real terms after taking inflation into account. Now, to get some historical perspective, let's look back at the 34 years before this one. And here we are going to see an almost biblical kind of symmetry in the sense of lean years and fat years to observe what happened in the stock market. Take, to begin with, the first 17 years of the period, from the end of 1964 through 1981. Here's what took place in that interval. Dow Jones Industrial Average, December 31st, 1964, 874.12. December 31st, 1981, 875.0. Now, I'm known as a long-term investor and a patient guy, but that is not my idea of a big move. And here's a major and very opposite fact. During the same 17 years, the GDP of the U.S., that is, the business being done in this country, almost quintupled, rising by 370%. Or if we look at another measure, the sales of the Fortune 500, a changing mix of companies, of course, more than sextupled, and yet the Dow went exactly nowhere. To understand why that happened, we need first to look at one of the two important variables that affect investment results: interest rates. These act on financial valuations the way gravity acts on matter. The higher the rate, the greater the downward pull. That's because the rates of return that investors need from any kind of investment are directly tied to the risk-free rate that they can earn from government securities. So, if the government rate rises, the prices of all other investments must adjust downward to a level that brings their expected rates of return into line. Conversely, if government interest rates fall, the move pushes the prices of all other investments upward. The basic proposition is this: what an investor should pay today for a dollar to be received tomorrow can only be determined by first looking at the risk-free interest rate. Consequently, every time the risk-free rate moves by 1 basis point, by 0.01%, the value of every investment in the country changes. People can see this easily in the case of bonds, whose value is normally affected only by interest rates. In the case of equities or real estate or farms or whatever, other very important variables are almost always at work, and that means the effect of interest rate changes is usually obscured. Nevertheless, the effect, like the invisible pull of gravity, is constantly there. In the 1964 to 81 period, there was a tremendous increase in the rates on long-term government bonds, which moved from just over 4% at year-end 1964 to more than 15% by late 1981. That rise in rates had a huge depressing effect on the values of all investments. But the one we noticed, of course, was the price of equities. So there, in that tripling of the gravitational pull of interest rates, lies the major explanation of why tremendous growth in the economy was accompanied by a stock market going nowhere. Then, in the early 1980s, the situation reversed itself. You will remember Paul Volcker coming in as chairman of the Fed, and remember also how unpopular he was. But the heroic things he did, his taking a 2x4 to the economy and breaking the back of inflation, caused the interest rate trend to reverse, with some rather spectacular results. Let's say you put $1 million into the 14% 30-year U.S. bond issued November 16, 1981, and reinvested the coupons. That is, every time you get an interest payment, you use it to buy more of that same bond. At the end of 1998, with long-term governments by then selling at 5%, you would have had $8,181,219 and would have earned an annual return of more than 13%. That 13% annual return is better than stocks have done in a great many 17-year periods in history. In most 17-year periods, in fact. It was a hell of a result, and from none other than a stodgy bond. The power of interest rates had the effect of pushing up equities as well, though other things that we will get into pushed additionally. And so here's what equities did in that same 19 years. If you'd invested $1 million in the Dow on November 16, 1981, and reinvested all dividends, you'd have had $19,720,112 on December 31st, 1998, and your annual return would have been 19%. The increase in equity values since 1981 beats anything you can find in history. This increase even surpasses what you would have realized if you'd bought stocks in 1932 at their depression bottom. On its lowest day, July 8, 1932, the Dow closed at 41.22 and held them for 17 years. The second thing bearing on stock prices during this 17 years was after-tax corporate profits. I'm quite fond of 1929, since that's when it all began for me. My dad was a stock salesman at the time, and after the crash came in the fall, he was afraid to call anyone, all those people who'd been burned, so he just stayed home in the afternoon. And there wasn't television then, so I was conceived on or about November 30th, 1929, and born 9 months later on August 30th, 1930. And I have forever had a kind of warm feeling about the crash. Corporate profits as a percentage of GDP peaked in 1929, and then they tanked. In fact, the years from 1929 to 1950 were filled with aberrations. Not only the Depression, but also a wartime profits boom, sedated by the excess profit tax, and another boom after the war. But from 1951 on, the percentage settled down pretty much to a 4% to 6.5% range. By 1981, though, the trend was headed toward the bottom of that band, and in 1982, profits tumbled to 3.5%. So at that point, investors were looking at two strong negatives. Profits were subpar, and interest rates were sky high. And as is so typical, investors projected out into the future what they were seeing. That's their unshakable habit, looking into the rear view mirror instead of through the windshield. What they were observing, looking backward, made them very discouraged about the country. They were projecting high interest rates. They were projecting low profits. They were therefore valuing the Dow at a level that was the same as 17 years earlier, even though GDP had nearly quintupled. Now, what happened in the 17 years beginning in 1982? One thing that didn't happen was comparable growth in GDP. In this second 17-year period, GDP less than tripled, but interest rates began their descent, and after the Volcker effect wore off, profits began to climb, not steadily, but nonetheless with real power. By the late 1990s, after-tax profits as a percent of GDP were running close to 6%, which is on the upper part of the normalcy band. And at the end of 1998, long-term government interest rates had made their way down to that 5%. These dramatic changes in the two fundamentals that matter most to investors explain much, though not all, of the more than tenfold rise in equity prices. The Dow went from 875 to 9,181 during this 17-year period. What was at work also, of course, was market psychology. Once a bull market gets underway, and once you reach the point where everybody has made money, no matter what system he or she followed, a crowd is attracted into the game that is responding not to interest rates and profits, but simply to the fact that it seems a mistake to be out of stocks. In effect, these people superimpose an I can't miss the party factor on top of the fundamental factors that drive the market. Like Pavlov's dog, these investors learn that when the bell rings, in this case the one that opens the New York Stock Exchange at 9:30 a.m., they get fed. Through this daily reinforcement, they become convinced that there is a God and that he wants them to get rich. Today, staring fixedly back at the road they just traveled, most investors have rosy expectations. A Paine-Webber and Gallup organization survey released in July shows that the least experienced investors, those who have invested for less than 5 years, expect annual returns over the next 10 years of 22.6%. Even those who have invested for more than 20 years are expecting 12.9%. Now, I'd like to argue that we can't come even remotely close to that 12.9% and make my case by examining the key value-determining factors. Today, if an investor is to achieve juicy profits in the market over 10 years or 17 or 20, one or more of 3 things must happen. I'll delay talking about the last of them for a bit, but here are the first 2. 1. Interest rates must fall further. If government interest rates, now at a level of about 6%, were to fall to 3%, that factor alone would come close to doubling the value of common stocks. Incidentally, if you think interest rates are going to do that, or fall to the 1% that Japan has experienced, you should head for where you can really make a bundle: bond options. 2. Corporate profitability in relation to GDP must rise. You know, someone once told me that New York has more lawyers than people. I think that's the same fellow who thinks profits will become larger than GDP. When you begin to expect the growth of a component factor to forever outpace that of the aggregate, you get into certain mathematical problems. In my opinion, you have to be wildly optimistic to believe that corporate profits as a percent of GDP can, for any sustained period, hold much above 6%. One thing keeping the percentage down will be competition, which is alive and well. In addition, there's a public policy point. If corporate investors, in aggregate, are going to eat an ever-growing portion of the American economic pie, some other group will have to settle for a smaller portion. That would justifiably raise political problems, and in my view, a major reslicing of the pie just isn't going to happen. So, where do some reasonable assumptions lead us? Let's say that GDP grows at an average 5% a year, 3% real growth, which is pretty darn good, plus 2% inflation. If GDP grows at 5%, and you don't have some help from interest rates, the aggregate value of equities is not going to grow a whole lot more. Yes, you can add on a bit of return from dividends, but with stocks selling where they are today, the importance of dividends to total return is way down from what it used to be. Nor can investors expect to score because companies are busy boosting their pet share earnings by buying in their stock. The offset here is that the companies are just about as busy issuing new stock, both through primary offerings and those ever-present stock options. So I come back to my postulation of 5% growth in GDP and remind you that it is a limiting factor in the returns you're going to get. You cannot expect to forever realize a 12% annual increase, much less 22%, in the valuation of American business if its profitability is growing only at 5%. The inescapable fact is that the value of an asset, whatever its character, cannot over the long term grow faster than its earnings do. Now, maybe you'd like to argue a different case, fair enough. But give me your assumptions. If you think the American public is going to make 12% a year in stocks, I think you have to say, for example, well, that's because I expect GDP to grow at 10% a year, dividends to add 2% points to returns, and interest rates to stay at a constant level. Or you've got to rearrange these key variables in some other manner. The Tinkerbell approach, clap if you believe, just won't cut it. Beyond that, you need to remember that future returns are always affected by current valuations and give some thought to what you're getting for your money in the stock market right now. Here are two 1998 figures for the Fortune 500. The companies in this universe account for about 75% of the value of all publicly owned American businesses. So when you look at the 500, you're really talking about America, Inc. Fortune 500. 1998 profits, $334,335,000,000. Market value on March 15th, 1999, $9,907,233,000,000. As we focus on those two numbers, we need to be aware that the profits figure has its quirks. Profits in 1998 included one very unusual item, a $16 billion bookkeeping gain that Ford reported from its spin-off of Associates. And profits also included, as they always do in the 500, the earnings of a few mutual companies such as State Farm that do not have a market value. Additionally, one major corporate expense, stock option compensation costs, is not deducted from profits. On the other hand, the profits figure has been reduced in some cases by write-offs that probably don't reflect economic reality and could just as well be added back in. But leaving aside these qualifications, investors were saying on March 15th this year that they would pay a hefty $10 trillion for the $334 billion in profits. Bear in mind, this is a critical fact often ignored, that investors as a whole cannot get anything out of their businesses except what the businesses earn. Sure, you and I can sell each other stocks at higher and higher prices. Let's say the Fortune 500 was just one business and that the people in this room each owned a piece of it. In that case, we could sit here and sell each other pieces at ever-ascending prices. You personally might outsmart the next fellow by buying low and selling high. But no money would leave the game when that happened. You'd simply take out what he put in. Meanwhile, the experience of the group wouldn't have been affected a whit, because its fate would still be tied to profits. The absolute most that the owners of a business in aggregate can get out of it in the end, between now and Judgment Day, is what the business earns over time. There's still another major qualification to be considered. If you and I were trading pieces of our business in this room, we could escape transactional costs because there would be no brokers around to take a bite out of every trade we made. But in the real world, investors have a habit of wanting to change chairs, or at least getting advice as to whether they should, and that costs money. Big money. The expenses they bear, I call them frictional costs, are for a wide range of items. There's the market maker's spread and commissions and sale loads and the 12B1 fees and management fees and custodial fees and wrap fees and even subscriptions to financial publications. And don't brush these expenses off as irrelevancies. If you were evaluating a piece of investment real estate, would you not deduct management costs in figuring your return? Yes, of course. And in exactly the same way, stock market investors who are figuring their returns must face up to the frictional costs they bear. And what do they come to? My estimate is that investors in American stocks pay well over $100 billion a year, say $130 billion, to move around on those chairs or to buy advice as to whether they should. Perhaps $100 billion that relates to the Fortune 500. In other words, investors are dissipating almost a third of everything that the Fortune 500 is earning for them, that $334 billion in 1998, by handing it over to various types of chair-changing and chair-advisory helpers. And when that handoff is completed, the investors who own the 500 are reaping less than a $250 billion return on their $10 trillion investment. In my view, that's slim pickings. Perhaps by now you're mentally quarreling with my estimate that $100 billion flows to those helpers. How do they charge thee? Let me count the ways. Start with transaction costs, including commissions, the markers makers take, and the spread on underwritten offerings. With double counting stripped out, there will this year be at least 350 billion shares of stock traded in the U.S., and I would estimate that the transaction cost per share for each side, that is, for both the buyer and the seller, will average 6 cents. That adds up to $42 billion. Move on to the additional costs. Hefty charges for little guys who have wrap accounts, management fees for big guys, and, looming very large, a raft of expenses for the holders of domestic equity mutual funds. These funds now have assets of about $3.5 trillion. And you have to conclude that the annual cost of these to their investors, counting management fees, sales loads, 12b-1 fees, general operating costs, runs to at least 1% or $35 billion. And none of the damage I've so far described counts the commissions and spreads on options and futures, or the costs borne by holders of variable annuities, or the myriad other charges that the helpers manage to think up. In short, $100 billion of frictional costs for the owners of the Fortune 500, which is 1% of the 500's market value, looks to me not only highly defensible as an estimate, but quite possibly on the low side. It also looks like a horrendous cost. I once heard about a cartoon in which a news commentator says, "There's no trading on the New York Stock Exchange today. Everyone was happy with what they owned." Well, if that were really the case, investors would every year keep around $130 billion in their pockets. Let me summarize what I've been saying about the stock market. I think it's very hard to come up with a persuasive case that equities will over the next 17 years perform anything like they've performed in the past 17. If I had to pick the most profitable return from appreciation and dividends combined that investors in aggregate, repeat, aggregate, would earn in a world of constant interest rates, 2% inflation, and those ever hurtful frictional costs, it would be 6%. If you strip out the inflation component from this nominal return, which you would need to do however inflation fluctuates, that's 4% in real terms. And if 4% is wrong, I believe that the percentage is just as likely to be less as more. Let me come back to what I said earlier, that there are 3 things that might allow investors to realize significant profits in the market going forward. The first was that interest rates might fall. The second was that corporate profits as a percent of GDP might rise dramatically. I get to the third point now. Perhaps you are an optimist who believes that though investors as a whole may slog along, you yourself will be a winner. That thought might be particularly seductive in these early days of the information revolution, which I wholeheartedly believe in. Just pick the obvious winners, your broker will tell you, and ride the wave. Well, I thought it would be instructive to go back and look at a couple of industries that transformed this country much earlier in the century: automobiles and aviation. Take automobiles first. I have here 1 page out of 70 in total of car and truck manufacturers that have operated in this country. At one time, there was a Berkshire car and an Omaha car. Naturally, I noticed those, but there was also a telephone book of others. All told, there appear to have been at least 2,000 car makes in an industry that had an incredible impact on people's lives. If you had foreseen in the early days of cars how this industry would develop, you would have said, "Here is the road to riches." So what did we progress to by the 1990s? After corporate carnage that never let up, we came down to 3 U.S. car companies themselves, no lollapaloozas for investors. So here is an industry that had an enormous impact on America, and also an enormous impact, though not an anticipated one, on investors. Sometimes, incidentally, it's much easier in these transforming events to figure out the losers. You could have grasped the importance of the auto when it came along, but still found it hard to pick companies that would make you money. But there was no one obvious decision you could have made back then. It's better sometimes to turn these things upside down. And that was to short horses. Frankly, I'm disappointed that the Buffett family was not short horses through this entire period. And we really have no excuse. Living in Nebraska, we would have found it super easy to borrow horses and avoid a short squeeze. U.S. horse population, 1900, 21 million. 1998, 5 million. The other truly transforming business invention of the first quarter of the century, besides the car, was the airplane. Another industry whose plainly brilliant future would have caused investors to salivate. So I went back to check out aircraft manufacturers and found that in the 1919 to 39 period, there were about 300 companies, only a handful still breathing today. Among the planes made then, we must have been the Silicon Valley of that age, were both the Nebraska and the Omaha, 2 aircraft that even the most loyal Nebraskan no longer relies upon. Move on to failures of airlines. Here, says Buffett in his speech, waving a piece of paper, is a list of 129 airlines that in the past 20 years filed for bankruptcy. Continental was smart enough to make that list twice. As of 1992, in fact, though the picture would have improved since then, the money that had been made since the dawn of aviation by all of this country's airline companies was zero. Absolutely zero. Sizing all this up, I'd like to think that if I'd been at Kitty Hawk in 1903 when Orville Wright took off, I would have been farsighted enough and public-spirited enough, I owed this to future capitalists, to shoot him down. I mean, Karl Marx couldn't have done as much damage to capitalists as Orville did. I won't dwell on other glamorous businesses that dramatically changed our lives, but concurrently failed to deliver rewards to U.S. investors, the manufacture of radios and televisions, for example. But I will draw a lesson from these businesses. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors. This talk of 17-year periods makes me think, incongruously I admit, of 17-year locusts. What could a current brood of these critters, scheduled to take flight in 2016, expect to encounter? I see them entering a world in which the public is less euphoric about stocks than it is now. Naturally, investors will be feeling disappointment, but only because they started out expecting too much. Grumpy or not, they will have by then grown considerably wealthier simply because the American business establishment that they own will have been chugging along, increasing its profits by 3% annually in real terms. Best of all, the reward from this creation of wealth will have flowed through to Americans in general, who will be enjoying a far higher standard of living than they do today. That wouldn't be a bad world at all, even if it doesn't measure up to what investors got used to in the 17 years just past.
Warren Buffett, Revivalist, May 19, 2000, by Amy Cover. Berkshire Hathaway chairman Warren Buffett calls his annual shareholders' meeting the Woodstock Weekend for Capitalists. But investor Michael Cleveland has a better analogy. It's a religious revival, and Buffett is our evangelist. For years, shareholders have flocked to Omaha each spring to hear Buffett preach the virtues of investing in and holding on to strong, proven businesses. As the incredible returns piled up, so have conversions to Buffettism. But last year, Buffett seemed to have lost his heavenly touch. This year, Berkshire's per-share book value underperformed the S&P 500 index by 20.5 percentage points. The first time in 20 years it lagged the index. The problem? Most of Buffett's blessed stocks, including Coca-Cola and Gillette, tumbled. Meanwhile, infant net stocks soared, making many instant millionaires. Buffett still refused to jump in. He doesn't feel comfortable betting on companies and industries subject to great uncertainties. Berkshire Hathaway fell 50% to a 52-week low of $40,800 a share by early March, enough to rattle the faith of even the most devout. Like any good revivalist, Buffett had a higher power on his side: Wall Street. Miraculously, his stock staged a 47% recovery to around $60,000 just in time for the meeting in late April. What's more, technology stocks tanked. "We're in this stock for the long haul anyway," notes Brian Goebel of Huntington Beach, California. "We're not day traders." Certainly not. Unlike the NouveauRiche.com clique, Buffett heads aren't glam. Rather than Prada slip dresses and Manolo Blahnik pumps, the weekend uniform was a forest green Berkshire t-shirt, emblazoned with a fistful of cash, and matching baseball cap. Few of the folks who lined up for free Danish and coffee looked as if they could afford a $60,000 share of Class A stock. This crowd was particularly pumped when Buffett announced that See's Candies, a company that Berkshire owns outright, was working in collaboration with Mattel to make a Barbie doll dressed in See's classic 1950s salesgirl outfit. Everyone clamored for order sheets. Of course, the weekend wasn't all about Barbies. The meat of the conference was the 7-hour meeting on Saturday in the cavernous Omaha Civic Auditorium. Buffett kicked off the event with a goofy 1-hour movie in which he strummed on a ukulele and played Who Wants to Be a Jillionaire with Regis Philbin. Sample question: what is the surefire investment for the new millennium? Buffett opted for a lifeline call to Bill Gates, after noting, value investing hasn't been working so hot lately. Then the gang settled down to business. For almost 5 hours, shareholders posed questions to Buffett and his vice chairman, Charlie Munger. Some shed their worshipful attitude, pressing Buffett on the company's underwhelming performance last year. One 15-year-old said, "I bought Class B shares 2 years ago for college. When they dipped below 1,500, I decided to investigate correspondence courses." Buffett laughed, as if to say, "You got me." Throughout the weekend, Omaha became a trade show floor showcasing Berkshire's wide-ranging businesses: International Dairy Queen, See's Candies, Dexter Shoe, and World Book. Shareholders scooped up discounted knives, mattresses, and diamonds with a hungry vengeance. On Saturday night, Buffett lured the faithful to a minor league baseball game, though many missed half the game waiting in line for Buffett's autograph. And others took part in their favorite pastime, trading Buffett tales. "Have you driven by his house?" one woman asked. "It's so modest." Another woman says she went to high school with the chairman. She had her photo taken with him at the last reunion. "I had a lot of boasting to do the next day," she laughed. Some had more pressing reasons to make the pilgrimage this year. Bong Zheng, who has owned Berkshire stock for a decade, needed to get back in touch with his Buffett values. It's been hard not to be tempted by internet stocks, explains Young. When you play golf, you chat about investing. My friend is telling me that he's making 80% in tech, while my stock is down 30%. It's hard not to be jealous. So I came here to renew my faith. Exactly, chimes in his wife. Renew. Once again, Sage Buffett gave his minions something to believe in. Warren Buffett invests in the First Lady, October 20th, 2000, by Jeffrey Birnbaum. Warren Buffett, a Democrat through most of his adult life, has over the years supported many a party candidate. But he gained particular attention, as witness the article that follows, when he backed Hillary Clinton's successful bid in 2000 to be elected senator from New York. The plot thickened then, in 2008, as Senator Clinton sought to become the Democrats' candidate for president. That gave Buffett a certain problem, in that he had also developed a cordial relationship with another contender, Barack Obama. Through a friend, Buffett had met Obama earlier when the Chicagoan was preparing to run for senator from Illinois. Obama came to Omaha then for lunch and conversation. Buffett liked the young man and his views, and the two men parted friends. What to do in 2008 then, when Clinton and Obama were both seeking the Democratic nomination? Buffett resolved that question by making himself, in his jest, a political bigamist. That is, he told the candidates that he would back both of them, which indeed he did. And we know who won. C.L.
Warren Buffett started life as a Republican. He had all but inherited the preference from his father, a four-term Republican congressman from Nebraska. Buffett was so zealous that he was president of the Young Republicans Club at the University of Pennsylvania, and in 1948 planned to ride an elephant down a Philadelphia thoroughfare to celebrate the election of Thomas Dewey until Harry Truman defeated Dewey. How times have changed. Buffett these days is decidedly Democratic. He has even raised and given money to, of all people, Hillary Clinton. That's right. The sage of Omaha is putting his money on Clinton's bid to become a senator from New York. Buffett went to Columbia University to appear on the First Lady's behalf alongside former Treasury Secretary Robert Rubin. He also co-hosted fundraisers for her at the Russian Tea Room in Manhattan and at the Omaha home of Vin Gupta, CEO of Info USA. Has he lost his mind? Not at all. I support politicians, irrespective of party, when I think their ideas on important issues are largely in sync with my own, says Buffett, a registered Democrat. In this case, he likes Clinton's pro-choice position on abortion, and her backing of campaign finance reform, a pet project of his. Unlike some of Clinton's donors, Buffett has not slept over at the White House or Camp David. Not even on a couch, he notes. I support her ideas, it's that simple, Buffett says. It's the same reason I voted for her husband. He also has a special affinity for New York. His company, Berkshire Hathaway, owned the Buffalo News, and he says that what happens in the state has an effect well beyond its borders. The surprise is that Buffett gives money to politicians at all. He has pushed hard and publicly in recent years to reform campaign financing. He has focused his ire on the system's most flagrant abuse, so-called soft money, the unlimited contributions to political parties. To avoid being labeled as a hypocrite, Buffett donates only hard money to federal candidates, which is limited to $1,000 per election per candidate. In other words, he has given Clinton $2,000, $1,000 for the primary and $1,000 for the general election. Buffett also doesn't ask others to contribute to his chosen candidates. He says he wants people to donate because they believe in the aspirant, not because he asks them to. Still, the name Warren Buffett on a fundraising invitation is sure to draw a crowd, and he's been careful about which candidates to back. They've mostly been Democrats, including his friend Senator Bob Kerrey of Nebraska, and, for president, former New Jersey Senator Bill Bradley. He also supported such champions of campaign finance reform as Democratic Senator Russ Feingold of Wisconsin and Connecticut's Representative Chris Shays, a Republican. In years past, he backed such well-regarded lawmakers as GOP Senator Nancy Kasbaum of Kansas and Democratic Senator Daniel Patrick Moynihan, whose seat Clinton is fighting to win. "I think she's quite effective and articulate," Buffett says of Clinton. "If she's elected, she'll be more than 1 in 100. Does that mean the First Lady is an undervalued asset?
Admired again and again. Fortune publishes its list of the most admired companies every year, and this year, 2001, our editors plucked Berkshire and Buffett from its number 7 spot on the list to write about and feature on the cover. History and maybe foresight justified that. Berkshire had been in the top 10 of the most admired for 5 years, and has stayed ever since, even after Fortune merged its U.S. and global lists into one world list beginning in 2008. For the last 15 years, 1997 through 2012, Berkshire is the only company that has always made the top 10. Buffett loves it all. Having Berkshire finish high in a list ranked by revenues, as is the Fortune 500, where Berkshire has risen to the top 10, matters little to him. But he values a good reputation immensely. Talking to Fortune in 2010 about how a business earns trust, he said, "You can't do it in a day or week or month. You do it one grain of sand at a time, and you can destroy it fast, but you build it slowly." Being a perennial object of admiration does not rule out a company having operating problems, or perhaps flunking the best use of its assets. And this story, The Value Machine, talks about Berkshire's intractable difficulties with its main subsidiary, Dexter Shoe. Naturally, Buffett did not anticipate problems. He was, in fact, an enthusiastic acquirer when Berkshire bought the company in 1993, paying stock worth $419 million. But Buffett severely underestimated the low-cost overseas competition that Dexter was facing, and by the 1999 annual report was forced to acknowledge that things at the company were not good. In 2000, Berkshire wrote off $219 million of Dexter accounting goodwill, and the next year Buffett threw in the towel, conceding that he, A, shouldn't have bought Dexter in the first place, B, particularly shouldn't have bought it with stock, and C, had procrastinated in attacking its problems. The management of Dexter was turned over in 2001 to another Berkshire shoe company, whose managers, Frank Rooney and Jim Isler, reduced its business, amid plant shutdowns and layoffs, to a few operations. By 2005, the Dexter name had disappeared entirely from Berkshire's annual report. Today, Buffett says of Dexter, "This is definitely the worst acquisition I have ever made, so far." Harold Alfond, chairman and major owner of Dexter when Berkshire bought it, and a well-known philanthropist before and after, died in 2007 and left most of his fortune to the Harold Alfond Foundation. When his will was settled, the foundation's assets jumped 5-fold to $500 million, about 80% of that in Berkshire stock. The foundation principally gives to Maine education, medical, and youth development causes. So that is another example, a paradoxical one, of Berkshire wealth going to philanthropy. C.L. The Value Machine, February 19, 2001, by Carol Loomis. A small quiz, if you don't mind. Kindly describe what each of the companies in the top 10 of the most admired does. Most readers could breeze through 8 of these paragons. They're into megastores, Walmart, the securities brokerages, Schwab, and computer chips, Intel, and so on. General Electric is tougher to parse. It's financial services, but also a TV network, and an electrical equipment and aerospace empire, soon to include Honeywell. But the real puzzler is number 7, Berkshire Hathaway of Omaha. Using a sharp number 2 pencil, could you please write 500 words on that company's business? If you're like many people, you couldn't get past 4 of them. That's Warren Buffett's company. It would take a Berkshire groupie, of whom there are carloads, to elucidate the fine points. What we've got here is a highly unusual combination of a very profitable operating company, insurance in a big way, plus a crazy quilt of other businesses, and a CEO, now 70, who invests its money and who, in that department, has a strong, long-standing claim to being the best in the world. In the 36 years that Buffett has run the company, Berkshire's per-share book value, the performance statistic that best describes the success of an insurance company, has grown, on average, by more than 23% a year. There have been a couple of ugly lurches, notably a terrible year in 1999, but in 32 of the 36 years, Berkshire's per-share results have beaten the total return of the S&P 500, often by miles. Berkshire's stock, which Buffett wouldn't dream of splitting, he sends birthday greetings to friends that say, "May you live until Berkshire splits," has tracked the company's success and then some. In those same 36 years, it has gone from about $12 a share to a year-end price of $71,000, which is an annual growth rate of 27%. Famous though this record may be, even many of the business people who vote for the most admired don't understand the machinery behind Berkshire's value proposition. A few may not even connect with the fact that they're voting, lordy, for an insurance company. But clearly, they like something. This is the 5th straight year that Berkshire has made the top 10. We now interrupt this account for some disclosure. I'm an admirer too, and a longtime friend of Buffett's, and perennial editor of his annual report, though he's most certainly the writer, and a Berkshire shareholder for decades. Buffett and I have talked forever about collaborating on a book about his business career. In terms of words actually written, this has been all hat and no cattle, and as a result, I have had unusual access to his thinking. What I know at this moment is that Berkshire had a remarkable year in 2000, in ways largely unrecognized. I'm not talking about the stock, although that's what most Berkshire followers were looking at. While tech stocks were skyrocketing earlier in the year, Berkshire was tanking. It got all the way down to 40,800 in March, when, Buffett says, we were on that other list, the most admired by short sellers. The stock then came back to that $71,000, which, from the bottom, was a gain of 74%. In late January, the stock was $68,000. The rebound left Berkshire climbing 26.6 for the calendar year, in a down year for most companies, including 7 of the 10 at the top of the most admired list. So what? The real story is what was going on in the company, not the stock. In a grand sweep of allocating capital, which has been his greatest talent, Buffett completed or initiated the purchase of no fewer than 8 companies. We're not talking stocks here, though some of the lot were publicly owned, but rather entire companies. One of the acquisitions, U.S. liability of Wayne, Pennsylvania, adds to Berkshire's insurance empire. The others contribute new swatches to the Berkshire crazy quilt. Being in business as ludicrously diverse and as old economy as bricks and boots, Justin Industries of Fort Worth, and fine jewelry, the Ben Bridge chain headquartered in Seattle, and carpets, Shaw Industries of Dalton, Georgia. The purchase price, in total, was $8 billion. That's an amount dwarfed by the $22 billion in stock that Berkshire paid for reinsurer General Ray in 1998. But the $8 billion paid for the pieces of 8 was almost all cash. That's a lot of cash. More than 5 times as much, for example, as the $1.5 billion that Berkshire put some years ago into the biggest stock investment ever, American Express. None of the $8 billion, furthermore, was borrowed. Buffett just reached into the big bucket of cash equivalents he's been patiently sitting with and handed over the money. When all the acquisitions are complete, Berkshire will have more than doubled the number of its employees and added about $13 billion in revenues, although $5 billion of that, from Mid-American Energy, will not be consolidated because of regulatory restrictions. Even so, when Berkshire's 2000 revenues are reported, they ought to be close to $30 billion. This year, for the first time, Berkshire will be among the top 50 companies on the Fortune 500 list. The company's profits should be in the range of $3 billion, including significant capital gains that Berkshire realized during the year from the sale of certain stocks whose identity Buffett hasn't yet disclosed. Buffett never set out to climb into the upper reaches of the Fortune 500 list. Neither did he have some grand plan for acquisitions, other than answering the phone, he says, as he entered 2000. The truth is, when it comes to creating value for investors, he doesn't see the world the way many chief executives do. He doesn't focus on his company's stock price. On a given day, he may not know where it stands. He is not searching for synergy. He likes to buy businesses that generate healthy earnings and leave them alone. And he is a switch hitter. He has always shown a willingness to buy whole businesses or, alternatively, to buy portions of businesses in the stock market. It's just that in 2000, he went on a kind of buying binge in the whole company camp. And was he concurrently putting new capital into the stock market? No. He's been buying some junk bonds, among them Finovas, but not Consencos, even though some publications recently reported he was. He was, however, a net seller of stocks in 2000, and in each of the 4 years before as well. This retreat fits his well-known opinion that future returns from stocks can't begin to match those that investors earned in the 1980s and 90s. Among the stocks he's known to have chopped in the past few years are McDonald's and Disney. In fact, for all his renown as a stock picker, Buffett has long preferred to have Berkshire grow not by buying stocks that go up, which is what most people would assume, but by adding businesses. Yes, that can add problems too. He's had some. But he'd still rather head in that direction. The preference is emotional, in that he likes dealing with the managers of Berkshire's subsidiaries and building a real working business. And the preference is often economic as well, because of taxes. Imagine that 1. A subsidiary of Berkshire, such as See's Candies, makes $10 million after tax, and that 2. Coca-Cola simultaneously makes $125 million after tax, which would mean Berkshire's share of that, given that it owns 8% of Coke, would be $10 million. The $10 million earned by See's is totally Berkshire's. The Coke $10 million, however, is ensnared. To capture that money, Berkshire must pay additional taxes, either on Coke dividends it receives or on capital gains it realizes upon selling Coke shares. It has never sold any. If the opportunities for reinvesting capital within Coke are sufficiently good, which means that the profits belonging to Berkshire will grow, Buffett happily accepts the tax toll. But otherwise he has no problem identifying the $10 million earned inside as what he'd like to have. He likes cash of all kinds, of course, and in Berkshire he has built a machine that produces prodigious amounts of it. The engine in the machine is the company's insurance business, which yields that wonderful thing called float. Money an insurer can invest while it's holding premiums that will eventually go to pay claims. The businesses Buffett buys with his available funds become parts of the machinery too, generating cash for further investment. As for what he buys, Buffett likes companies at sensible prices, which leaves him avoiding the auctions investment bankers run, that throw off cash and have capable, honest, and trustworthy people running them. He wants substantial earnings, for sure, but cares not at all whether they are consistent. Quote, "I'd rather have a lumpy 15% return on capital," he has often said, "than a smooth 12%. And he wants businesses that he can understand and that are not subject to major change. It is the rapid change in technology that has kept him away from tech investments. He feels that he cannot be sure how much cash flow a tech company will be producing 10 years from now, so he stays away. To get good companies at good prices, it helps to be perceived as a great owner, and Buffett has that reputation. He has piled up furniture retailers more or less by word of mouth, the first one in Omaha, the next in Utah, then Texas, then Massachusetts, then Iowa. For some sellers, Berkshire is a refuge, a place to land when, say, some members of a family that controls a private company want cash and others wish to keep running the business. To the latter, Buffett promises independence and respect, and then, barring some irreconcilable problem that just has to be dealt with, delivers on the commitment. "We don't have any MBAs running around telling these people what to do," Buffett says, and God knows I wouldn't know what to tell them. To public companies that may also have a family reason for selling, or that just want to escape the cold world of regrettable stock prices, unrealistic quarterly demands, and unfriendly suitors, he is equally a haven. These are acquisition parameters that have logic in any year, but 2000 had a tightening financial character that gave Berkshire an edge in buying companies. The money available for purchases of companies got short as the year went on, with junk bonds tough to sell and big equity investors skittish. In fact, a New York investment banker visiting Buffett told him that he thought of Berkshire as the only investor in the country that could lay out $5 billion for an equity position. There is no better example of Berkshire's edge, and of Buffett's agility in exploiting it, than the Johns Manville purchase, the 8th acquisition of the year. Manville's profile in 2000 included $2 billion in revenues from insulation and roofing products, more than $200 million in profits, and a controlling stockholder, a trust that had been set up in Manville's bankruptcy days to assume its asbestos liabilities. In mid-2000, a buyout group made a deal to acquire the company for $2.8 billion. But Manville's business later went into a cyclical slide, and the buyers ran into financing problems. They bowed out December 8, a Friday. Among those left stranded was Manville's CEO, Charles "Jerry" Henry, who had been set to participate in the buyout and was looking forward to getting divorced from the trust. Buffett and the man he's long called his partner, Berkshire's vice chairman, Charles Munger, who lives in Los Angeles, had been wishfully watching the Manville action from the wings. And 3 days later, on Monday, they called the trust and offered $2.2 billion for Manville, cash on the barrel. They had a deal, negotiated by phone, in 24 hours, and an announcement December 20th. That afternoon, Jerry Henry went before Manville's Denver employees and announced, to cheers, "There is a Santa Claus, but he's not located at the North Pole, my friends. He's in Omaha." Henry, 59, has since met with Buffett in Omaha for about 6 hours. He went into the meeting, Henry says, thinking about plans he had to retire and ready to say, "I'm gone," if he got any clue that he couldn't work with Buffett. Instead, he says, he emerged from the meeting charged up. Quote, "I came out totally committed to making this thing work. It's easy to see what happens with Buffett's companies. You end up saying you don't want to let this guy down." For this article, I talked to the heads of all 8 of the companies Berkshire bought. I heard no complaints about their new owner, just compliments. True, there's no reason these people should publicly grouse about their boss, especially to one of his friends. But it's also true that I heard stories from the sellers about money renounced, just so a Berkshire deal could be made. Ed Bridge, 44, the 4th-generation co-head of Ben Bridge Jeweler, got to thinking a couple of years ago, in a period when he was ill, that he should sell his family's much-treasured, privately owned company. He considered an IPO, or an LBO, or selling to a strategic buyer, meaning someone in a related business. But he also got a push toward Berkshire from Barnett Hellsberg of Kansas City, who'd sold his own jewelry store business to Buffett in 1995. Bridge couldn't quite see why Buffett would be interested in his relatively small company, described by Bridge as 65 doors in 11 western states. Bridge, nonetheless, talked by phone to Buffett early last year and then sent him some financial data. Back came Buffett's enthusiastic reply, recalled by Bridge as, "You guys are great, great, great." Things then moved toward a deal. But a strategic buyer heard that Bridge might be selling and began edging up to an offer. "I think," says Bridge, "that we probably could have received 20% more from this buyer than we got from Berkshire. But I also think we would have destroyed the business if we had gone that way." So in early May, he and Buffett agreed on the details of a deal, including a price not being made public. They didn't shake hands because they hadn't ever met at that point. That suited Buffett just fine. Quote, "I buy companies all the time over the phone," he told Bridge. But Bridge really wanted to see this fellow personally. He got the chance later in May, when Buffett, on his way to a Microsoft conference, stopped to do a Bridge visit. The managers and employees that he talked to that day got hours of his attention. He has great stamina when doing something he likes. They also got a dose of the usual Buffett. Bespectacled, Midwestern looks, carelessly combed gray hair, unbuttoned suit coat, suspenders, and probably the same tie he'd worn for a month straight. Plain talk dressed in metaphors. One directive Buffett gave that day is familiar to many of his companies. Just keep on doing what you're doing. We're never going to tell a 400 hitter how to change his batting stance. Bridge also recalls that, as he and Buffett drove past a See's candy store, Buffett reeled off its dollar sales. To Bridge's marveling at this feat of memory, Buffett replied, "Well, I love numbers." That made Bridge think back to what the head of a Berkshire subsidiary had warned when Bridge inquired about Buffett. Quote, "Don't show him any number you don't want him to see because he'll remember it." Buffett's buying binge naturally raises a question. How have his past acquisitions performed? Generally, they have been very successful, but not all have been unequivocal winners. General Ray, his $22 billion purchase of 1998, has slogged through a tough reinsurance market and been hurt by its own pricing mistakes. It's working its way out of those, and had improved results in 2000. But some insurance analysts have argued that Buffett goofed in making this purchase. He himself mourns any deal that must be made in stock, as this one was, because he so dislikes relinquishing pieces of ownership in Berkshire. But he says he is confident Gen Re will turn into a valuable Berkshire asset. In Buffett's non-insurance companies, the manufacturers, retailers, and service companies, in other words, the profit margins generally look good, especially considering that these businesses are largely mundane. In 1999, the companies made $700 million pre-tax on $5.7 billion in revenues. After tax, their margin was around 7.7%, which was well above the Fortune 500's median of 5%. Furthermore, the managers of many Berkshire subsidiaries work under compensation agreements that encourage them to hold their use of capital to a minimum and to zip any spare dollars off to Omaha headquarters. Quote, "That's why," Buffett says, "I always come down to the office on Saturday to personally open the mail." Once the dollars get to headquarters, by the way, they don't go to paying Buffett. His Berkshire salary is $100,000 a year, and not set to rise. On the other hand, he owns 31% of Berkshire's stock, recently worth about $32 billion, so we won't feel sorry for him. In his manufacturing lineup, Buffett's biggest disappointment has been Dexter Shoe, a Maine company he bought in the early 1990s for some $440 million in stock. Encountering severe foreign competition, Dexter tried hard to stick with U.S. plants, and all it got for its pains was drastically reduced profits and then losses. Making the kind of statement he has had very little experience with, Buffett will say in his annual report that he clearly overpaid for Dexter and that he compounded the mistake by paying in stock. He will add that he does not consider Dexter's management to have been at fault. But he has had to deal occasionally with other situations in which management was patently the problem, and in which he has had to resort to firing people. Some of the problems have arisen in companies he's bought from families, in which the older, highly competent managers initially in charge do not have children with comparable abilities, which may be, he recognizes, the reason the elders decided to sell. He hit that kind of trouble at Feckheimer, a Cincinnati manufacturer of uniforms that Berkshire bought in 1986, when it was run by two brothers in their mid-60s. One brother then retired, and the other, the CEO, became ill. The CEO's son took over but couldn't cut the mustard and was ousted. Years went by with no CEO settled upon. Finally, in 1999, Buffett made a rare attempt to cross-pollinate, making a manager from one of his insurance companies, Brad Kinsler, the head of Feckheimer. Quote, "And he's just terrific," says Buffett relievedly. "We may have to try this kind of thing more often." The vigor with which Buffett goes at fixing up his machine, or doing anything that involves Berkshire, belies his 70 years. Nonetheless, his age is a subject that often preys on the minds of the company's shareholders. Their concern is rational, given what Berkshire is. First, it is a fine collection of assets, whose value would survive Buffett's not being around. Second, it is his skill at investing the cash flow from these assets, and this talent is probably irreplaceable. The age topic got special attention last summer when Buffett underwent an operation to remove several polyps, all benign, in his colon. He recovered quickly, resumed his morning run on a treadmill, and returned to eating hamburgers, French fries snowed under by salt, and the occasional Dairy Queen sundae, all washed down by cherry cokes. Nonetheless, the operation drove the press to review what he had said in his annual report about management succession. If he were to die today, his 46-year-old son, Howard, chairman of an agricultural equipment firm in Assumption, Illinois, and also a working farmer, would become non-executive chairman of Berkshire. The sweeping job that the boss does now would be split between two people. Lewis Simpson, 64, who manages the investments of Berkshire's Geico subsidiary, would probably take over Berkshire's portfolio. The job of overseeing Berkshire's operating subsidiaries would go to some insider, whom Buffett has selected but not identified publicly. In an October article, the Wall Street Journal speculated that 3 executives in Berkshire's subsidiaries had the lead. Ajit Jian, 49, who works with Buffett in constructing big arcane insurance deals, Tony Nicely, 57, head of Geico, and Richard Santulli, 56, CEO of Executive Jet. Buffett says any one of them could do his job better than he can, quote, but don't let that get around. He has a solution anyway, quote, forget about splitting the stock. We're just going to split my age. The fact is that it's hard to take any discussion of successors seriously because Buffett and his doctor consider his health good, and he simply plans to keep doing his job indefinitely. He loves his work. Loves it. So does Jack Welch, of course, but GE has retirement rules, and Berkshire doesn't. Buffett sent Welch a kidding reminder of that recently after Welch, 65, made a comment to the Financial Times about age. Quote, there is nothing worse than seeing the old drooling chairman sitting in the seat. Buffett faxed that sentence to Welch with a scrawled message, Jack, we don't tolerate this sort of talk at Berkshire. I keep Charlie on stage. That would be Vice Chairman Munger, 77, on the stage at Berkshire's annual meeting. So the stockholders know it could be worse. It may seem odd to ask a 77-year-old whether he thinks his 70-year-old friend is still sharp, but that's what we did recently with the aforesaid Charlie, who is recognized as astute by all who know him. Does he see, we asked Munger, any diminution of Buffett's mental powers or ability to think outside the box? Munger first came through with a totally typical monosyllabic answer. No. Prodded to elaborate, he said the Buffett of today might just be a little better than the Buffett of all the yesterdays. Because he knows more, Munger says. Now, I've watched enough people age to know that things can happen pretty fast. Some people go along at 90 miles an hour and then, like an orange tree does, they go into a quick decline. So you can't make extrapolations, but I don't see the slightest diminution in Warren's mental powers. Munger adds that Berkshire has built up a reputational advantage. That gives you shortcuts, he says. We basically made a deal to buy John's Manville without meeting any of the people. To those who know him, it also seems that Buffett keeps coming up with fresh ideas. They don't have much to do with product innovation, unless you count his dedication to helping See's pick new lollipop flavors. But Berkshire has repeatedly dealt with its shareholders in an innovative way, giving them an owner's manual that states Berkshire's operating principles, permitting them to personally determine, based on how many shares each has, where Berkshire's charitable contributions should go, even structuring an annual meeting that permits shareholders 5 hours of opportunity to ask the bosses, Buffett and Munger, any business-related question they want. And, of course, the annual meeting in Omaha is itself unique. Around 10,000 shareholders turn up, many from abroad, for an entire weekend of festivities. A baseball game, at which Buffett throws the first pitch, usually poorly, out-of-control shopping, I hope, says Buffett, at Borsheim's, Berkshire's Omaha jewelry store, and those hours of Buffett and Munger teaching, because that's what it is, at the meeting itself. In sum, this is a company that thinks first and foremost about its shareholders. Though there may be one point on which Buffett and some of his flock disagree. Other than Buffett, I have never met a CEO who didn't think his stock was undervalued. Buffett, however, has gone through periods, one was in 1998, when Berkshire rose above $80,000, in which he felt the stock was overpriced. And he agonized about it, because he does not like to think of Berkshire shareholders as either buying or selling at prices that are significantly out of line with what he views as a zone of fairness. "I'll say this," he said recently. "I'm bothered more by Berkshire getting too high than too low." Will this heresy get him ejected from the top 10 of the most admired? For Berkshire shareholders, the fresh ideas that probably matter most are those that come out of the company's core insurance company, National Indemnity. Over the years, the insurer has built a worldwide reputation for its willingness to write a policy covering just about any risk, of almost any size, though the company always caps its exposure, if the premium is satisfactory. Figuring the odds on these policies is a joint project of Buffett and Ajit Jain, both eminently suited to the game, and the two sometimes take Berkshire into weird territory. It would require pages to discuss that terrain fully, but here's an example. Last year, they wrote a policy protecting Grab.com against having to pay a $1 billion prize, with a present value of $170 million, a lure that Grab.com used to attract millions of people to its internet site, so as to gather information about them that would be useful to marketers. The game for visitors to the site was to pick 7 numbers between 1 and 77. Bulletins warned that the odds against anybody's picking the right 7 were formidable. Nobody knew that better than Buffett and Jihan. And in fact, no one did win. But obviously somebody could have, which would have put a huge hole in Berkshire's earnings. Quote, "I wouldn't have thrown a party if we had had to pay off," says Buffett. "But we take well-judged chances like that all the time. That's what we do that almost no one else is willing to do." Jihan, whose office is in Connecticut, is someone who has actually seen a change in Buffett. In the early 90s, the two used to talk almost every night around 9, Omaha time, about the day's insurance happenings. Then Buffett started playing bridge on the internet, and that's where he normally is now at 9. Jihan says the change is okay. Quote, "We just talk now before or after the bridge game." Having frequently played bridge with Buffett both as partner and opponent, I have come to think that his bridge style, in some ways, resembles his business and investing style, though he is far harder on some of his bridge partners than on his managers. In bridge, he does not employ some of the modern bidding conventions that most players accept as standard. He knows all the odds in the game, and both bids and plays his hands with them in mind. He is analytical and focused when playing, and he keeps getting better, though he's not what bridge folk call expert. When he makes a stupid mistake, he tends to be hard on himself. "I can't believe I did that," he said recently after one hand. "That was incredible." The self-accusatory remark reminded me of something he once said about his mistakes in business. It wouldn't matter to me that nobody else knew. I'd know. The records show there can't have been too many of those mistakes. And given continued good health, Buffett is likely to keep on burnishing the record as well. An interesting fact about Berkshire at the moment is that its 3 largest stock holdings, Coke, American Express, and Gillette, all have new CEOs. Douglas Daft at Coke, Kenneth Chenault at American Express, and James Kiltz, a Nabisco executive who was just hired at Gillette. That will give Buffett something to watch. And as he says, with relish, I've got all these wonderful companies that we own to look at. He also still has cash. Quote, "This place reminds me of Mickey Mouse as the sorcerer's apprentice in Fantasia," he says. His problem was floods of water. Ours is cash. The stuff never burns a hole in Buffett's pocket. Patience is one of his strengths. Now that he's into serial buying, though, you wouldn't want to lay odds, unless you covered yourself with a Berkshire insurance policy, that he won't strike again. A letter from Fortune's Letters column, March 26, 2001. The Value Machine is a great article, but I'd like to quibble with one point you make. Buffett isn't searching for synergy. Whether he's searching for it or not, he has an uncanny record for delivering it. Time after time, a good return on equity has become a great one under the Berkshire umbrella. Consider See's Candy, Buffalo News, Scott Fetzer, and so on. Double the return on equity of a company, and you get much more than a doubling of the company's intrinsic value. While the record for synergy is interesting, the source of that record is important. Buffett is the only conglomerator I can think of who doesn't hew to the command and control model. To that extent, he has created a new management model. Buffett is one of the greatest managers in history. He created the most successful of all the 60s conglomerates, the most successful of all the 70s inflation hedges, and he's on the verge of creating the biggest category killer of all time, a collection of category killers. He should get his due as a manager. Charles Wallman, Washington Island, Wisconsin. Warren Buffett on the stock market, December 10, 2001. A Buffett speech that Carol Loomis converted into an article. Buffett's speech at Allen & Company's 1999 Sun Valley, Idaho conclave of business leaders was so widely admired that Herbert Allen, head of the company, asked Buffett 2 years later for a reprise. Once again, I worked with Buffett to convert his speech, given in July 2001, into a Fortune article. On the opening page, we set up the piece with a question. So where do we stand now, with the stock market seeming to reflect a dismal profit outlook, an unfamiliar war, and rattled consumer confidence? Buffett's discussion, an exemplar of his out-of-the-box thinking, turns to several themes he feels deeply about: the resilience of the U.S. economy, the inability of investors, very much including pension funds, to ignore the rearview mirror, the importance of price engaging when it's time to buy. In the 2 years between his first speech and the second, indeed, the Dow Industrials had dropped from 11,194 to 9,500 as the Internet bubble deflated. Just on the basis of price, Buffett's expectations for long-term stock returns had therefore improved. But not by a lot. A chart in the article, based on a Buffett metric, showed that prices were still historically high in relation to GNP. The chart became famous. Over the years that followed, I would frequently get calls and emails asking Fortune to update it, and in fact we ultimately did, running a new version of the chart in early 2009, when for a time it appeared that stocks would never hit bottom. CL.
The last time I tackled this subject, in 1999, I broke down the previous 34 years into two 17-year periods, which, in the sense of lean years and fat, were astonishingly symmetrical. Here's the first period. As you can see, over 17 years, the Dow gained exactly 0.1%. Dow Jones Industrial Average, December 31st, 1964, 874.12. December 31st, 1981, 875.0. And here's the second, marked by an incredible bull market that, as I laid out my thoughts, was about to end, though I didn't know that. Dow Industrials, December 31st, 1981, 875.0. December 31st, 1998, 9,181.43. Now, you couldn't explain this remarkable divergence in markets by, say, differences in the growth of gross national product. In the first period, that dismal time for the market, GNP actually grew more than twice as fast as it did in the second period. Gain in gross national product, 1964 to 1981, 373%. 1981 to 1998, 177%. So what was the explanation? I concluded that the market's contrasting moves were caused by extraordinary changes in two critical economic variables, and by a related psychological force that eventually came into play. Here I need to remind you about the definition of investing, which, though simple, is often forgotten. Investing is laying out money today to receive more money tomorrow. That gets to the first of the economic variables that affected stock prices in the two periods, interest rates. In economics, interest rates act as gravity behaves in the physical world. At all times, in all markets, in all parts of the world, the tiniest change in rates changes the value of every financial asset. You see that clearly in the fluctuating prices of bonds. But the rule applies as well to farmland, oil reserves, stocks, and every other financial asset. And the effects can be huge on values. If interest rates are, say, 13%, the present value of $1 that you're going to receive in the future from an investment is not nearly as high as the present value of $1 if rates are 4%. So here's the record on interest rates at key dates in our 34-year span. They moved dramatically up. That was bad for investors in the first half of that period, and dramatically down, a boon for investors, in the second half. Interest rates, long-term government bonds, December 31st, 1964. 4.2%, December 31st, 1981, 13.65%, December 31st, 1998, 5.09%. The other critical variable here is how many dollars investors expected to get from the companies in which they invested. During the first period, expectations fell significantly because corporate profits weren't looking good. By the early 1980s, Fed Chairman Paul Volcker's economic sledgehammer had, in fact, driven corporate profitability to a level that people hadn't seen since the 1930s. The upshot is that investors lost their confidence in the American economy. They were looking at a future they believed would be plagued by two negatives. First, they didn't see much good coming in the way of corporate profits. Second, the sky-high interest rates prevailing caused them to discount these meager profits further. These two factors working together caused stagnation in the stock market from 1964 to 1981, even though those years featured huge improvements in GNP. The business of the country grew, while investors' valuation of that business shrank. And then, the reversal of those factors created a period during which much lower GNP gains were accompanied by a bonanza for the market. First, you got a major increase in the rate of profitability. Second, you got an enormous drop in interest rates, which made that dollar of future profit that much more valuable. Both phenomena were real and powerful fuels for a major bull market. And in time, the psychological factor I mentioned was added to the equation. Speculative trading exploded, simply because of the market action that people had seen. Later, we'll look at the pathology of this dangerous and oft-recurring malady. 2 years ago, I believed the favorable fundamental trends had largely run their course. For the market to go dramatically up from where it was then would have required long-term interest rates to drop much further, which is always possible, or for there to be a major improvement in corporate profitability, which seemed, at the time, considerably less possible. If you take a look at a 50-year chart of after-tax profits as a percentage of gross domestic product, you find that the rate normally falls between 4%, that was its neighborhood in the bad year of 1981, for example, and 6.5. For the rate to go above 6.5% is rare. In the very good profit years of 1999 and 2000, the rate was under 6%, and this year it may well fall below 5%. So there you have my explanations of those two wildly different 17-year periods. The question is, how much do those periods of the past for the market say about its future? To suggest an answer, I'd like to look back over the 20th century. As you know, this was really the American century. We had the advent of autos, we had aircraft, we had radio, TV, and computers. It was an incredible period. Indeed, the per capita growth in U.S. output, measured in real dollars, that is, with no impact from inflation, was a breathtaking 702%. The century included some very tough years, of course, like the Depression years of 1929 to 1933, but a decade-by-decade look at the per capita GNP shows something remarkable. As a nation, we made relatively consistent progress throughout the century, so you might think that the economic value of the U.S., at least as measured by its securities markets, would have grown at a reasonably consistent pace as well. That's not what happened. We know from our earlier examination of the 1964 to 98 period that parallelism broke down completely in that era. But the whole century makes this point as well. At its beginning, for example, between 1900 and 1920, the country was chugging ahead, explosively expanding its use of electricity, autos, and the telephone. Yet the market barely moved, recording a 0.4% annual increase that was roughly analogous to the slim pickings between 1964 and 1981. Dow Industrials, December 31st, 1899, 66.08. December 31st, 1920, 71.95. In the next period, we had the market boom of the 20s, when the Dow jumped 430% to 381 in September 1929. Then we go 19 years, and there was the Dow at 177, half the level where it began. That's true even though the 1940s displayed by far the largest gain per capita GDP, 50%, of any 20th century decade. Following that came a 17-year period when stocks finally took off, making a great 5-to-1 gain. And then the two periods discussed at the start, stagnation until 1981, and the roaring boom that wrapped up this amazing century. To break things down another way, we had three huge secular bull markets that covered about 44 years, during which the Dow gained more than 11,000 points. And we had three periods of stagnation, covering some 56 years. During those 56 years, the country made major economic progress, and yet the Dow actually lost 292 points. How could this have happened? In a flourishing country in which people are focused on making money, how could you have had three extended and anguishing periods of stagnation that, in aggregate, leaving aside dividends, would have lost you money? The answer lies in the mistake that investors repeatedly make, the psychological force I mentioned above. People are habitually guided by the rearview mirror and, for the most part, by the vistas immediately behind them. The first part of the century offers a vivid illustration of that myopia. In the century's first 20 years, stocks normally yielded more than high-grade bonds. That relationship now seems quaint, but it was then almost axiomatic. Stocks were known to be riskier, so why buy them unless you were paid a premium? And then came along a 1924 book, slim and initially unheralded, but destined to move markets as never before, written by a man named Edgar Lawrence Smith. The book, called Common Stocks as Long-Term Investments, chronicled a study Smith had done of security price movements in the 56 years ended in 1922. Smith had started off his study with a hypothesis. Stocks would do better in times of inflation, and bonds would do better in times of deflation. It was a perfectly reasonable hypothesis. But consider the first words in the book. These studies are the record of a failure, the failure of facts to sustain a preconceived theory. Smith went on. The facts assembled, however, seem worthy of further examination. If they would not prove what we had hoped to have them prove, it seemed desirable to turn them loose and to follow them to whatever end they might lead. Now there was a smart man who did just about the hardest thing in the world to do. Charles Darwin used to say that whenever he ran into something that contradicted a conclusion he cherished, he was obliged to write the new finding down within 30 minutes. Otherwise, his mind would work to reject the discordant information, much as the body rejects transplants. Man's natural inclination is to cling to his beliefs, particularly if they are reinforced by recent experience. A flaw in our makeup that bears on what happens during secular bull markets and extended periods of stagnation. To report what Edgar Lawrence Smith discovered, I will quote a legendary thinker, John Maynard Keynes, who in 1925 reviewed the book, thereby putting it on the map. In his review, Keynes described perhaps Mr. Smith's most important point, and certainly his most novel point. Well-managed industrial companies do not, as a rule, distribute to the shareholders the whole of their earned profits. In good years, if not in all years, they retain a part of their profits and put them back in the business. Thus, there is an element of compound interest operating in favor of a sound industrial investment. It was that simple. It wasn't even news. People certainly knew that companies were not paying out 100% of their earnings, but investors hadn't thought through the implications of the point. Here, though, was this guy Smith saying, why do stocks typically outperform bonds? A major reason is that businesses retain earnings, with these going on to generate still more earnings, and dividends too. That finding ignited an unprecedented bull market. Galvanized by Smith's insight, investors piled into stocks, anticipating a double dip, their higher initial yield over bonds and growth to boot. For the American public, this new understanding was like the discovery of fire. But before long, that same public was burned. Stocks were driven to prices that first pushed down their yield to that on bonds, and ultimately drove their yield far lower. What happened then should strike readers as eerily familiar. The mere fact that share prices were rising so quickly became the main impetus for people to rush into stocks. What the few bought for the right reason in 1925, the many bought for the wrong reason in 1929. Astutely, Keynes anticipated a perversity of this kind in his 1925 review. He wrote, "It is dangerous to apply to the future inductive arguments based on past experience, unless one can distinguish the broad reasons why past experience was what it was. If you can't do that," he said, "you may fall into the trap of expecting results in the future that will materialize only if conditions are exactly the same as they were in the past." The special conditions he had in mind, of course, stemmed from the fact that Smith's study covered a half-century during which stocks generally yielded more than high-grade bonds. the colossal miscalculation that investors made in the 1920s has recurred in one form or another several times since. The public's monumental hangover from its stock binge of the 1920s lasted, as we have seen, through 1948. The country was then intrinsically far more valuable than it had been 20 years before. Dividend yields were more than double the yield on bonds, and yet stock prices were at less than half their 1929 peak. The conditions that had produced Smith's wondrous results had reappeared in spades. But rather than seeing what was in plain sight in the late 1940s, investors were transfixed by the frightening market of the early 1930s and were avoiding re-exposure to pain. Don't think for a moment that small investors are the only ones guilty of too much attention to the rearview mirror. Let's look at the behavior of professionally managed pension funds in recent decades. In 1971, this was nifty-50 time, pension managers, feeling great about the market, put more than 90% of their net cash flow into stocks, a record commitment at the time. And then, in a couple of years, the roof fell in and stocks got way cheaper. So what did the pension fund managers do? They quit buying because stocks got cheaper. Private pension funds. Percent of cash flow put into equities. 1971, 91%, record high. 1974, 13%. This is the one thing I can never understand. To refer to a personal taste of mine, I'm going to buy hamburgers the rest of my life. When hamburgers go down in price, we sing the Hallelujah chorus in the Buffett household. When hamburgers go up, we weep. For most people, it's the same way with everything in life they will be buying, except stocks. When stocks go down and you can get more for your money, people don't like them anymore. That sort of behavior is especially puzzling when engaged in by pension fund managers who, by all rights, should have the longest time horizon of any investors. These managers are not going to need the money in their funds tomorrow, not next year, not even next decade. So they have total freedom to sit back and relax. Since they are not operating with their own funds, moreover, raw greed should not distort their decisions. They should simply think about what makes the most sense. Yet they behave just like rank amateurs, getting paid, though, as if they had special expertise. In 1979, when I felt stocks were a screaming buy, I wrote in an article, "Pension fund managers continued to make investment decisions with their eyes firmly fixed on the rear-view mirror. This generals fighting the last war approach has proved costly in the past and will likely prove equally costly this time around." That's true, I said, because stocks now sell at levels that should produce long-term returns far superior to bonds. Consider the circumstances in 1972 when pension fund managers were still loading up on stocks. The Dow ended the year at 1,020, had an average book value of 625, and earned 11% on book. 6 years later, the Dow was 20% cheaper, its book value had gained nearly 40%, and it had earned 13% on book. Or, as I wrote then, stocks were demonstrably cheaper in 1978 when pension fund managers wouldn't buy them than they were in 1972 when they bought them at record rates. At the time of the article, long-term corporate bonds were yielding about 9.5%. So I asked this seemingly obvious question. Can better results be obtained over 20 years from a group of 9.5% bonds of leading American companies maturing in 1999 than from a group of Dow-type equities purchased in aggregate around book value and likely to earn in aggregate about 13% on that book value? The question answered itself. Now, if you had read that article in 1979, you would have suffered, oh, how you would have suffered, for about 3 years. I was no good then at forecasting the near-term movements of stock prices, and I'm no good now. I never have the faintest idea what the stock market is going to do in the next 6 months, or the next year, or the next 2. But I think it is very easy to see what is likely to happen over the long term. Ben Graham told us why. Though the stock market functions as a voting machine in the short run, it acts as a weighing machine in the long run. Fear and greed play important roles when votes are being cast, but they don't register on the scale. By my thinking, it was not hard to say that over a 20-year period, a 9.5% bond wasn't going to do as well as the disguised bond called the Dow that you could buy below par, that's book value, and that was earning 13% on par. Let me explain what I mean by that term I slipped in there, disguised bond. A bond, as most of you know, comes with a certain maturity and with a string of little coupons. A 6% bond, for example, pays a 3% coupon every 6 months. A stock, in contrast, is a financial instrument that has a claim on future distributions made by a given business, whether they are paid out as dividends, or to repurchase stock, or to settle up after sale or liquidation. These payments are in effect coupons. The set of owners getting them will change as shareholders come and go, but the financial outcome for the business's owners as a whole will be determined by the size and timing of these coupons. Estimating those particulars is what investment analysis is all about. Now, gauging the size of those coupons gets very difficult for individual stocks. It's easier, though, for groups of stocks. Back in 1978, as I mentioned, we had the Dow earning 13% on its average book value of $850. The 13% could only be a benchmark, not a guarantee. Still, if you'd be willing then to invest for a period of time in stocks, you were, in effect, buying a bond at prices that in 1979 seldom inched above par, with a principal value of $891 and a quite possible 13% coupon on the principal. How could that not be better than a 9.5% bond? From that starting point, stocks had to outperform bonds over the long term. That, incidentally, has been true during most of my business lifetime. But as Keynes would remind us, the superiority of stocks isn't inevitable. They own the advantage only when certain conditions prevail. Let me show you another point about the herd mentality among pension funds, a point perhaps accentuated by a little self-interest on the part of those who oversee the funds. Here are 4 well-known companies, typical of many others I could have selected, and the expected returns on their pension funds' assets that they used in calculating what charge, or credit, they should make annually for pensions. Expected pension fund returns. Exxon, 1975, 7%, 1978, 7.8%, 2000, 9.5%. General Electric, 1975, 6%, 1978, 7.5%, 2000, 9.5%. General Motors, 1975, 6%, 1978, 7%, 2000, 10%. IBM, 1975, 4.8%, 1978, 5.5%, 2000, 10%. Yield on long-term government bonds, 1975, 8%, 1978, 10.4%, 2000, 5.5%. Now, the higher the expectation rate that a company uses for pensions, the higher its reported earnings will be. That's just the way that pension accounting works, and I hope, for the sake of relative brevity, that you'll just take my word for it. Expectations in 1975 were modest. 7% for Exxon, 6% for GE and GM, and under 5% for IBM. The oddity of these assumptions is that investors could then buy long-term government non-callable bonds that paid 8%. In other words, these companies could have loaded up their entire portfolio with 8% no-risk bonds, but they nevertheless used lower assumptions. By 1982, they had moved up their assumptions a little bit, most to around 7%. But now you could buy long-term governments at 10.4%. You could, in fact, have locked into that yield for decades by buying so-called strips that guaranteed you a 10.4% reinvestment rate. In effect, your idiot nephew could have managed the fund and achieved returns far higher than the investment assumptions corporations were using. Why in the world would a company be assuming 7.5% when it could get nearly 10.5% on government bonds? The answer is that rearview mirror again. Investors who'd been through the collapse of the Nifty 50 in the early 1970s were still feeling the pain of the period and were out of date in their thinking about returns. They couldn't make the necessary mental adjustment. Now, fast forward to 2000, when we had long-term governments at 5.4%. And what were the four companies saying in their 2000 annual reports about expectations for their pension funds? They were using assumptions of 9.5% and even 10%. I'm a sporting type, and I would love to make a large bet with the chief financial officer of any one of those four companies, or with their actuaries or auditors, that over the next 15 years, they will not average the rates they've postulated. Just look at the math for one thing. A fund's portfolio is very likely to be 1/3 bonds on which, assuming a conservative mix of issues with an appropriate range of maturities, the fund cannot today expect to earn much more than 5%. It's simple to see, then, that the fund will need to average more than 11% on the 2/3 that's in stocks to earn about 9.5% overall. That's a pretty heroic assumption, particularly given the substantial investment expenses that a typical fund incurs. Heroic assumptions do wonders, however, for the bottom line. By embracing those expectation rates, these companies report much higher earnings, much higher, than if they were using lower rates. And that's certainly not lost on the people who set the rates. The actuaries who have roles in this game know nothing special about future investment returns. What they do know, however, is that their clients desire rates that are high, and a happy client is a continuing client. Are we talking big numbers here? Let's take a look at General Electric, the country's most valuable and most admired company. I'm a huge admirer myself. GE has run its pension fund extraordinarily well for decades, and its assumptions about returns are typical of the crowd. I use the company as an example simply because of its prominence. If we may retreat to 1982 again, GE recorded a pension charge of $570 million. That amount cost the company 20% of its pre-tax earnings. Last year, GE recorded a $1.74 billion pension credit. That was 9% of the company's pre-tax earnings, and it was 2.5 times the appliance division's profit of $684 million. A $1.74 billion credit is simply a lot of money. Reduce that pension assumption enough, and you wipe out most of the credit. GE's pension credit, and that of many other corporations, owes its existence to a rule of the Financial Accounting Standards Board that went into effect in 1987. From that point on, companies equipped with the right assumptions and getting the fund performance they needed could start crediting pension income to their income statements. Last year, according to Goldman Sachs, 35 companies in the S&P 500 got more than 10% of their earnings from pension credits, even as, in many cases, the value of their pension investments shrank. Unfortunately, the subject of pension assumptions, critically important though it is, almost never comes up in corporate board meetings. I myself have been on 19 boards, and I have never heard a serious discussion of the subject. And now, of course, the need for discussion is paramount, because these assumptions that are being made, with all eyes looking backward at the glories of the 1990s, are so extreme. I invite you to ask the CFO of a company having a large defined benefit pension fund what adjustment would need to be made to the company's earnings if its pension assumption was lowered to 6.5%. And then, if you want to be mean, ask what the company's assumptions were back in 1975 when both stocks and bonds had a far higher prospective returns than they do now. With 2001 annual reports soon to arrive, it will be interesting to see whether companies have reduced their assumptions about future pension returns, considering how poor returns have been recently and the reprises that probably lie ahead. I think anyone choosing not to lower assumptions, CEOs, auditors, and actuaries all, is risking litigation for misleading investors. And directors who don't question the optimism thus displayed simply won't be doing their job. The tour we've taken through the last century proves that market irrationality of an extreme kind periodically erupts, and compellingly suggests that investors wanting to do well had better learn how to deal with the next outbreak. What's needed is an antidote, and in my opinion, that's quantification. If you quantify, you won't necessarily rise to brilliance, but neither will you sink into craziness. On a macro basis, quantification doesn't have to be complicated at all. Starting almost 80 years ago, let's look at the market value of all publicly traded securities as a percentage of the country's business, that is, a percentage of GNP. The ratio has certain limitations in telling you what you need to know. Still, it is probably the best single measure of where valuations stand at any given moment. Nearly 2 years ago, the ratio rose to an unprecedented level. That should have been a clear warning signal. For me, the message is this. If the percentage relationship falls to the 70% or 80% area, buying stocks is likely to work very well for you. If the ratio approaches 200%, as it did in 1999 and a part of 2000, you are playing with fire. As you can see, the ratio was recently 133%. Even so, that is a good-sized drop from when I was talking about the market in 1999. I ventured then that the American public should expect equity returns over the next decade or two, with dividends included and 2% inflation assumed, of perhaps 7%. That was a gross figure, not counting frictional costs such as commissions and fees. Net, I thought returns might be 6%. Today, stock market hamburgers, so to speak, are cheaper. The country's economy has grown and stocks are lower, which means that investors are getting more for their money. I would expect now to see long-term returns run somewhat higher, in the neighborhood of 7% after costs. Not bad at all. That is, unless you're still deriving your expectations from the 1990s.
The MASH Note Everybody Wants. September 16, 2002. A Sidebar by Jerry Useem. The following sidebar ran in a post-Enron article describing the rush of corporations to make themselves into model institutions.
What are the most coveted words in corporate America today? That's simple. Sincerely, Warren. With companies competing to clean up their act, a letter of praise from super investor Warren Buffett has become the ultimate good housekeeping seal of approval. General Electric got one for announcing it would expense stock options. "For long, GE has brought good things to life," Buffett wrote. "Now GE has brought good things to accounting." Standard & Poor's got one too for its new core earnings measure. "Your move is both courageous and correct," Buffett wrote in his letter, which S&P liked enough to post on its website. "In the future, investors will look back at your action as a milestone event." Other lucky recipients have included Bank One and Amazon. "He's the only person or entity out there that still has an unblemished reputation," says S&P analyst Robert Friedman. Well, a few other voices still command credulity, such as John Bogle, the outspoken founder of Vanguard Group. But how did Bogle know that a speech about corporate accountability went over well? "Buffett gave me a very nice note after reading that speech," he says.
The Oracle of Everything, November 11th, 2002, by Andy Serwer. In the 47 years that Warren Buffett has run Berkshire Hathaway, the company's stock has fallen roughly 40% to 50% at 4 different times. We will identify 3 of those episodes: 1973 to 74, 87 to 88, and 2007 to 2008, and move on to the other perpetrator, the Internet bubble. This cover story picks up Buffett in late 2002, when the bubble had clearly burst, and Berkshire's A stock had climbed back from just over $40,000 in early 2000 to more than $70,000. Meantime, the word abroad about Buffett was that maybe he wasn't a relic after all, as so many market pundits had adamantly asserted him to be in the days when their heads were in the bubble. Andy Serwer, who was then writing copious amounts of copy for Fortune under the name Street Life, and who in 2006 became managing editor of the magazine, happened to get assigned to this Buffett's Back story at a time when Buffett was headed to California with a group of men on a golfing trip. Not that Buffett was himself playing golf. He couldn't because of a torn rotator cuff. But this particular group of men had been playing Pebble Beach, Spyglass, and Cypress Point every year for 2 decades, and Buffett wasn't inclined to give up the sociability of it all. So Andy went to Pebble Beach, too. He hung around with Buffett throughout the day, in a scenic spot when the rooms of neither were available, in Buffett's room, and at night when Buffett and the golfers congregated. Among the others were Charlie Munger, Tom Murphy of Cap Cities ABC, George Gillespie of Cravath, Swaine and Moore, Don Graham of Washington Post, and Sandy Gottsman and my husband, John Loomis, of First Manhattan Company. Andy quickly decided it would not be all bad to do the entirety of his future reporting at Pebble Beach. Unsurprisingly, no other reporting assignment has since taken him there. C.L.
For decades, the name Warren Buffett has conjured up the image of a golden touch investor, a solid, straight-shooting, deep, value-minded soul who, as dozens of biographies and investing primers will tell you, believes in buying companies, not stocks. His effect on the stock market rivals that of Federal Reserve Chairman and U.S. presidents. His investing style is studied and copied by legions of acolytes from Wall Street to small-town America. His missives in Berkshire Hathaway's annual reports are read and cited as if they were the gospel itself. So, it is a little strange, to say the least, to see the man, Warren Buffett, up close in his PJs. It is a sumptuous California morning, and I am sitting with the 70-year-old Buffett in his spacious ground-floor suite at the lodge at Pebble Beach. Outside, the October sun is brilliant. The view of Carmel Bay is glorious. The 18th green frames the scene to the right. A large cypress tree stands to the left. As for the Oracle of Omaha, well, he's kicked back, picking at a room service omelet, lounging around in a white terry-cloth bathrobe and pastel blue pajamas. Fittingly, for such left coast perfection, we are talking about the tech bubble of the century just ended. It was a mass hallucination, Buffett says, by far the biggest in my lifetime. Scary stuff, yet Buffett looks hardly perturbed. There is no self-regret on his face. Maybe that's because he wasn't a party to any of that malarkey, the bubble or its popping. Which brings us to another facet of Buffett, and that's the fact that he not only has been dead on with the vast majority of his investments over time, but has also, in his own calm, self-effacing, almost goofy way, been right about much else. Right on his views about corporate governance, right about stock options and accounting reform, right about the demise of corporate ethics, uncannily right about the stock market. Indeed, he has been right on those fronts for years. What has changed during the recent months of corporate scandal, a soggy economy, and a vicious bear market is that the rest of the world seems to be coming back around to the Buffett worldview. Take that a step further. More and more people seem to be expecting, or at least hoping, that he will step in and save them from their own past mistakes. Because he controls, through his company Berkshire Hathaway, one of the most liquid sources of capital on earth, Buffett has recently been able to step up and buy chunks of American businesses, especially in hard-hit sectors like telecom, utilities, and energy. He's doing what he has always done these many years, buying at the bottom of the market, not the top. As simple as that feat may sound, no one has been able to match it. For us mere mortals, that is reason enough to watch his every move. And that is also why fortune has returned to this subject. When we asked for a little bit of Buffett's precious time, we got instead an extraordinary 48-hour peek into the oracle's mind and a marathon conversation that spanned everything from nuclear bombs to junk bonds to Barry Bonds to Barry Switzer to Elliot Spitzer. Right now, though, we are talking about a time many believed he was wrong. Hard to imagine, but it wasn't long ago that a good number of people on Wall Street and in Silicon Valley thought this fabled investor was irrelevant, washed up. Buffett's take on things seemed out of tune. The rules of the game had changed, but he just didn't get it. Warren Buffett should say, "I'm sorry," fumed Harry Newton, publisher of Technology Investor magazine in early 2000. How did he miss the Silicon wireless, DSL, cable, and biotech revolutions? It is hardly necessary to point out that this was during the age of irrational exuberance, when the NASDAQ was flying and Berkshire's stock was flopping. Buffett's fixation on value and values, too. His focus on the long term, not the short term, that was old hat. What was wrong with the stock option culture, financial engineering, and situational ethics, to use one of Buffett's own phrases? The stuff worked, didn't it? Did it ever bother you, I asked him, that people said you were a has-been, that you were through? Never, he says in his folksy, gravelly voice. Nothing bothers me like that. You can't do well in investments unless you think independently. And the truth is, you're neither right nor wrong because people agree with you. You're right because your facts and your reasoning are right. In the end, that's all that counts. And there wasn't any question about the facts or reasoning being correct. My time with Buffett begins back in Omaha on a Sunday and continues on a NetJet's Gulfstream out to Monterey, where his sister Bertie picks us up and drives us over to Pebble Beach. At Pebble, he spends most of his time holed up in his room instead of out on the links with his usual biennial eightsome due to a torn left rotator cuff. The injury is not a huge problem for Buffett. For one thing, it isn't that painful, and for another, he's not that crazy about golf. I've got the highest handicap of any member of Augusta, he brags. The shoulder injury affords him much more time to work, reading, writing, and phoning, which is what he loves anyway. There is only one logical thing to do when you have the world's greatest financial mind cornered in his room with an injured wing, and that is to ask him about the stock market. The problem is, Buffett doesn't like to talk about stock prices per se, though he did so in a November 1999 Fortune article in which he strongly implied that the market was too high. Historians might do well to observe the parallels between that article and the warning Bernard Baruch famously gave in the 1920s. Fortune ran a follow-up piece about his views last year, in which Buffett said that many corporations would be forced to lower their inflated expectations for the returns on their pension funds. He is proving to be right. And he pointed out that the value of all U.S. stocks was then a full third higher than the U.S. gross national product, well above the ratio's peak in 1929. The message was clear. Stocks could continue falling. Right again. So what does Buffett think about the market now? Not much more than, the bubble has popped, but stocks are still not cheap. There is no question, however, that now is a better time to buy stocks than it was in 1999, he confirms. Buffett's investing precepts remain unflinching as well. Investors need to avoid the negatives of buying fads, crummy companies, and timing the market, he says. Buying an index fund over a long period of time makes the most sense. What about buying Berkshire Hathaway stock? I don't know about that. It's kind of high right now, he says, though I'd rather own it than the S&P 500 when we were talking about buying back our stock. In early 2000, when it dipped into the low 40,000s, now that was a real sign. He lets out one of his patented guffawing chuckles, kicking his feet up on the glass coffee table. His stock has risen to more than $70,000 since then. Investors take note. Next time Buffett talks about a buyback, buy. The center of Buffett's life isn't the broader stock market, but his company, Berkshire Hathaway. And understanding how it works is key to understanding Buffett's thinking. For that, I first check in with Buffett's partner, Charlie Munger, who is a member of the golfing party, along with Tom Murphy, former head of Cap Cities, and Don Graham, CEO of the Washington Post Company. It's so extreme the way Berkshire is operated that I think a lot of people don't fully understand it, Munger tells me. We have less overhead and faster decision-making than any other place of our size in the world. It is truly difficult to overstate just how different Berkshire Hathaway is from other companies. For the record, it is a conglomerate with sizable operations in insurance. It holds large stakes in giant American companies such as Coke, Gillette, and American Express. Berkshire also controls a significant utility and gas pipeline business and owns an amazing cornucopia of mundane operations, things like furniture retailers, jewelry shops, and shoe factories. The company has grown with no master plan or strategic roadmap, and yet the physical makeup of Berkshire provides investors with a pretty good window into the mind of Buffett. For instance, for years, Berkshire was best known as an insurance company with those big stock holdings. But a couple of things have happened. First, Buffett has largely stopped buying huge blocks of stock of companies. His purchases of the Washington Post, for instance, date back to the 1970s. Why has he stopped? Simple. Stock prices have been too high to his taste for years. I bought my first stock 60 years ago, Buffett says, and of those 60 years, probably 50 have been attractive to buy common stocks, and probably 10 years I've not been able to find anything. Most of those 10, notably, have been recent ones. Instead, Buffett has shifted to buying entire companies, often of the old economy and private variety, many of which were selling cheap during the tech boom. Some of the acquisitions have also been insurance operations, but others have been part of the aforementioned cornucopia: Benjamin Moore Paint, Shaw Carpets, a utility called Mid-American Energy, and most recently, the Pampered Chef, a privately held direct marketer of kitchenware. The result is that Berkshire's famous stock holdings have become somewhat de-accentuated. Recently, that portfolio was worth some $26 billion. And while the insurance segment has grown, the part of the conglomerate made up of manufacturing and service companies is now much larger than before. Insurance still accounts for about half of Berkshire's revenues. On a relative basis, though, it's falling. Through the acquisition of these various businesses, some 20 over the past 5 years, the number of employees working at Berkshire Hathaway companies has grown at a healthy clip. Today, more than 145,000 folks around the country can stand up and say, "I work for Warren Buffett." That would make Berkshire about the 25th largest private employer in the U.S. That's more than the headcount at PepsiCo or Marriott. How does Warren Buffett find new companies to add to the fold? Typically, they come to him. These days, Buffett says sellers appear in a couple of varieties. We now get two kinds of calls. We get contacted where people only want us, meaning they want their businesses to become Berkshire companies. And now we get calls where people only want cash, and fast. We're the buyer who can come up with cash over a weekend. Fitting into the former category, sellers who approach him because they want to be Berkshire companies, is Buffett's latest acquisition, the Pampered Chef. If you are a male or hate to cook, you may not have heard of this company, but if you don't fit into that description, it's very likely you have. Pampered Chef consultants sell cookware and utensils at parties in their homes. It's a sort of upscale Tupperware model. 22 years ago, founder Doris Christopher borrowed $3,000 from a life insurance policy to start the business so that she could work flexible hours and spend time with her young daughters. Today, her company has more than $700 million in sales, which comes from some 70,000 direct marketers who host more than 19,000 in-house demonstrations a week. As for profits, we can say only that Pampered is plenty profitable with mouth-watering margins. Even though her business was flourishing, Christopher knew she needed a plan in the event she A. dropped dead, or B. decided upon aging to step back from the business. She had heard about Warren Buffett years ago, and in the back of my mind I thought, wouldn't it be great to be part of his company? But we dismissed it at the time. The name Berkshire came up again, though, and in mid-September, Christopher's bankers at Goldman Sachs contacted Buffett, who immediately liked what he saw. Within a matter of days, Christopher and her president, Sheila O'Connell Cooper, were winging from Chicago to Omaha for a sit-down with the Oracle. I could tell that in a few minutes, and Doris could tell in a few minutes, that we were made for each other, says Buffett, who made her an offer on the spot. He positively gushes when he talks about the Pampered Chef. I didn't know the name 2 months ago, but I could tell that Doris and Sheila love running the business. All I have to do is not get in their way. It's a better story than I am. Well, not quite. For Buffett, though, this story has all the right plot lines. Pampered is a proprietary, high-margin, growing franchise, and one that's already big to start with. The fact is, size matters to Buffett. That's because Berkshire is actually growing pretty fast and is a heck of a lot bigger than it was 10 years ago. Annual revenues have grown from $3 billion to nearly $38 billion over that time, with most of that growth having come from acquisitions like Gen Re and Shaw. They said that Berkshire wasn't scalable, scoffed the 79-year-old Munger. Well, they were wrong. While Berkshire clearly has grown and will grow still, Buffett's acquisition diet is limited mostly to big fish. With a few exceptions, a company must now have some $50 million in pre-tax profits for Buffett to even consider buying it. That is why he tells me that he may broaden his search for great companies to other countries. The reason is simple. An acquisition needs to be plenty large to have any impact on Berkshire's bottom line, a line, we should point out, that tends to be somewhat erratic. That's partly because in any given year, Berkshire may be taking huge capital gains, a factor that makes following the company's net earnings on a short-term basis a rather fruitless exercise. Example: because of insurance losses from September 11th, last year's earnings plunged 76% to $795 million, matching the company's profit tally in 1995. But in 2000, earnings more than doubled to $3.3 billion. If those kinds of gyrations bother you, look elsewhere. Buffett is interested only in investors who have a long-term horizon. One evening in Pebble Beach, Buffett invites me to join him and his crew over at his sister Bertie's cozy house in nearby Carmel to have dinner. It's a casual get-together, a few drinks and a buffet supper, with Bertie's beloved San Francisco Giants playing on a big screen TV. The talk here is much the same as it is with any group of guys. A lot of sports, which Buffett can do with the best of them, though a pained look flashes across his face when I remind him that his Nebraska Cornhuskers are out of the top 25 for the first time in decades. At one point during the evening, Buffett, his ever-present cherry Coke in hand, leans over and says to me, "For me, Mid-American started here, in this house." He is referring to what is likely to be the next cornerstone of Berkshire, Mid-American Energy Holdings Company, an electric power and gas pipeline utility based in Des Moines. "No, I didn't know," I say to him. "Could he explain?" Almost exactly 3 years ago, it seems, Bertie was having another party for her brother and a different group of pals. One of the guests was Walter Scott, chairman of the Telco Level 3, and also former CEO of Peter Kiewitt's Sons, the large Omaha construction firm. Walter pulled me aside and asked if he could speak with me for a minute in another room, Buffett says. He talked about this public utility company called Mid-American that he was into, which wasn't going anywhere. They had tried to explain the business to Wall Street, but the analysts didn't like it because they were looking for companies like AES or Calpine that had what was called deal velocity, meaning they were doing a lot of deals. Walter said they were thinking of taking Mid-American private and asked if I would be interested. I said yes. You have to remember that at that point, many utility stocks were just as hot and overhyped as internet incubators or B2B stocks. Calpine and AES, for instance, traded at $56 and $70 respectively at their peaks. Today, each sells for around $2. The origin of the utility bubble goes back to the Energy Policy Act of 1992, which lured companies into the seemingly sexy, unregulated end of the business. Unregulated utilities produce power on a speculative basis without guaranteed customers, but can sell that power at market rates. A regulated utility has guaranteed customers and regulated rates. As more and more money streamed into unregulated businesses, David Sokol, CEO of Mid-American, saw what he thought was a tremendous opportunity. Regulated assets were being overlooked. By the mid-1990s, Mid-American owned regulated utilities in California, Iowa, and Britain. But while Enron and its ilk sported PEs of 30 to 50, Mid-American was selling for 6 to 8 times earnings. We couldn't figure out what the other companies were doing, says Sokol. They kept on building power plants and adding capacity. I guess because they thought demand would go up forever. And their trading businesses were also a mystery. The profits seemed impossible to us. Meanwhile, Mid-American's stock was languishing. So Sokol decided in October 1999 to abandon the public markets and sell out to Buffett. Berkshire effectively ended up buying 80% of the company, for $35.05 a share, a cost of $3.3 billion. Buffett's timing wasn't impeccable, but it was close. By the summer of 2001, the unregulated energy business, headlined by Enron, began its spectacular collapse. By earlier this year, the situation had become dire for many of these players, including Williams Companies, which suddenly found itself in need of a large amount of cash. What Williams had to offer was the Kern River pipeline, which transports 850 million cubic feet of gas, CFG, per day over 935 miles from the Rocky Mountains to Las Vegas and California. The price tag? $950 million, which was hundreds of millions less than the market would have valued it 2 years earlier. Even sweeter for Buffett was Mid-American's purchase this past July of the 4.3 billion CFG per day, 16,600-mile northern natural gas pipeline. With obvious pleasure, Buffett leans back on the couch and tells the story as though relating the hooking of a giant tuna. Northern Natural used to be a prominent Omaha company. In 1986, a guy came up from Houston with a smaller company and said, "Let's merge, and I'll come to Omaha." Most people in Omaha feel they got double-crossed because within 6 or 8 months, the company had gone back to Houston. Of course, the guy from Houston was Ken Lay, and the company became Enron. When Enron got in trouble a year ago, they made this deal with Dynegy, where Dynegy puts in $1.5 billion, and they, more or less, got Northern Natural as collateral. So Dynegy takes over the pipeline for its $1.5 billion, and then Dynegy gets in trouble. So they call us on a Friday and say, "We need a deal by next week that we're sure will close for cash." So we sent a team down, and we sign a contract by the following Monday morning. Here's how the math works. Enron effectively sells the pipeline to Dynegy in January for $1.5 billion. Dynegy sells it to Buffett's Mid-American 6 months later for, get this, $928 million. Nice. Mid-American now transports about 10% of the nation's gas. It may be that we'll never make another deal, but it could be a very big company, Buffett says. Mid-American is useful because it is big scale, as in potentially very big scale. Berkshire could ultimately end up investing some $10 billion to $15 billion or more in this company. If that sounds like a mammoth sum, consider that Berkshire now generates some $5 billion in cash flow annually from its investments, insurance, and operating companies. "We've got $100 million a week that I have to figure out what to do with," he says. "It's a happy problem, but it's a problem, especially if I do something dumb with it. And that's easy to do." After dining at Bertie's house, Don Graham, Buffett, and I pile into Graham's rented Ford Taurus, and we begin to try to find our way back to Pebble Beach. Easier said than done. It's pitch black, and I'm in the back seat with a map trying to navigate. "I'm glad Don's driving," says Buffett as we wend our way through Pebble Beach's myriad dark ocean roads. "I don't like driving at night. Don't see that well at night." Yes, the man is mortal, even getting on in years. He has $100 million a week to figure out how to invest, but he has trouble driving at night. Earlier in our visit, Buffett had me in stitches with off-color palindromes. Sorry, but this is a family magazine. Can this be the same public citizen who pens op-ed pieces in the New York Times on the slipperiness of stock option accounting? Another seeming contradiction. The man whom shareholders count on to defy gravity time and again is telling those same shareholders that gravity always wins. Partly because of Berkshire's ever-increasing size, Buffett had been warning his Berkshire flock for years that the future performance of their company's stock couldn't match the spectacular returns of the past. The future became now in 1999, when Berkshire posted its worst relative return ever. The metric Buffett likes to use to gauge his performance is comparing the annual change in the per-share book value of Berkshire with the total return of the S&P 500. In 1999, Berkshire's book value nudged up 0.5%, while the S&P soared 21%, ergo relative underperformance of 20.5 percentage points. Since then, the company has reverted to its outperforming ways, although 2001 produced another Berkshire anomaly. It was the first year ever that Berkshire's book value declined. The 6.2% drop was due in large part to the fact that Berkshire's insurance operations lost more than $2 billion in the September 11th terror attack on the World Trade Center. That's the bad news. The good news is that because of September 11th, pricing in the insurance business has firmed up, meaning the cost of coverage has risen, which is potentially good for the bottom line of Berkshire's insurance operations. Recently, there have been rumors in the market that Berkshire will buy Employers Re, GE's reinsurance business. With the S&P down some 20% year to date, and Berkshire's operations mostly purring along as of June 30th, Berkshire's book value was up 7.6%. Another year of relative outperformance seems likely. As for Berkshire's stock, well, it has certainly held its own recently. On March 10th, 2000, the Nasdaq peaked intraday at 5,132. That same day, Berkshire hit a multi-year low of $40,800. Recently, the Nasdaq traded for 1,270, down 75%, while Berkshire traded for $74,000, up 81%. And, of course, BRK has beaten up on the S&P 500 over the past 1, 2, 5, 10, 15 years, you name the period. The week after my visit with Buffett, I spent time speaking with some of the CEOs of Berkshire's companies. They number close to 40 now, and Buffett happily points out that in Berkshire's 38 years, not a single one has elected to leave the fold to go work someplace else. This, in part, has to reflect an underrated aspect of Buffett's managerial prowess, his people skills. He is the best judge of human talent there is, says Rich Santulli, who heads up NetJets, a company that leases fractional shares of aircraft, and people want to work for him. Judging by the success of Buffett's companies, Santulli has a point. It is a remarkable group of CEOs, impressive not only in their ability but also in their love of work. There are several octogenarians in the group, including Al Yulschi, 85, CEO of Flight Safety, and Frank Rooney, 80, at shoe company H.H. Brown. Joe Brandon, on the other hand, at 43, is one of the youngest Berkshire CEOs. Named head of General Re a year ago, Brandon is also sitting in Berkshire's hottest of hot seats. Even before September 11th, Gen Re, which Berkshire bought for $22 billion of stock in 1998, has had troubles. Its underwriting has been undisciplined, its returns subpar. Buffett has gone so far as to apologize to shareholders for the company's performance. "So, Joe, how's the old man been treating you?" "He has been supportive in every way," insists Brandon. "Yes, you are working for one of the smartest guys in the world, so you better be prepared. But people just don't understand what a great manager he is." Brandon's point is dead on and again unrecognized. In part, this is because of Buffett himself. "I just buy the businesses and get out of the way," Buffett says over and over. Well, not exactly. Dig deeper and you discover that Buffett is engaged with each of his companies to a varying degree, depending on his interest and whether the particular business warrants his attention. For instance, Brandon says that he speaks to Buffett up to a couple of times a week, But Buffett talks to Agent Jane, head of Berkshire's other reinsurance operations, every day. That is not because Jane is doing a bad job. On the contrary, Buffett will tell you that Jane is one of his ablest executives. It's just that insuring jumbo risks, the Olympic Games, for instance, has major financial implications for Berkshire. It's also true that pricing insurance for huge pieces of business like this happens to be a discipline that Buffett loves dearly. As for some of his other companies, here's what Buffett says. Geico sends me figures every Tuesday. Internet hits, business closed on the internet, telephone inquiries closed. I love all that. Shaw sends me the daily sales figures by fax. And around Christmas, the month before, I like to get daily sales figures from our jewelry stores and from our candy business. Even with the staggering pile of numbers that Buffett sifts through, and even though he works like the Dickens, Buffett is no type A boss. Yes, I need roller skates to keep up with him, says Debbie Bosanek, his secretary of 9 years, but I've never seen him get mad. I don't think he'd like to be lied to, though. If you make a mistake and tell him about it, that's okay, but you wouldn't want to cover it up. Adds Tom Murphy, the founder of Cap Cities. He wakes up every morning and goes to work to have fun. It's not work. He's only with people he likes, so he isn't stressed out. Buffett is probably one of the few CEOs in America who spends much of the day reading. Buffett doesn't email, and there are no time-squandering meetings at Berkshire's headquarters. Warren gets blinding headaches if he sits in a room full of people around a table, and a lot of people are saying dumb things on and on, says his partner Charlie Munger. Buffett and Munger, who have been together 40-plus years, used to talk all the time, but less so now. By now, Warren knows pretty much everything I think. Once in a while, I'll know something that's useful to him. The bottom line is that Buffett's ability to allocate his time and brainpower among all these various businesses is as impressive as his vaunted ability to allocate capital. Most super smart people tend to make things more complicated, says Don Graham of the Washington Post Company, where Buffett sits on the board. He has an extraordinary ability to state things clearly and make them simple. But wait a minute, stop the music. There must be some people out there who don't like the guy, right? Well, sure. A long list, actually. Buffett has lobbied hard for expensing stock options, so the Silicon Valley crowd aren't big fans. Some also point out that for all of Buffett's grousing about corporate governance, Berkshire has a paucity of outside directors. Buffett gives money to Planned Parenthood, so he's not a favorite of the right-to-lifers. Many investment bankers don't like him. They can't snow him. And he's no friend to the Wall Street analysts. He won't give them any guidance. And as someone, the only one, who routinely and consistently beats the market, he must drive disciples of the efficient market theory crazy. Harvey Pitt may be a bit peeved at him, since Buffett has been less than supportive of his tenure. And then there's the matter of the 16,712 votes cast earlier this year against Buffett for director of Berkshire. For the record, he received 1,140,816 votes in his favor. Overall, though, Buffett's stature has never been loftier, and he is using that prominence to weigh in on significant economic and political issues. In addition to the stock option fight, for instance, he has been vocal in his support for a federal terrorism insurance fund similar to the FDIC. Nuclear attack could bankrupt the insurance industry, he says. The federal government would have to bail out the country anyway. Why not create this fund before something happens rather than after the fact? If talking about nuclear destruction on the 6th green at Pebble Beach is incongruous, doesn't seem to bother Buffett. A nuclear bomb, he says, is the ultimate depressing thing. It will happen. It's inevitable. I don't see any way that it won't happen. But we can reduce the probabilities. If there's a 10% probability of something happening in a given year, and I don't know if that's the right probability, nobody knows, then the chances that it will happen in 50 years are 99.5%. If you get it down to 3%, there is about a 78% chance. If you get it down to 1% per year, there's about a 40% chance. So reducing the probabilities per annum of anything happening obviously increases the chance significantly that your kids will get through their lifetimes without this happening. You can't get rid of the knowledge. You can try to control the materials. You'll never get rid of the intent. It is the ultimate problem of mankind. Late in the afternoon, as the setting sun gilds the back nine outside Buffett's window, I ask him the inevitable question of succession. Or, put it less delicately, what happens when he dies? Buffett has been through this 1,000,000 times, and he has 1,000,000 lines. I hope the stock doesn't go up too much, being one of his favorites. But this time he turns serious. Look, this company is going to outlast me for years to come, he says. These businesses are going to run for 50 years. We have a great team of managers. They know how this company works. It's pretty simple, really. Really? Well, this is one time I beg to differ. It's not so much the operational businesses that are a problem. Presumably, those managements would stay and continue their money-coining ways. And never mind that the insurance businesses are pretty darn complicated. It's the capital allocation skills of Buffett's that would be so hard to replicate. Even Buffett's friends privately wonder about filling those shoes. As for Buffett's family, they are connected to Berkshire today and Berkshire tomorrow in various ways. Buffett's wife, Susie, is a board member of Berkshire and lives in San Francisco, but frequently travels with Buffett. For more than 20 years, Buffett has lived in Omaha with a woman named Astrid Manx. It's a unique arrangement, but one that seems to suit all parties. Susie Buffett is also CEO of the Buffett Foundation. Buffett's Berkshire stock, now valued at $34 billion, will go to Susie when he dies, assuming he dies first. And then, when she dies, virtually all of her assets will go to the Buffett Foundation, which will then distribute the assets. Buffett's elder son, Howard, until recently an executive at an agricultural equipment company, is also a director of Berkshire, and upon his father's death would become non-executive chairman of the company. Buffett's two other children, Susie, a homemaker, and Peter, a musician, are trustees of the foundation. After Buffett is gone, the foundation will become one of the largest philanthropic organizations in the world, though one intriguing point is that Buffett hasn't designated where the money goes. The trustees of the foundation will have full discretion over that disbursement. For now, that may be the only part of Buffett's glorious legacy that isn't yet crystal clear.
A letter from Fortune's Letters column, February 17, 2003. The bold type in Playing the Dividend Market, Investor's Guide 2003, December 9, saying, "Not just any dividend payer is a good investment. Many of the most tempting are quite risky," rang a very loud bell. In January 1956, I bought some shares in a textile company because it appeared to be paying an 8.5% dividend. But it turned out that dividends hadn't yet caught up with a decrease in net income. I sold the stock a year later for a 64% loss. That was the biggest mistake of my life. The company was Berkshire Hathaway, which Warren Buffett took over a few years after that. Please don't tell me what the stock I sold is now worth. Robert H. Paschal, Bishop, California. Avoiding a Mega Catastrophe, March 17, 2003. An excerpt from Buffett's letter to shareholders in the 2002 Berkshire Hathaway Annual Report. Quote, "Financial weapons of mass destruction." That Buffett blast at derivatives, a phrase soon to become famous around the world, made its inaugural public appearance in Fortune. as we publish this excerpt from Berkshire's 2002 annual report a short time before the report itself came out. But then, in the mid-2000s, just in time for the financial crisis, Buffett bought a range of derivatives contracts for Berkshire, many of them appearing to take large amounts of risk with its money. The situation is further complicated by the fact that Charlie Munger, were he boss of the financial world, would banish all derivatives, whose social value he thinks to be far less than zero. Shall we say that all of this left many Berkshire shareholders deeply confused, and some angry, as proved by a few rancorous questions at annual meetings? A beginning explanation for this puzzle is that Buffett believes derivatives, just like other securities, can be safely bought if the buyer truly understands both risk and pricing. Buffett, displaying a confidence built on experience, feels himself able to handle both challenges. He has in fact gone gleefully through life trying to spot mispricing wherever it occurs, in stocks and businesses, of course, but also in bonds, commodities, currencies, and even television stations. No one can say that his detective work has been unsuccessful. Its controversial extension in recent years to derivatives may therefore be easy to explain as just one more expedition into a land of mispricing, one more lovely garden to tend. And then, of course, if you're Buffett and you see something terrific, you have to act. I do not believe that Buffett is capable of ignoring mispriced securities. To date, the derivatives contracts that Buffett controversially entered into during the mid-2000s have increased the volatility of Berkshire's earnings, a fact to which Buffett assigns zero importance, but have otherwise had only beneficial effects. Buffett, in fact, has referred again and again in his annual letter to A, the billions of dollars of float that have been generated by Berkshire's derivatives, and B, his expectation as well that satisfying amounts of underwriting profit will be earned on them. Since some of the contracts on the books extend to 2028, 2 years before the centennial of his birth, he wishes also to be around, at the end, to see how it all worked out. C.L.
Charlie Munger and I are of one mind in how we feel about derivatives and the trading activities that go with them. We view them as time bombs, both for the parties that deal in them and the economic system. Having delivered that thought, which I'll get back to, let me retreat to explaining derivatives, though the explanation must be general because the word covers an extraordinarily wide range of financial contracts. Essentially, these instruments call for money to change hands at some future date, with the amount to be determined by one or more reference items such as interest rates, stock prices, or currency values. If, for example, you're either long or short an S&P futures contract, you are a party to a very simple derivatives transaction, with your gain or loss derived from movements in the index. Derivatives contracts are of varying duration, running sometimes to 20 or more years, and their value is often tied to several variables. Unless derivatives contracts are collateralized or guaranteed, their ultimate value also depends on the creditworthiness of the counterparties to them. In the meantime, though, before a contract is settled, the counterparties record profits and losses, often huge in amount, in their current earnings statements without so much as a penny changing hands. The range of derivatives contracts is limited only by the imagination of man, or sometimes, so it seems, madmen. At Enron, for example, newsprint and broadband derivatives, due to be settled many years in the future, were put on the books. Or say you wanted to write a contract speculating on the number of twins to be born in Nebraska in 2020. No problem. At a price, you will easily find an obliging counterparty. When we purchased Gen Re, it came with General Re Securities, a derivatives dealer that Charlie and I didn't want, judging it to be dangerous. We failed in our attempts to sell the operation, however, and are now terminating it. But closing down a derivatives business is easier said than done. It will be a great many years before we are totally out of this operation, though we reduce our exposure daily. In fact, the reinsurance and derivatives businesses are similar. Like hell, both are easy to enter and almost impossible to exit. In either industry, once you write a contract, which may require a large payment decades later, you are usually stuck with it. True, there are methods by which the risk can be laid off with others, but most strategies of that kind leave you with residual liability. Another commonality of reinsurance and derivatives is that both generate reported earnings that are often wildly overstated. That's true because today's earnings are in a significant way based on estimates whose inaccuracy may not be exposed for many years. Errors will usually be honest, reflecting only the human tendency to take an optimistic view of one's commitments. But the parties to derivatives also have enormous incentives to cheat in accounting for them. Those who trade derivatives are usually paid in whole or part on earnings calculated by mark-to-market accounting. But often there is no real market. Think about our contract involving twins, and mark-to-model is utilized. This substitution can bring on large-scale mischief. As a general rule, contracts involving multiple reference items and distant settlement dates increase the opportunities for counterparties to use fanciful assumptions. In the twin scenario, for example, the two parties to the contract might well use differing models allowing both to show substantial profits for many years. In extreme cases, mark-to-model degenerates into what I would call mark-to-myth. Of course, both internal and outside auditors review the numbers, but that's no easy job. For example, General Re Securities at year-end, after 10 months of winding down its operation, had 14,384 contracts outstanding, involving 672 counterparties around the world. Each contract had a plus or minus value derived from one or more reference items, including some of mind-boggling complexity. Valuing a portfolio like that, expert auditors could easily and honestly have widely varying opinions. The valuation problem is far from academic. In recent years, some huge-scale frauds and near-frauds have been facilitated by derivatives trades. In the energy and electric utility sectors, for example, companies used derivatives and trading activities to report great earnings until the roof fell in when they actually tried to convert the derivatives-related receivables on their balance sheets into cash. Mark-to-market then turned out to be truly mark-to-myth. I can assure you that the marking errors in the derivatives business have not been symmetrical. Almost invariably, they have favored either the trader who was eyeing a multi-million-dollar bonus or the CEO who wanted to report impressive earnings, or both. The bonuses were paid and the CEO profited from his options. Only much later did shareholders learn that the reported earnings were a sham. Another problem about derivatives is that they can exacerbate trouble that a corporation has run into for completely unrelated reasons. This pile-on effect occurs because many derivatives contracts require that a company suffering a credit downgrade immediately supply collateral to counterparties. Imagine, then, that a company is downgraded because of general adversity and that its derivatives instantly kick in with their requirements, imposing an unexpected and enormous demand for cash collateral on the company. The need to meet this demand can throw the company into a liquidity crisis that may, in some cases, trigger still more downgrades. It all becomes a spiral that can lead to a corporate meltdown. Derivatives can also create a daisy chain risk that is akin to the risk run by insurers or reinsurers that lay off much of their business with others. In both cases, huge receivables from many counterparties tend to build up over time. At Gen Re Securities, we still have $6.5 billion of receivables, though we've been in liquidation mode for nearly a year. A participant may see himself as prudent, believing his large credit exposures to be diversified and therefore not dangerous. Under certain circumstances, though, an exogenous event that causes the receivable from Company A to go bad will also affect those from companies B through Z. History teaches us that a crisis often causes problems to correlate in a manner undreamed of in more tranquil times. In banking, the recognition of a linkage problem was one of the reasons for the formation of the Federal Reserve System. Before the Fed was established, the failure of weak banks would sometimes put sudden and unanticipated liquidity demands on previously strong banks, causing them to fall in turn. The Fed now insulates the strong from the troubles of the weak. But there is no central bank assigned to the job of preventing the dominoes toppling in insurance or derivatives. In these industries, firms that are fundamentally solid can become troubled simply because of the travails of other firms further down the chain. When a chain reaction threat exists within an industry, it pays to minimize links of any kind. That's how we conduct our reinsurance business, and it's one reason we are exiting derivatives. Many people argue that derivatives reduce systematic problems, and that participants who can't bear certain risks are able to transfer them to stronger hands. These people believe that derivatives act to stabilize the economy, facilitate trade, and eliminate bumps for individual participants. And on a micro level, what they say is often true. Indeed, at Berkshire, I sometimes engage in large-scale derivatives transactions in order to facilitate certain investment strategies. Charlie and I believe, however, that the macro picture is dangerous and getting more so. Large amounts of risk, particularly credit risk, have become concentrated in the hands of relatively few derivatives dealers, who in addition trade extensively with one another. The troubles of one could quickly infect the others. On top of that, these dealers are owed huge amounts by non-dealer counterparties. Some of these counterparties, as I've mentioned, are linked in ways that could cause them to contemporaneously run into a problem because of a single event, such as the implosion of the telecom industry or the precipitous decline in the value of merchant power projects. Linkage, when it suddenly surfaces, can trigger serious systemic problems. Indeed, in 1998, the leveraged and derivatives-heavy activities of a single hedge fund, long-term capital management, caused the Federal Reserve anxieties so severe that it hastily orchestrated a rescue effort. In later congressional testimony, Fed officials acknowledged that, had they not intervened, the outstanding trades of LTCM, a firm unknown to the general public and employing only a few hundred people, could well have posed a serious threat to the stability of American markets. In other words, the Fed acted because its lenders were fearful of what might have happened to other financial institutions had the LTCM domino toppled. And this affair, though it paralyzed many parts of the fixed income market for weeks, was far from a worst-case scenario. One of the derivatives instruments that LTCM used was total return swaps, contracts that facilitate 100% leverage in various markets, including stocks. For example, Party A to a contract, usually a bank, puts up all of the money for the purchase of a stock, while Party B, without putting up any capital, agrees that at a future date it will receive any gain or pay any loss that the bank realizes. Total return swaps of this type make a joke of margin requirements. Beyond that, other types of derivatives severely curtail the ability of regulators to curb leverage and generally get their arms around the risk profiles of banks, insurers, and other financial institutions. Similarly, even experienced investors and analysts encounter major problems in analyzing the financial condition of firms that are heavily involved with derivatives contracts. When Charlie and I finished reading the long footnotes detailing the derivatives activities of major banks, the only thing we understand is that we don't understand how much risk the institution is running. The derivatives genie is now well out of the bottle, and these instruments will almost certainly multiply in variety and number until some event makes their toxicity clear. Knowledge of how dangerous they are has already permeated the electricity and gas businesses, in which the eruption of major troubles caused the use of derivatives to diminish dramatically. Elsewhere, however, the derivatives business continues to expand unchecked. Central banks and governments have so far found no effective way to control or even monitor the risks posed by these contracts. Charlie and I believe Berkshire will be a fortress of financial strength for the sake of our owners, creditors, policyholders, and employees. We try to be alert to any sort of mega catastrophe risk, and that posture may make us unduly apprehensive about the burgeoning quantities of long-term derivatives contracts and the massive amount of uncollateralized receivables that are growing alongside. In our view, however, derivatives are financial weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal.
Where We're Putting Our Money Now, March 17, 2003. A second excerpt from Buffett's letter to shareholders in the 2002 annual report.
We continue to do little in equities. Charlie and I are increasingly comfortable with our holdings in Berkshire's major investees because most of them have increased their earnings while their valuations have decreased. But we are not inclined to add to them. Though these enterprises have good prospects, we don't yet believe their shares are undervalued. In our view, the same conclusion fits stocks generally. Despite 3 years of falling prices, which have significantly improved the attractiveness of common stocks, we still find very few that even mildly interest us. That dismal fact is testimony to the insanity of valuations reached during the Great Bubble. Unfortunately, the hangover may prove to be proportional to the binge. The aversion to equities that Charlie and I exhibit today is far from congenital. We love owning common stocks if they can be purchased at attractive prices. In my 61 years of investing, 50 or so years have offered that kind of opportunity. There will be years like that again, unless, however, we see a very high probability of at least 10% pre-tax returns, which translate to 6% to 7% after corporate tax. We will sit on the sidelines. With short-term money returning less than 1% after tax, sitting it out is no fun. But occasionally, successful investing requires inactivity. Last year we were, however, able to make sensible investments in a few junk bonds and loans. Overall, our commitments in this sector sextupled, reaching $8.3 billion by year-end. Investing in junk bonds and investing in stocks are alike in certain ways. Both activities require us to make a price-value calculation and also to scan hundreds of securities to find the very few that have attractive reward-to-risk ratios. But there are important differences between the two disciplines as well. In stocks, we expect every commitment to work out well because we concentrate on conservatively financed businesses with strong competitive strengths, run by able and honest people. If we buy into these companies at sensible prices, losses should be rare. Indeed, during the 38 years we have run the company's affairs, gains from the equities we manage at Berkshire, that is, excluding those managed at General Re Cologne and Geico, have exceeded losses by a ratio of about 100 to 1. Purchasing junk bonds, we are dealing with enterprises that are far more marginal. These businesses are usually overloaded with debt and often operate in industries characterized by low returns on capital. Additionally, the quality of management is sometimes questionable. Management may even have interests that are directly counter to those of debt holders. Therefore, we expect that we will have occasional large losses in junk issues. So far, however, we have done reasonably well in this field.
The Sage Goes to Asia, May 26, 2003, by Clay Chandler.
Remember that Warren Buffett line about how, if he taught business school, he'd ask every student to compute the value of an internet company and then flunk anyone who answered? He could say the same about Chinese stocks. The People's Republic may boast the world's fastest-growing economy, but the finances of its publicly traded companies are as murky as the Yangtze. So why is the Sage of Omaha boosting his stake in Beijing's biggest state oil firm, PetroChina? In April, Buffett's Berkshire Hathaway socked $50 million into PetroChina, increasing its stake to more than 13% of the company's publicly traded equities. Citigroup's Thomas Hibelt said the Buffett effect drove the stock up 12% in a week. The purchase raises Buffett's total investment in the company to merely $500 million, making him the second largest outside investor after Britain's BP. It's tough to square PetroChina with the buy what you know mantra that has helped make Buffett the world's second richest man. This is a guy who for decades has mainly stuck to businesses in his own backyard. Investors hoping for an explanation at Berkshire Hathaway's annual meeting in May didn't find one. "We think we understand the oil business in China reasonably well," Buffett said. "We don't make any great judgments about China." Countless investors have been burned over the years betting against Buffett. Still, some China analysts question the move. "There must be some other reason for it," speculates CSFB's Peter Best. Viewed from a computer screen on the other side of the earth, PetroChina, which produces 2/3 of China's oil and natural gas, may look like a winner. China guzzles more than 5 million barrels of oil a day, and that thirst will surely grow. Car sales surged nearly 60% last year, and PetroChina, which trades at about 7 times earnings, looks like a steal compared with ExxonMobil's PE of 15. But there are reasons to worry that Buffett's PetroChina claim will come up dry. The company's 3 main oil fields have been thoroughly plumbed. Management has kept production stable, but observers say that has come with unsustainable outlays on exploration. Others question PetroChina's bloated payroll of 400,000 workers. Cost concerns are a key reason some investors favor CNOOC, the China National Offshore Oil Corp, as the smarter China oil play. Investors give CNOOC higher marks for corporate governance, and its annual revenue has grown by 13% over the past 3 years versus 4% for PetroChina. Then again, PTR has Buffett.
Editor's note: Berkshire sold its PetroChina stock in 2007, and here is what Buffett said in that year's annual report about the holding. Quote, "In 2002 and 2003, Berkshire bought 1.3% of PetroChina for $488 million, a price that valued the entire business at about $37 billion. Charlie and I felt that the company was worth about $100 billion. By 2007, 2 factors had materially increased its value. The price of oil had climbed significantly, and PetroChina's management had done a great job in building oil and gas reserves. In the second half of last year, the market value of the company rose to $275 billion, about what we thought it was worth compared to other giant oil companies. So we sold our holdings for $4 billion. The price of PetroChina stock fell off a cliff at the very end of 2007 and has never returned to its bull market levels. So Buffett made a good sale. On the other hand, he piled money into another oil company, ConocoPhillips, in 2007 and 2008, with terrible timing, he said soon after, because oil prices promptly fell. In 2009 and 2010, Berkshire sold about 2/3 of its ConocoPhillips position. The losses Berkshire took on that oil investment roughly balanced what it had made on PetroChina. The Power Issue. From The 25 Most Powerful People in Business, August 11, 2003. Excerpts from an article by Jerry Useem. Editor's note. This article began with a description of a Sun Valley golf game in July 2003 that the writer thought might have established, quote, a new record for aggregate economic might. The players, quote, they included the CEO of the world's largest company, the world's most successful investor, and the world's richest man. Picture all that clout piled into one battery-powered cart, and you have the right visual for opening this power issue. Move past a dozen or so paragraphs about the meaning of power to the editor's discussion of who should be first on the list. Said the article, and we quote several paragraphs.
After several months of internal debate about our power list, two things became clear. First, that power is a really deep topic. Second, that any list we published would provoke the same howls of protest and counter-protest that filled our offices. And yet, in one area, a strange civility broke out. When it came to deciding the list's highest slots, there was something close to unanimity. In fact, we narrowed the top 3 contenders to a trio who, coincidentally, and on the Bible here, were set to play golf in Sun Valley. We had our 3 biggest fish. That left the question, who's the kingfish? There's no debating who runs the most powerful company. Lee Scott's Walmart is reshaping about 20 industries at once, and would probably qualify for a seat on the UN Security Council if that body's membership weren't limited to countries. Yet Scott may be the most replaceable of the 3. Bill Gates, as lead brain in a company powered by brain power, is still Mr. Microsoft. And as Huck Finn might have said, he's got a powerful amount of green stuff to go with his gray. Yet the company's $46 billion war chest is only potential and unrealized power unless it finds new behavior-changing ways to use it. Lately, Microsoft has been parceling it out to investors as dividends. Which brings us to our 3rd golfer. Besides overseeing an empire known as Berkshire Hathaway, Warren Buffett has his hand in a lot of important pies: Coca-Cola, Gillette, the Washington Post Company, and a personal fortune second only to Gates's. But the most arresting fact about Buffett may come from a recent Duke University survey of graduating MBAs. After their own father, the person the graduates admire most, more than the president, more than the Pope, more than Gandhi, is Warren Buffett. That remarkable stature gives him a power of moral suasion that's been made all the stronger by his sparing use of it. It's the ability to shape the behavior of people far beyond his direct reach merely through his words. And it's added to Buffett's image as American capitalism's unofficial Lord Protector. He's got the rock, the scissors, and the paper. And now he's got something else. The top spot on our list.
The Most Powerful Business Person, Warren Buffett. August 11, 2003, by Andy Serwer.
The most powerful business person in America is famously understated about his station in life. Sure, Warren Buffett enjoys some of the trappings that come from being the second richest man in the world, such as winging around in one of his net jets and playing bridge with his pal and number 2 on our list, Bill Gates. Mostly, though, the 72-year-old brushes aside the notion that he is the atlas of American business. "It really just means that if I do something dumb, I can do it on a very big scale," he says with his trademark chuckle. "It means you could add a lot of zeros to the losses." There haven't been many of the latter. Buffett's company, Berkshire Hathaway, has become an all-American juggernaut, with multi-billion-dollar interests in everything from insurance, where Buffett is one of the world's leading players, to newspapers, carpets, and cowboy boots. And racking up compound annual returns of 21% over the past 15 years versus the market's 11%, Buffett has proved himself the world's greatest investor. As such, his influence on stocks and the market is unparalleled. Word that Buffett is buying or selling certain shares, be it fact or fiction, will move a stock like a pinball, which is why he is extra guarded when it comes to discussing investments. One of the few places where he does talk about investments, his annual letter to shareholders, is far and away the most widely read communication from a CEO in the world. When former Chinese President Jiang Zemin discussed the mystifying nature of the U.S. stock market with a visiting Bill Gates, Gates told him that there was really only one guy who understood it: Warren Buffett. Gates added that when he got back to the U.S., he would send Buffett's most recent annual report to him, which he did. No word on whether Jiang is now long BRK. What's more, Buffett is without question the world's most sought-after businessman by other CEOs who want guidance. "CEOs are surrounded by people who are getting paid," says Buffett. "I'm getting nothing, so I can give them unbiased advice." Over the past 5 years, dozens of CEOs have come to Omaha to visit the sage, including General Electric's Jeff Immelt, a number 7 on our list. "I've been there 2 or 3 times to speak with him and have a steak," says Immelt. "He's the world's most astute investor, and I'm trying to pick his brain." The U.S. Congress hangs on Buffett's words, too. On May 20th, just days before lawmakers voted on the Bush tax bill, Buffett wrote an op-ed piece in the Washington Post that pointed out what he perceived as the folly of eliminating taxes on dividends. The tax cut, Buffett argued, would mostly benefit the wealthy. Powerful stuff coming from Buffett, powerful enough to persuade certain members of Congress to water down the final version of the tax cut. Quite simply, Buffett is respected and admired more than any other business person alive, not only by others in business, but by the general public as well. Now that's power.
The complete Power article, including all 25 of the people listed, is available at fortune.com/BuffettBook. America's growing trade deficit is selling the nation out from under us. Here's a way to fix the problem, and we need to do it now. November 10th, 2003. By Warren Buffett, working with Carol Loomis. This article by Buffett, running under a title that surely set a new fortune records for length, deplored the U.S. trade deficit and proposed a Buffett idea. Quote, "Import certificates," as a way to bring imports and exports into balance. Being both creative and well thought out, the idea sparked some interest in Washington, catching the fleeting attention, for example, of both Senators Ted Kennedy and Joe Biden. Even today, with Buffett in no way stumping for his idea, he will occasionally get an email from someone admiring his concept and wondering how to advance it. But overall, Buffett's idea did not gain traction. Certainly no acclaim came from economists. They are almost universally free traders who despise quotas and all else that would interfere with the market's working its Adam Smith magic. Charlie Munger himself is enough of a traditionalist to have disliked Buffett's plan, which he happened to learn about in a brand new copy of Fortune that I, while visiting him and his now late wife in California, hand-delivered to him. He immediately read the article from start to finish, then said, "Warren is right, of course, in abhorring our trade deficits. I wish, though, that he would not push gimmicks like this." Just as Buffett was sure would happen, nonetheless, the problems that he spotlighted in 2003 have worsened. The U.S. trade deficit that year was about $500 billion. It ran $100 billion to $250 billion higher in each of the next 5 years, abating to under $500 billion only in 2009, when the credit crisis so terrified U.S. citizens that they at least temporarily cut their consumption of goods in favor of higher rates of saving. After 2009, the trade deficit began working its way up. Its likely level in 2012, going by monthly rates through July, is around $560 billion. Today, though Buffett talks about the import certificate idea only when asked, he still thinks it has merit. Other ideas for achieving a balance between exports and imports might work as well, he adds, but, he says with conviction, somehow we have to get to balance. The current situation of huge deficits is simply untenable. The article's opening revelation that Buffett has put Berkshire into foreign currencies, trading against the dollar for the first time in his life, led him in the next few years to report periodically on where this bet stood. He wound up this narrative in early 2006 by stating that Berkshire had made about $2.2 billion on currencies and had closed out almost all of its positions. That was not because he expected the dollar to strengthen. He, in fact, said it would probably weaken, which indeed it has, by a significant amount, but because interest rate differentials between countries had changed and lessened the attractiveness of direct investments in currencies. Putting Berkshire's money into companies, making a large proportion of their earnings overseas, would be a better strategy for the future, Buffett said. One follow-on. Just a few months later, to that declaration, Berkshire's first ever acquisition of a foreign company, namely Iskar, an Israeli manufacturer of cutting tools that makes almost all of its profits outside the U.S. Berkshire's stake is 80% of the company, bought for $4 billion, with the other 20% remaining in the hands of the sellers. The article that immediately follows this one on the trade deficit appeared as a sidebar. CL.
I am about to deliver a warning regarding the U.S. trade deficit and also suggest a remedy for the problem. But first, I need to mention 2 reasons you might want to be skeptical about what I say. To begin, my forecasting record with respect to macroeconomics is far from inspiring. For example, over the past 2 decades, I was excessively fearful of inflation. More to the point at hand, I started way back in 1987 to publicly worry about our mounting trade deficits, and as you know, we've not only survived but also thrived. So on the trade front, score at least 1 wolf for me. Nevertheless, I am crying wolf again, and this time backing it with Berkshire Hathaway's money. Through the spring of 2002, I had lived nearly 72 years without purchasing a foreign currency. Since then, Berkshire has made significant investments in, and today holds, several currencies. I won't give you the particulars. In fact, it is largely irrelevant which currencies they are. What does matter is the underlying point. To hold other currencies is to believe that the dollar will decline. Both as an American and as an investor, I actually hope these commitments prove to be a mistake. Any profits Berkshire might make from currency trading would pale against the losses the company and our shareholders, in other aspects of their lives, would incur from a plunging dollar. But as head of Berkshire Hathaway, I am in charge of investing its money in ways that make sense. And my reason for finally putting my money where my mouth has been so long is that our trade deficit has greatly worsened to the point where our country's net worth, so to speak, is now being transferred abroad at an alarming rate. Perpetuation of this transfer will lead to major trouble. To understand why, take a wildly fanciful trip with me to two isolated side-by-side islands of equal size, Squanderville and Thriftville. Land is the only capital asset in these islands, and their communities are primitive, needing only food and producing only food. Working 8 hours a day, in fact, each inhabitant can produce enough food to sustain himself or herself. And for a long time, that's how things go along. On each island, everybody works the prescribed 8 hours a day, which means that each society is self-sufficient. Eventually, though, the industrious citizens of Thriftville decide to do some serious saving and investing, and they start to work 16 hours a day. In this mode, they continue to live off the food they produce in 8 hours of work, but begin exporting an equal amount to their one and only trading outlet, Squanderville. The citizens of Squanderville are ecstatic about this turn of events, since they can now live their lives free from toil, but eat as well as ever. Oh yes, there's a quid pro quo, but to the squanders it seems harmless. All that the thrifts want in exchange for their food is squander bonds, which are denominated naturally in squander bucks. Over time, Thriftville accumulates an enormous amount of these bonds, which at their core represent claim checks on the future output of Squanderville. A few pundits in Squanderville smell trouble coming. They foresee that for the squanders both to eat and to pay off or simply service the debt they're piling up will eventually require them to work more than 8 hours a day. But the residents of Squanderville are in no mood to listen to such doom-saying. Meanwhile, the citizens of Thriftville begin to get nervous. Just how good, they ask, are the IOUs of a shiftless island? So the thrifts change strategy. Though they continue to hold some bonds, they sell most of them to Squanderville residents for squander bucks and use the proceeds to buy Squanderville land. And eventually, the thrifts own all of Squanderville. At that point, the squanders are forced to deal with an ugly equation. They must now not only return to working 8 hours a day in order to eat, they have nothing left to trade, but must also work additional hours to service their debt and pay Thriftville rent on the land so imprudently sold. In effect, Squanderville has been colonized by purchase rather than conquest. It can be argued, of course, that the present value of the future production that Squanderville must forever ship to Thriftville only equates to the production Thriftville initially gave up, and that, therefore, both have received a fair deal. But since one generation of squanders gets the free ride and future generations pay in perpetuity for it, there are, in economist talk, some pretty dramatic intergenerational inequities. Let's think of it in terms of a family. Imagine that I, Warren Buffett, can get the suppliers of all that I consume in my lifetime to take Buffett family IOUs that are payable in goods and services and with interest added by my descendants. This scenario may be viewed as affecting an even trade between the Buffett family unit and its creditors, but the generations of Buffetts following me are not likely to applaud the deal, and, heaven forbid, may even attempt to welsh on it. Think again about those islands. Sooner or later, the Squanderville government, facing ever greater payments to service debt, would decide to embrace highly inflationary policies, that is, issue more squander bucks to dilute the value of each. After all, the government would reason, those irritating squander bonds are simply claims on specific numbers of squander bucks, not on bucks of specific value. In short, making squander bucks less valuable would ease the island's fiscal pain. That prospect is why I, were I a resident of Thriftville, would opt for direct ownership of Squanderville land rather than bonds of the island's government. Most governments find it much harder morally to seize foreign-owned property than they do to dilute the purchasing power of claim checks for foreigners' hold. Theft by stealth is preferred to theft by force. So, what does all this island hopping have to do with the U.S.? Simply put, after World War II and up until the early 1970s, we operated in the industrious Thriftville style, regularly selling more abroad than we purchased. We concurrently invested our surplus abroad, with the result that our net investment, that is, our holdings of foreign assets less foreign holdings of U.S. assets, increased under methodology since revised that the government was then using, from $37 billion in 1950 to $68 billion in 1970. In those days, to sum up, our country's net worth, viewed in totality, consisted of all the wealth within our borders, plus a modest portion of the wealth in the rest of the world. Additionally, because the U.S. was in a net ownership position with respect to the rest of the world, we realized net investment income that, piled on top of our trade surplus, became a second source of investable funds. Our fiscal situation was thus similar to that of an individual who was both saving some of his salary and reinvesting the dividends from his existing nest egg. In the late 1970s, the trade situation reversed, producing deficits that initially ran about 1% of GDP. That was hardly serious, particularly because net investment income remained positive. Indeed, with the power of compound interest working for us, our net ownership balance hit its high in 1980 at $360 billion. Since then, however, it's been all downhill, with the pace of decline rapidly accelerating in the past 5 years. Our annual trade deficit now exceeds 4% of GDP. Equally ominous, the rest of the world owns a staggering $2.5 trillion more of the U.S. than we own of other countries. Some of this $2.5 trillion is invested in claim checks, U.S. bonds, both governmental and private, and some in such assets as property and equity securities. In effect, our country has been behaving like an extraordinarily rich family that possesses an immense farm. In order to consume 4% more than we produce, that's the trade deficit, we have, day by day, been both selling pieces of the farm and increasing the mortgage on what we still own. To put the $2.5 trillion of net foreign ownership in perspective, contrast it with the $12 trillion value of publicly owned U.S. stocks, or the equal amount of U.S. residential real estate, or what I would estimate as a grand total of $50 trillion in national wealth. Those comparisons show that what's already been transferred abroad is meaningful, in the area, for example, of 5% of our national wealth. More important, however, is that foreign ownership in our assets will grow at about $5 billion per year at the present trade deficit level, which means that the deficit will be adding about 1% point annually to foreigners' net ownership of our national wealth. As that ownership grows, so will the annual net investment income flowing out of this country. That will leave us paying ever-increasing dividends and interest to the world, rather than being a net receiver of them, as in the past. We have entered the world of negative compounding. Goodbye pleasure, hello pain. We were taught in Economics 101 that countries could not for long sustain large, ever-growing trade deficits. At a point, so it was claimed, the spree of the consumption-happy nation would be braked by currency rate adjustments and by the unwillingness of creditor countries to accept an endless flow of IOUs from the big spenders. And that's the way it has indeed worked for the rest of the world, as we can see by the abrupt shutoffs of credit that many profligate nations have suffered in recent decades. The U.S., however, enjoys special status. In effect, We can behave today as we wish because our past financial behavior was so exemplary, and because we are so rich. Neither our capacity nor our intention to pay is questioned, and we continue to have a mountain of desirable assets to trade for consumables. In other words, our national credit card allows us to charge truly breathtaking amounts, but that card's credit line is not limitless. The time to halt this trading up assets for consumables is now, and I have a plan to suggest for getting it done. My remedy may sound gimmicky, and in truth, it is a tariff called by another name, but this is a tariff that retains most free market virtues, neither protecting specific industries, nor punishing specific countries, nor encouraging trade wars. This plan would increase our exports and might well lead to increased overall world trade. And it would balance our books without there being a significant decline in the value of the dollar, which, I believe, is otherwise almost certain to occur. We would achieve this balance by issuing what I call import certificates, ICs, to all U.S. exporters in an amount equal to the dollar value of their exports. Each exporter would, in turn, sell the ICs to parties, either exporters abroad or importers here, wanting to get goods into the U.S. To import $1 million of goods, for example, an importer would need ICs that were the byproduct of $1 million of exports. The inevitable result? Trade balance. Because our exports total about $80 billion a month, ICs would be issued in huge equivalent quantities, that is, $80 billion certificates a month, and would surely trade in an exceptionally liquid market. Competition would then determine who among those parties wanting to sell to us would buy the certificates and how much they would pay. I visualized that the certificates would be issued with a short life, possibly 6 months, so that speculators would be discouraged from accumulating them. For illustrative purposes, let's postulate that each IC would sell for 10 cents, that is, 10 cents per dollar of exports behind them. Other things being equal, this amount would mean a U.S. producer could realize 10% more by selling his goods in the export market than by selling them domestically with the extra 10% coming from his sales of ICs. In my opinion, many exporters would view this as a reduction in cost, one that would let them cut the prices of their products in international markets. Commodity-type products would particularly encourage this kind of behavior. If aluminum, for example, was selling for 66 cents per pound domestically, and ICs were worth 10%, domestic aluminum producers could sell for about 60 cents per pound, plus transportation costs, in foreign markets, and still earn normal margins. In this scenario, the output of the U.S. would become significantly more competitive, and exports would expand. Along the way, the number of jobs would grow. Foreigners selling to us, of course, would face tougher economics, but that's a problem they're up against no matter what trade solution is adopted. And make no mistake, a solution must come. As Herb Stein said, if something cannot go on forever, it will stop. In one way, the IC approach would give countries selling to us greater flexibility, since the plan does not penalize any specific industry or product. In the end, the free market would determine what would be sold in the U.S. and who would sell it. The ICs would determine only the aggregate dollar volume of what was sold. To see what would happen to imports, let's look at a car now entering the U.S. at a cost to the importer of $20,000. Under the new plan and the assumption that ICs sell for 10%, the importer's cost would rise to $22,000. If demand for the car was exceptionally strong, the importer might manage to pass all of this on to the American consumer. In the usual case, however, competitive forces would take hold, requiring the foreign manufacturer to absorb some, if not all, of the $2,000 IC cost. There is no free lunch in the IC plan. It would have certain serious negative consequences for U.S. citizens. Prices of most imported products would increase, and so would the prices of certain competitive products manufactured domestically. The cost of the ICs, either in whole or in part, would therefore typically act as a tax on consumers. That is a serious drawback. But there would be drawbacks also to the dollar continuing to lose value, or to our increasing tariffs on specific products, or instituting quotas on them, courses of actions that, in my opinion, offer a smaller chance of success. Above all, the pain of higher prices on goods imported today dims beside the pain we will eventually suffer if we drift along and trade away ever larger portions of our country's net worth. I believe that ICs would produce rather promptly a U.S. trade equilibrium well above present export levels, but below present import levels. The certificates would moderately aid all our industries in world competition, even as the free market determined which of them ultimately met the test of comparative advantage. This plan would not be copied by nations that are net exporters because their ICs would be valueless. Would major exporting countries retaliate in other ways? Would this start another Smoot-Hawley tariff war? Hardly. At the time of Smoot-Hawley, we ran an unreasonable trade surplus that we wished to maintain. We now run a damaging deficit that the whole world knows we must correct. For decades, the world has struggled with a shifting maze of punitive tariffs, export subsidies, quotas, dollar-locked currencies, and the like. Many of these import-inhibiting and export-encouraging devices have long been employed by major exporting countries trying to amass ever larger supplies, yet significant trade wars have not erupted. Surely one will not be precipitated by a proposal that simply aims at balancing the books of the world's largest trade debtor. Major exporting countries have behaved quite rationally in the past, and they will continue to do so, though, as always, it may be in their interest to attempt to convince us that they will behave otherwise. The likely outcome of an IC plan is that the exporting nations, after some initial posturing, will turn their ingenuity to encouraging imports from us. Take the position of China, which today sells us about $140 billion of goods and services annually, while purchasing only $25 billion. Were ICs to exist, one course for China would be simply to fill the gap by buying 115 billion certificates annually. But it could, alternatively, reduce its need for ICs by cutting its exports to the U.S. or by increasing its purchases from us. This last choice would probably be the most palatable for China, and we would wish it to be so. If our exports were to increase, and the supply of ICs were therefore to be enlarged, their market price would be driven down. Indeed, if our exports expanded sufficiently, ICs would be rendered valueless and the entire plan made moot. Presented with the power to make this happen, important exporting countries might quickly eliminate the mechanisms they now use to inhibit exports from us. Were we to install an IC plan, we might opt for some transition years in which we deliberately ran a relatively small deficit, a step that would enable the world to adjust as we gradually got to where we needed to be. Carrying this plan out, our government could either auction bonus ICs every month, or simply give them, say, to less developed countries needing to increase their exports. The latter course would deliver a form of foreign aid likely to be particularly effective and appreciated. I will close by reminding you again that I cried wolf once before. In general, the batting average of doomsayers in the U.S. is terrible. Our country has consistently made fools of those who were skeptical about either our economic potential or our resiliency. Many pessimistic seers simply underestimated the dynamism that has allowed us to overcome problems that once seemed ominous. We still have a truly remarkable country and economy. But I believe that in the trade deficit, we also have a problem that is going to test all of our abilities to find a solution. A gently declining dollar will not provide the answer. True, it would reduce our trade deficit to a degree, but not by enough to halt the outflow of our country's net worth and the resulting growth in our investment income deficit. Perhaps there are other solutions that make more sense than mine. However, wishful thinking and its usual companion, thumb-sucking, is not among them. From what I now see, action to halt the rapid outflow of our national wealth is called for, and ICs seem the least painful and most certain way to get the job done. Just keep remembering that this is not a small problem. For example, at the rate at which the rest of the world is now making net investments in the U.S., it could annually buy and sock away nearly 4% of our publicly traded stocks. In evaluating business options at Berkshire, my partner, Charles Munger, suggests that we pay close attention to his jocular wish. All I want to know is where I'm going to die, so I'll never go there. Framers of our trade policy should heed this caution and steer clear of Squanderville.
Why Foreigners Can't Ditch Their Dollars. November 10th, 2003. A sidebar by Warren Buffett with Carol Loomis.
How often have you seen a comment like this in articles about the U.S. dollar? Analysts say that what really worries them is that foreigners will start moving out of the dollar. Next time you see something like that, dismiss it. The fact is that foreigners, as a whole, cannot ditch their dollars. Indeed, because our trade deficit is constantly putting new dollars into the hands of foreigners, they have to just as constantly increase their U.S. investments. It's true, of course, that the rest of the world can choose which U.S. assets to hold. They can decide, for example, to sell U.S. bonds to buy U.S. stocks. Or they can move into real estate, as the Japanese did in the 1980s. Moreover, any of these moves, particularly if they are carried out by anxious sellers or buyers, can influence the price of the dollar. But imagine that the Japanese both want to get out of their U.S. real estate and entirely away from dollar assets. They can't accomplish that by selling their real estate to Americans because they will get paid in dollars. And if they sell their real estate to non-Americans, say the French, for euros, the property will remain in the hands of foreigners. In either kind of sale, the dollar assets held by the rest of the world will not, except for any concurrent shift in the price of the dollar, have changed. The bottom line is that other nations simply can't disinvest in the U.S. unless they, as a universe, buy more goods and services from us than we buy from them. That state of affairs would be called an American trade surplus, and we don't have one. You can dream up some radical plots for changing the situation. For example, the rest of the world could send the U.S. massive foreign aid that would serve to offset our trade deficit, but under any realistic view of things, our huge trade deficit guarantees that the rest of the world must not only hold the American assets it owns, but consistently add to them. And that's why, of course, our national net worth is gradually shifting away from our shores.
The Market According to Buffett. May 17, 2004. By David Stiers.
How much would you pay to get close to Warren Buffett? In what must set a new record for business fandom, some admirers were bidding as much as $117 on eBay for a ticket to Berkshire Hathaway's May 1st annual meeting. Determined to secure access for all, Buffett posted 10,000 tickets on the site at $2.50 apiece, a bargain given that one share of Class A stock goes for $93,500. But it's hardly the only time Buffett mania has reared its head. Below, a sampling of the robust Buffett aftermarket. $16.95, the best-selling Buffett tome. $210,000, Buffett's 20-year-old wallet sold at a charity auction in 1999. $5, 2 tickets to Berkshire Hathaway's annual meeting. $250,100, lunch with Buffett sold on eBay in 2003. $100, dollar bill signed by Buffett sold at a church auction in Nebraska in 2004. $20, bobblehead doll sold on the Omaha Royals website.
Editor's note: the eBay auction for a Buffett lunch to benefit San Francisco's Glide Foundation continues, and also jumps in price every year. In 2012, the winning bid, once again a record, was $3,456,789. The Best Advice I Ever Got, March 11, 2005. A Warren Buffett Recollection, edited by Carol Loomis. 3 times in the 2000s decade, Fortune lined up 20 or so well-known people and asked each to relate the best advice he or she had ever been given. Buffett agreed to be in the first of these packages, and within about 1 second of his acceptance, managing editor Rick Kirkland scheduled him for the cover. I had the Buffett interview assignment, and as I opened my notebook to record whatever he had to say, I was genuinely curious as to what it would be. I simply didn't think I'd ever heard him on this subject, so I said, "Okay, what is the best advice you ever got?" Back came an out-of-the-box answer that was a real doozy. He didn't have any best advice to talk about. Instead, he went on at length about the worst advice he had ever received, with it coming to boot from the 2 men he admired most. I can't remember how I presented Rick with this surprise twist on what he had in mind. Perhaps I have suppressed the whole scene from my brain, but you know what? We put Buffett on the cover anyway. CL.
I had 2 mentors, my dad, Howard Buffett, and Ben Graham. Here were these 2 guys who I revered and who over the years gave me tons of good advice. But when I think about what they said to me, the truth is, the first thing that comes to mind is bad advice. I was not quite 21 when this happened in 1951, and just getting out of business school at Columbia. I had just taken Ben's class there, and I was the most interested student you ever saw. I wanted to work for Ben at Graham Newman Corp., and I had famously gone to him and offered to work for nothing. He said no. But I still was determined to go into the securities business, and that's where Ben and my dad gave me the bad advice. They both thought it was a bad time to start. One thing on their minds was that the Dow Jones Industrials had been above 200 all year, and yet there had never been a year when it didn't sell below 200. So they both said, "You'll do fine, but this is not a good time to start." Now, there's one thing that may have influenced my dad, and maybe Ben too. I was too immature. I was not only young-looking, I was young-acting. I was skinny, my hair looked awful. Maybe their advice was their polite way of saying that before I started selling stocks, I needed to mature a little, or I wasn't going to be successful. But they didn't say that to me. They said the other. Anyway, I didn't pay any attention. I went back to Omaha and started selling securities at my dad's firm, Buffett Falk. My dad was a totally independent thinker. I suppose the fact that he was has influenced my own thinking some when it comes to buying stocks. Ben instructed me some there, too. He said, "You're neither right nor wrong because others agree with you. You're right because your facts and reasoning are right." Now, Ben, I started learning from him when I read his books on investing at the University of Nebraska. I had tried all kinds of investing up to then, but what he said, particularly in The Intelligent Investor, just lifted the scales from my eyes. Things like margin of safety and how to use Mr. Market rather than letting him use you. I then went to Columbia just to take his class, and later got that turned down when I asked him for a job. But I kept thinking about that idea when I came back to Omaha. I kept trying to sell Ben stocks and pestering him, sort of. And finally, one day in 1954, I got a letter from him saying something to the effect of, "The next time you're in New York, I'd like to talk to you about something." I was elated, and I made a point of getting to New York immediately. I went to work for Ben in August 1954 without ever having asked what my salary would be. It turned out to be $12,000, plus the next year I got a $2,000 bonus. I worked for both parts of the business. Graham Newman was a regulated investment company, and Newman and Graham Limited was what we'd today call a hedge fund. But together they ran only $12 million. Walter Schloss and I, though he left before long to start a hedge fund, worked together in a little room. We had a lot of fun with each other, plus we kept poring through the manuals looking for cheap stocks. We never went out to visit any companies. Ben thought that would be cheating. And when we found something terrific, Ben would put $50,000 into it. By early 1956, Ben was planning to leave the firm to go to California, and I had already decided by then to go back to Omaha. I had a terrible time telling Ben about it. I'd go into his office and come back, and then go in and not do it for a really long time. But his reaction was kind of the same as my dad would have had. Whatever's best for you. I had $9,800 at the end of 1950, and by 1956, I had $150,000. I figured with that I could live like a king, and I didn't know what I was going to do in Omaha. Maybe go to law school. I did not have a plan. I certainly didn't know I was going to start an investing partnership. But then, a couple of months later, 7 people wanted me to invest their money for them, and a partnership was the way to do it. And that began it all.
The $91 billion Conversation, October 31st, 2005, by Daniel Roth. Fair's fair. That is, if it's Warren Buffett and Bill Gates, and it's time for the University of Nebraska to finally match the event held by the University of Washington 8 years earlier. News jumped out of this conversation, which signaled that Buffett had gone a long way toward deciding that he would give his money away while he was still alive. That was a sharp swerve in his philanthropic intentions. But there had also been a swerve, a very sad one, in Buffett's life. The death in the summer of 2004 of his wife, Susie, who died from a sudden stroke. As noted earlier in this book, Buffett had always expected that Susie, 2 years younger than he, would outlive him and quickly apply her superabundant wisdom and compassion to giving his billions away. With Susie gone, the job of determining how his philanthropy should proceed had become a weight on Buffett's mind. By early 2006, though, he had settled on his stunning plan to gradually give away his Berkshire stock to 5 foundations. Chief among them, the one run by the Bill of this conversation and his wife Melinda. The Buffett Speaks Out sidebar that follows the Q&A attests to how strongly Buffett felt even in 2005 about the unfairness of the ultra-rich, including himself and Gates, of course, paying very low tax rates on their income. He made that case repeatedly in the next few years, and by 2011 had so often spoke out that his arguments, or at least something loosely resembling them, were shaped by President Obama's camp into the so-called Buffett rule. This book went to print before 2012's voters had spoken on that issue and all others before them. CL.
It's the Friday before the University of Nebraska's Big 12 conference opener in football-mad Lincoln, but the Cornhuskers game isn't the only hot ticket in town. On a beautiful late September afternoon, some 2,000 students are lined up outside the school's Lyde Center Auditorium an hour before the doors open. Andrew Schumacher, a lanky 19-year-old chemical engineering sophomore, doesn't even have a ticket, but hopes he can scrounge one to get inside. How could he miss seeing this show? After all, he says, it's Bill Gates and Warren Buffett. Gates and Buffett, friends who just happen to be the two richest men in the world, worth $51 billion and $40 billion, respectively, are coming together for a free-ranging question and answer session. They have done this kind of talk before, once. The two met up in Gates's hometown of Seattle in 1998 with students at the University of Washington. Back then, both men were on the verge of turbulent times. Microsoft about to face off against the government in its epic antitrust trial, and Buffett weeks away from buying reinsurer General Re, now the thorn in his company Berkshire Hathaway's side, thanks to its involvement with the troubled AIG. Fortune, the only magazine invited to attend their first chat, found the interaction something pretty darn close to wisdom, and put the talk on the cover. So when the billionaires decided to meet again, we went along for an inside peek at the event, and, more important, some private time with the two men to pose our own questions. Over lunch with Fortune's Daniel Roth, cherry Coke and sliced turkey on white bread for Buffett, roast beef with mustard on white for Gates, the two moguls loosened up, talking about their close relationship, their plans for poker that night, and Wall Street's willingness to lead investors down the wrong path. Both men are shaping up. Gates, 50 in October, has dropped 20 pounds by running regularly. Buffett, 75, has shed 12 pounds thanks to 3 times a week personal training sessions. And they're reshaping their plans as well. Buffett reverses himself and says for the first time that he may begin giving away his fortune before he dies. What follows are excerpts from that conversation. Fortune. A few quick hits. First, best book you've read lately. Buffett. Katharine Graham's Personal History is sensational. I think everybody ought to read that. Gates. There's one called The Bottomless Well about energy that I love. There's one about computer science, Ray Kurzweil's book. I have a preprint, so I'm not sure when it's coming out, called Singularity is Near, about artificial intelligence. The Tom Friedman book, The World is Flat, is super good. Jeffrey Sachs wrote a book called The End of Poverty. The Jack Welch book, Winning, came out this year. And don't forget Jared Diamond's Collapse, which is the follow-on to one of the best books of all time, Guns, Germs, and Steel. Fortune. Your last big splurge? Buffett. You mean personal expenditure? Fortune. Right. Buffett. Plain. That's the only way in which having a lot of money has changed my life. A NetJets G4. Note, Berkshire owns NetJets. I spent a couple $100,000 a year, maybe a little more. Gates. Splurge. I guess if I lose at poker tonight, it's a $500 splurge. Buffett. That is a splurge. Gates. Warren's and my betting has always been confined to $1 bets. Buffett. This fellow in Omaha called me about a poker game, and it sounded like fun. But with Texas Hold'em, you've got to play for money. That's the nature of the game. I think bridge is a better game, but poker is a lot of fun. Gates. If we had an ideal fourth here, we might have opted for bridge. Fortune. What does your friend think when you say, oh yeah, I'll come over for poker. Going to bring my buddy Bill Gates? Buffett. We kept it quiet. The guy that's setting up the game knows, but the other participants don't. Fortune. Back to the lightning round. Make a call on the market. 7 years from now, will the S&P 500 have returned over or under 10% annually? Buffett. More likely to be under than over. You're not going to have the GDP in nominal terms grow 5% a year and everybody make 10% a year. Gates. I'd say under, most likely. The notion that returns will continue to be super high? There are some clouds out there. Fortune. The last time you did a talk like this, Warren, you said that people were making fairly reckless assumptions about stock market returns. Is the same thing happening today with hedge funds and private equity? Buffett. In the late 1990s, people were looking in their rearview mirror, and they thought that God had granted Americans the right to 15% a year. They built that into pension assumptions. They built it to some extent into what endowment funds spent. Now, 6 or 7 years later, people look in the rearview mirror and they see that conventional investments haven't produced remotely anything like that. And so they say to themselves, well, how do I get it? I'll turn to alternative investments. You can be sure that vacuum will be filled by Wall Street people who say, you're right looking into that rearview mirror and seeing conventional investments don't work. Come with us, because we have the Holy Grail. And the thing about the Holy Grail is that you have to pay a lot more. Gates. In venture capital, there were very high returns with small amounts of money, and then very poor returns with large amounts of money. This desire to have high absolute returns, and seeing that places like Harvard University were cleverly in alternative assets, has led to this thought that, okay, there must be something out there returning 10%. I just haven't found it yet. So the fact that expectations of returns exceed reality, that's still true today. Buffett. And Wall Street feeds that. Gates. It's Wall Street's job. Both laugh. Fortune. Warren gave a speech to Allen and Company this summer about his worries surrounding the ballooning U.S. trade deficit. I'm curious, Bill, whether you have the same sort of fears that Warren does. Gates. Warren has got me thinking hard about it. I watched that speech twice, and after each time I am more concerned. I believe in the basic principle that trade is a super good thing. I am very worried that the reaction to this imbalance is to put on trade restrictions to bring imports down, which would lead other nations to do similar things. I think the greatest danger is something that would slow down the benefits that the free trade system has brought. Fortune. Don't companies like yours, as they move production overseas, add to the trade deficit problem? Gates. Microsoft is a net exporter more than any other business. We do way more of our R&D here than we get in sales here. If the U.S. had about 100 more Microsofts, the trade deficit would be gone. Buffett. High tech has been one of our huge advantages. You're looking for the things in the world that you're good at, and let the other guy turn out bananas. We're never going to be good at growing bananas in this country, but I don't think the trade deficit is a stable thing. If you had a major economic disruption, and people just had a general feeling that, look at what this situation has done, you get some very bad political consequences. It's almost inevitable. Fortune. Is that your biggest fear about what happens to the U.S.? Buffett. The biggest problem we have is in terms of rogue states, terrorists, and nuclear, chemical, or biological weapons. Economically, I think the U.S. is going to be fine. If the rest of the world's GDP per capita grows faster than ours, that's the way it should be. Gates. It's too bad that economics isn't taught or a hobby for lots of people, because you do run into those who seem to say, there's only a certain number of jobs. That's not the case. Let's say tomorrow we could decide that everyone in India is as rich as we are. Would the world be a better place? Certainly. Would the U.S. thrive more because of the great products and work that would be done over there? Absolutely. The world getting richer is a great thing. It has been a great thing, and it will continue to be. Buffett. It's not a zero-sum game. Gates. Right, that's the key. Fortune. You have different philosophies about philanthropy, with Bill giving a lot of his money away today, and Warren waiting until he dies to give it away. What arguments would you make to the other that your way is the right way? Buffett. Well, I think his way is better. He and Melinda, they're devoting a huge amount of money, terrific brains and heart to it. That's a great combination. I couldn't have done that when I was in my 40s and added anything meaningful. At my age now, you can argue that a very significant percentage of the money has been made, and I don't need the stock to control Berkshire, so it may make sense to do something very significant before I die. Fortune. Is this a change for you? Buffett. It's an evolution. Gates. In 1998, I was just getting started in philanthropy, and back then I would have said, look, it's too confusing and distracting to be making money and giving money away at the same time. I didn't think I could spare the time. As my dad encouraged me to jump in, as Melinda weighed in on that side, and both of them were willing to put time into it, we got a great person in Steve Ballmer, who actually I'd known at Microsoft a long time. The pieces really fell together. I'd always thought that I would wait until I was done working full-time before I'd do a lot of philanthropy, but it's worked amazingly well to be able to do some of both. Buffett. Bill's got a better mind for it. I couldn't do what he does. I wouldn't get any enjoyment, because I would know I wasn't that good at it. I want to see the money used intelligently. I don't regard my death as being the perfect timing necessarily. Fortune. Do you two talk about this? Buffett. Oh, sure. Gates. Absolutely. Fortune. Are you trying to persuade Warren to be as hands-on in philanthropy as you are? Gates. No, but I share the enjoyment I get out of it and some of the fun dynamics, the dynamics of what works and doesn't work. It's a lot like the world of business. Not enough that you can just walk into it, but you learn some of the specifics, and then the experience of business applies. Buffett. Berkshire is so much a part of me that I could never walk away from it. But I don't think that I'm going to quintuple my personal fortune in 6 or 8 years. The amount is big enough now to do very significant things and way different than when I was in my 40s. I mean, if I had done this in my 40s, it might have been 20 million. Now we've got a sum that can do something significant. And I don't need it to control Berkshire. Nobody's going to take over Berkshire at its present size, which was not the case 20 years ago. Gates. I'd never thought that giving wealth to my own kids could be disadvantageous till I read a Fortune article. Buffett. Should you leave it all to the children? Gates. Right. Warren was a strong voice in that article, and after I read it, I thought, wow, it would be a mistake as you get past a certain amount to hand it all down. So this idea that it should all go back to society, Warren influenced me dramatically on that. Buffett. And he's doing a better job. Laughter. It's interesting that the same people who talk about the terrible cycle of dependency that welfare brings will then hand their kids, when they emerge from the womb, a lifetime supply of food stamps. But some poor woman who's had 2 pregnancies by the time she's 17, they say, oh, this is terrible to give her anything. Fortune. Warren, I know that you don't typically invest in tech companies, but I'm curious if Microsoft is looking tempting. Buffett. With Bill on my board, people would assume that I had inside information if I made money, and if I didn't make money, it wouldn't be a good idea. Both start laughing. Gates. Yeah, they'd assume I misled you. Fortune. But Bill, you've been buying more Berkshire Hathaway. Gates. Well, out of all the board members, I have the smallest percentage of my net worth in Berkshire stock. Fortune. So this isn't a takeover attempt at Berkshire? Gates, laughing. No. Buffett. If anybody takes over, I hope it's Bill. Gates. When I get up to 1%, I'll let you know. Fortune. Speaking of Berkshire, you both like its subsidiary, Dairy Queen. So the last question, Dilly Bar or Blizzard? Buffett. Well, I actually prefer something I call a dusty Sunday. But given the choice, I would have to say a Blizzard. Gates. I would pick a Dilly Bar. Later, Dan Roth talked to the men separately. Here is his Buffett report. Buffett speaks out on the idea of a flat tax. I wouldn't support it. We have, in my view, a taxation system that's much too flat already. If you look at the payroll tax, which is over 12% now, and that applies on the first $80,000 or $90,000 of income, Bill and I pay practically none of that in relation to our income. For the people that work for us, their tax rate in many cases is the same or even higher than my own, since the rate on capital gains and dividends was cut to 15%. What has gone on in this country in recent years is a huge benefit to the very rich and not that much relief to people down below. Frankly, I think that Bill and I should have a higher tax rate on the income we get. We pay less than half the rate that I was paying 25 years ago when I was making a lot less money. They have really taken care of the rich. On his worst investment decisions. The biggest mistakes are mistakes of omission rather than commission. We've never lost that much money on any one investment, but it's the things that I knew enough to do but didn't do. We have missed profits as much as $10 billion. The fact that I didn't buy Microsoft way back is not a foregone opportunity because I didn't know enough to make that decision. But there have been other investments where I did know enough, and for one reason or other I didn't invest at all, or I did on a small scale. I was sucking my thumb when I should have been writing checks, basically. But you know, if you were a golfer and you had a hole-in-one on every hole, the game wouldn't be any fun. At least that's my explanation of why I keep hitting them in the rough. On giving his money to his children. Our kids are going to be rich, in the top 0.5% of the world, but 99% of what I have will go to philanthropy, and Bill has the same attitude, basically. We are not going to turn out super wealthy kids. They'll be wealthy, there's no question about that, but the idea of dynastic fortune turns me off. If you talk about equality of opportunity in this country, and really having everybody with talent, having a fair shot at getting the brass ring, the idea that you hand over huge positions in society simply because someone came from the right womb, I just think it's almost un-American.
Cut Your Gains, March 20th, 2006. An excerpt from Buffett's letter to shareholders in the 2005 Berkshire Hathaway Annual Report. Quote, "He is such a reductionist," said a business associate of Warren Buffett's not long ago, using that uncommon word to refer to Buffett's uncommon ability to reduce a problem or issue to its essence. Buffett displays that talent in this excerpt from his 2005 shareholder letter, averring, quote, "The most that owners in aggregate can earn between now and Judgment Day is what their businesses, in aggregate, earn." He then goes on, under the "Cut Your Gains" headline that Fortune supplied for the excerpt, to lament frictional costs and their expense effect on a family named Gotrocks. Frictional costs have been on Buffett's mind since he started his Buffett Partnership Limited in 1956. By today's definition, it was a hedge fund. But in a practice emulated by few other funds, Buffett assigned the first 6% of the fund's annual gains to his limited partners before beginning to collect any part of the gains for himself. Later, as his shareholder letters became famous, he advised most individual investors to head for low-cost index funds rather than to try to deal with the stock market themselves. Still later, he made the now famous bet against protégé partners, in which he wagered that an unmanaged and low-cost S&P index fund could over 10 years beat the performance of 5 hedge fund of funds carefully selected for this bet. The burden that limited partners in those funds bear, of course, is 2 sets of frictional costs. The first at the hedge fund level, the second at the fund of funds level. As this book is published in 2012, 4 years of the bet have passed, and the 2 sides are virtually tied. More about the bet can be found in Buffett's Big Bet, page 279. CL.
It's been an easy matter for Berkshire and other owners of American equities to prosper over the years. Between December 31st, 1899, and December 31st, 1999, to give a really long-term example, the Dow rose from 66 to 11,497. Guess what annual growth rate is required to produce this result? The surprising answer is at the end of this piece. This huge rise came about for a simple reason. Over the century, American businesses did extraordinarily well, and investors rode the wave of their prosperity. Businesses continued to do well, but now shareholders, through a series of self-inflicted wounds, are in a major way cutting the returns they will realize from their investments. The explanation of how this is happening begins with a fundamental truth. With unimportant exceptions, such as bankruptcies in which some of the company's losses are borne by creditors, the most that owners in aggregate can earn between now and Judgment Day is what their businesses in aggregate earn. True, by buying and selling that is clever or lucky, investor A may take more than his share of the pie at the expense of investor B, and yes, all investors feel richer when stocks soar, but an owner can exit only by having someone take his place. If one investor sells high, another must buy high. For owners as a whole, there is simply no magic, no shower of money from outer space that will enable them to extract wealth from their companies beyond that created by the companies themselves. Indeed, owners must earn less than their businesses earn because of frictional costs. And that's my point. These costs are now being incurred in amounts that will cause shareholders to earn far less than they historically have. To understand how this toll has ballooned, imagine for a moment that all American corporations are, and always will be, owned by a single family. We'll call them the Gottrocks. After paying taxes on dividends, this family, generation after generation, becomes richer by the aggregate amount earned by its companies. Today, that amount is about $700 billion annually. Naturally, the family spends some of these dollars, but the portion it saves steadily compounds for its benefit. In the Gottrocks household, everyone grows wealthier at the same pace, and all is harmonious. But let's now assume that a few fast-talking helpers approach the family and persuade each of its members to try to outsmart its relatives by buying certain of their holdings and selling them certain others. The helpers, for a fee of course, obligingly agree to handle these transactions. The Gottrocks still own all of corporate America. The trades just rearrange who owns what. So the family's annual gain in wealth diminishes, equaling the earnings of American business minus commissions paid. The more that family members trade, the smaller their share of the pie, and the larger the slice received by the helpers. This fact is not lost upon these broker helpers. Activity is their friend, and in a wide variety of ways they urge it on. After a while, most of the family members realize that they are not doing so well in this new beat my brother game. Enter another set of helpers. These newcomers explain to each member of the Gotrocks clan that by himself he'll never outsmart the rest of the family. The suggested cure: hire a manager, yes, us, and get the job done professionally. These manager helpers continue to use the broker helpers to execute trades. The managers may even increase their activity so as to permit the brokers to prosper still more. Overall, a bigger slice of the pie now goes to the two classes of helpers. The family's disappointment grows. Each of its members is now employing professionals, yet overall, the group's finances have taken a turn for the worse. The solution? More help, of course. It arrives in the form of financial planners and institutional consultants who weigh in to advise the Gotrocks on selecting manager helpers. The befuddled family welcomes this assistance. By now, its members know they can pick neither the right stocks nor the right stock pickers. Why, one might ask, should they expect success in picking the right consultant? But this question does not occur to the Gotrocks, and the consultant helpers certainly don't suggest it to them. The Gotrocks, now supporting 3 classes of expensive helpers, find that their results get worse, and they sink into despair. But just as hope seems lost, a 4th group, we'll call them the hyper-helpers, appears. These friendly folk explain to the Gotrocks that their unsatisfactory results are occurring because the existing helpers, brokers, managers, consultants, are not sufficiently motivated and are simply going through the motions. What, the new helpers ask, can you expect from such a bunch of zombies? The new arrivals offer a breathtakingly simple solution: pay more money. Brimming with self-confidence, the hyper-helpers assert that huge contingent payments, in addition to stiff fixed fees, are what each family member must fork over in order to really outmaneuver his relatives. The more observant members of the family see that some of the hyper-helpers are really just manager helpers wearing new uniforms, bearing sewn-on sexy names like hedge fund or private equity. The new helpers, however, assure the Gotrocks that this change of clothing is all important, bestowing on its wearers magical powers similar to those acquired by mild-mannered Clark Kent when he changed into his Superman costume. Calmed by this explanation, the family decides to pay up. And that's where we are today. A record portion of the earnings that would go in their entirety to owners, if they all just stayed in their rocking chairs, is now going to a swelling army of helpers. Particularly expensive is the recent pandemic of profit arrangements under which helpers receive large portions of the winnings when they are smart or lucky, and leave family members with all the losses and large fixed fees to boot when the helpers are dumb or unlucky, or occasionally crooked. A sufficient number of arrangements like this, heads, the helper takes much of the winnings, tails, the Gotrocks lose and pay dearly for the privilege of doing so, may make it more accurate to call the family the Hadrocks. Today, in fact, the family's frictional costs of all sorts may well amount to 20% of the earnings of American business. In other words, the burden of paying helpers may cause American equity investors overall to earn only 80% or so of what they would earn if they just sat still and listened to no one. Long ago, Sir Isaac Newton gave us 3 laws of motion, which were the work of genius. But Sir Isaac's talents did not extend to investing. He lost a bundle in the South Sea bubble, explaining later, "I can calculate the movement of the stars, but not the madness of men." If he had not been traumatized by this loss, Sir Isaac might well have gone on to discover the 4th law of motion. For investors as a whole, returns decrease as motion increases. Here's the answer to the question posed at the beginning of this piece. To get very specific, the Dow increased from 65.73 to 11,497.12 in the 20th century, and that amounts to a gain of 5.3% compounded annually. Investors would have also received dividends, of course. To achieve an equal rate of gain in the 21st century, the Dow will have to rise by December 31st, 2099 to, brace yourself, precisely 2,011,011.23. But I'm willing to settle for 2 million. 6 years into this century, the Dow has gained not at all.
Buffett's Alter Ego, May 29, 2006, by Andy Serwer. The matchup of Warren Buffett and Charles Munger is regarded as so perfect, so impossible to imagine not happening, that two different Omahans claim they made the introduction. This argument will not be settled here. But it is worth recalling what one of the contenders, Richard Holland, has written in his book, Truth and Other Tall Tales, about the evening in which he claims to have brought the pair together. Quote, "Our living room was arranged with 2 chairs in one corner for conversations, and that's where Warren and Charlie parked for the evening. To my memory, they never got out of their chairs nor stopped talking until it was time to leave. Charlie talked so much he hyperventilated occasionally." In the article that follows, Andy Serwer describes the unique talents that Munger brings to the Berkshire party, among them making the annual meeting the best two-man show that never made it to Broadway. For this introduction, I thought it might be interesting as well to ask Charlie himself to look back on his Buffett-Berkshire years and articulate, in his distinctive way, what he thinks have been the most important contributions he has made to the extraordinary success that Berkshire has become. He didn't quite rise to that bait. Instead, he employed a pronoun, we. That is an integral part of Berkshire's culture. Said Charlie, "We chose our style of operation to fit our natures, which demanded that plenty of time be spent thinking and learning, while engaging in lifelong self-criticism, light contrition for every error, and much humor. Naturally, this caused extreme delegation, which is what we would have wanted as recipients of trust. We knew our methods would create good financial results for us and those who relied on us. But we did not anticipate that we would draw so much more admiration than we deserved, and that this would help us to be happy, as we in effect became teachers who to some extent copied Warren's mentor, Ben Graham." C.L.
Ask folks about Berkshire Hathaway, and most will tell you that it's Warren Buffett's company, which is true as far as it goes. But those in the know recognize that Berkshire's success is actually the product of a tag-team effort by Buffett and his long-standing partner, Charlie Munger. Sure, Buffett is the top banana. He's the chairman and CEO as well as the very public face of the company, while Munger is merely vice chairman and more of a behind-the-scenes type. But Munger has long been the co-thinker at Berkshire, which is no small thing. In early May, I made the pilgrims to Omaha to attend Berkshire's now world-famous annual meeting and to get a taste of what Munger calls festival capitalism. I had another agenda, however, which was to do some close-up Munger watching, and also to sit down with him and pick his brain. You've probably read plenty about Berkshire's annual meetings, and I have too, but it was still a surreal experience to stroll into the filled-to-capacity Quest Center in Omaha and find 17,000 shareholders plus another 7,000 spread throughout the facility in overflow rooms. And almost every single one of them, many of whom are multimillionaires, was sitting in rapt attention as a couple of geezers, Buffett is 75 and Munger is 82, waxed on for some 5 hours. It's the kind of scene where you'd expect to see a couple of high-powered motivational speakers, which, in a sense, is what Buffett and Munger are. Over the years, the Buffett and Munger show has taken on a somewhat formulaic choreography. The two men sit center stage, facing a dark sea of shareholders. Questions are usually fielded first by Buffett, who will answer and then ramble a bit in his inimitable way, often with a one-liner or two mixed in, for 5 minutes or so. At that point, he will look over to his partner and inquire, "Charlie?" Then one of two things occurs. Munger will either lean in and make a point, pithy, often scathing comment, which sometimes elicits gasps or loud guffaws from the crowd, or Munger will simply remark, "I have nothing to say," which, after a particularly long-winded Buffett digression, can be amusing as well. After that, Buffett likes to come back for a 2-minute coda. This goes on for 2.5 hours in the morning. Then there's a break for lunch, and then another couple of hours in the afternoon. "We stumbled into this 2-person format," Munger told me the day after this year's marathon. "It would not work if it was just one person. You could have the wittiest, wisest person on earth up there, and people would find it very tiresome. It takes a little interplay of personalities to handle the extreme length of the festival." Berkshire watchers say that Munger, who can be prickly and does not suffer fools particularly well, has been coming into his own lately. Unlike Buffett, who intends to engage in post-mortem philanthropy, Munger has been actively doling out big bucks, mostly to educational and health care causes in his adopted state of California. And then there's the lavish coffee table book, Poor Charlie's Almanac, The Wit and Wisdom of Charles T. Munger, the second edition of which came out just in time for this year's annual meeting. The book's title and conceit is, of course, a nod to Benjamin Franklin, a man whom Munger generally admires. "There is the sheer amount of Franklin's wisdom," says Munger, who just for a second flashes a cherubic grin, "and the talent. Franklin played 4 instruments. He was the nation's leading scientist and inventor, plus a leading author, statesman, and philanthropist. There has never been anyone like him." To Berkshire shareholders, Munger is pretty singular himself. "Warren is obviously so brilliant," one stockholder told me, "but I just love what Charlie says." In a way, Buffett and Munger remind me of the Rolling Stones. Buffett, like Mick Jagger, is certainly the main dude, but many believe that Munger, like Keith Richards, is just as cool, if not more so. Let's just hope that Munger stays out of coconut trees. So, what were some of Charlie's zingers this year? Well, at one point, Buffett was talking about his shareholders investing on their own, which he said would work out just fine for many of them. To which Charlie followed up, "Many of you won't do fine." Munger blasted auditors, saying they are contemptible, they've totally sold out. Corrupt foreign governments are kleptocracies. A well-regarded author of business books is demented. As for executive comp, America is exporting poison to Europe, he says. The hedge fund and private equity businesses are due for a comeuppance at some point, and Wall Street is filled with racetrack touts and so on. But Munger isn't just about calling out charlatans. Many Mungerisms are exercises in humility and simple wisdom. Warren and I avoid doing anything that someone else at Berkshire can do better, he tells me. You don't really have a competency if you don't know the edge of it. On the eve of the meeting, Berkshire announced that for $4 billion it had purchased an 80% stake in Iskar, an Israeli metal-cutting tool manufacturer, and Berkshire's first acquisition overseas. In Iskar, Munger says he and his partner have found management with super talent and super integrity. I hear that Munger, who's usually more skeptical of deals than Buffett, was highly enthusiastic about Iskar from the get-go, and even more eager to do the deal than Buffett. Who the hell wouldn't be excited about this deal? Munger says. What's always been maddening to me about Berkshire and Buffett and Munger is how they make both their business and the art of investing, which I find to be so complicated and bewildering, seem so simple. Berkshire is in the business of making easy predictions, Munger explains. If a deal looks too hard, the partners simply shelve it. But the line of Munger's that I really remember best from this year's meeting is, "We have a high moral responsibility to be rational," he says. Think about that for a minute. Have you ever heard any business leader describe their charge thusly? There's a reason that there's just one Berkshire Hathaway and one Warren Buffett. And one Charlie Munger, too.
Buffett backs GM and buys a caddy. May 29, 2006. By Alex Taylor III.
Warren Buffett isn't one of those guys who always has to have the fanciest bling on the block. This is, after all, the billionaire who loves to dine at Dairy Queen. And his daily commute takes only 5 minutes. But after he saw Rick Wagoner, the chairman and CEO of General Motors, on CBS's Face the Nation in early April, Buffett decided it was time to splurge for a new ride. He faxed Wagoner a note that praised him for being candid, composed, and rational in discussing problems that GM faced that weren't of his making, and added a P.S. "I don't buy cars very often, but the next one will be a Cadillac." Wagoner wrote back offering to help Buffett with the purchase, but it wasn't necessary. Buffett dispatched his daughter to a nearby dealer so that he could, as he put it, cast one vote for the guy. She picked out a DTS, a sedan that is the model of choice for senior citizen drivers and starts at $41,900. "I think I'll become a car salesman because I would have no trouble selling this car to anyone," Buffett says. "I'm behind GM 100%. In case you were wondering, he paid cash.
The philanthropist emerges. In early May of 2006, I went into the office of my managing editor, Eric Pooley, shut his door, and told him we had a chance to break a big story. "As you know," I said in these general words, "Warren Buffett has always said that most of his fortune would go to charity, but has never spelled out any plan for making that happen. Now he's set to announce in June that he will start the giving right away. His money will gradually go to 5 foundations, and the biggest recipient by far will be the Gates Foundation. Fortune can do a story, a Q&A with him maybe, in which we can disclose all this, if we want it." Eric looked stunned, but in a microsecond said, "We want it." No doubt thinking immediately of a cover story, he said we needed to call in Greg Pond, the head of our photo department. When Greg arrived, Eric asked me to repeat my news. I began the recital, and when I got to the part about where the money would go, Eric interrupted and said, in a voice that surely penetrated the closed door, "And he's giving it to Bill Gates?" Buffett wanted to make his announcement in late June, and we scheduled our article for an issue closing June 23rd. But the story did not go on the tentative list made up for each issue, which is routinely circulated to the staff. Instead, a small team of us huddled over the secret while quietly carrying out the normal workings of a magazine. Reporting, writing, and editing took place. A photographer who didn't exactly know what the story was set up a cover shoot. Our art director pulled into the secret, designed pages and a cover. In what amounted to a small miracle, we managed to keep this story absolutely secret from even the staff for more than a month. It was not until a few days before publication that some bright soul asked, in our morning meeting, "Is there maybe some story that we don't know about that's in this issue?" Eric Pooley said there was indeed, and that the absence of further questions would be appreciated. When Fortune's public relations crew put out a long press release on Sunday, June 25th, that disclosed the news, it was a complete surprise to the world and most of the magazine's staff. Buffett made his first gifts to the 5 foundations in August 2006, and they have continued each summer. Counting all the donations made through 2012, he has given about $13.3 billion to the 5 donees. Of that, about $11 billion went to the Bill and Melinda Gates Foundation, $1.1 billion to the Susan Thompson Buffett Foundation, and $1.2 billion, that is, close to $400 million apiece, to the foundations run by his 3 children. Because the contributions to all the foundations are a set, though annually declining, number of Berkshire Hathaway's shares, the value of what Buffett gives swings yearly with the price of Berkshire stock. As one example, the gifts to the Gates Foundation have ranged from a high of $1.8 billion in the cliff-hanging year of 2008 down to a low of $1.25 billion in battered 2009. One note: the data given for the Berkshire B shares in this article and the one that follows are not adjusted for the 50-to-1 split of the shares that took place in 2010. CL. Warren Buffett Gives It Away, July 10, 2006, by Carol Loomis. We were sitting in a Manhattan living room on a spring afternoon, and Warren Buffett had a cherry Coke in his hand, as usual. But this unremarkable scene was about to take a surprising turn. "Brace yourself," Buffett warned with a grin. He then described a momentous change in his thinking. Within months, he said, he would begin to give away his Berkshire Hathaway fortune, then and now worth well over $40 billion. This news was indeed stunning. Buffett, 75, has for decades said his wealth would go to philanthropy, but has just as steadily indicated the handoff would be made at his death. Now he was revising the timetable. "I know what I want to do," he said, "and it makes sense to get going." On that spring day, his plan was uncertain in some of its details. Today it is essentially complete. And it is typical Buffett: rational, original, breaking the mold of how extremely rich people donate money. Buffett has pledged to gradually give 85% of his Berkshire stock to 5 foundations. A dominant 5/6 of the shares will go to the world's largest philanthropic organization, the $30 billion Bill and Melinda Gates Foundation, whose principals are close friends of Buffett's, a connection that began in 1991, when a mutual friend introduced Buffett and Bill Gates. The Gateses credit Buffett, says Bill, with having inspired their thinking about giving money back to society. Their foundation's activities, internationally famous, are focused on world health, fighting diseases such as malaria, HIV/AIDS, and tuberculosis, and on improving U.S. libraries and high schools. Up to now, the 2 Gateses have been the only trustees of their foundation. But as his plan gets underway, Buffett will be joining them. Bill Gates says he and his wife are thrilled by that, and by knowing that Buffett's money will allow the foundation to both deepen and accelerate its work. The generosity and trust Warren has shown, Gates adds, is incredible. Beginning in July and continuing every year, Buffett will give a set, annually declining number of Berkshire B shares, starting with 602,500 in 2006, and then decreasing by 5% per year to the 5 foundations. The gifts to the Gates Foundation will be made either by Buffett or through his estate, as long as at least one of the pair, Bill, now 50, or Melinda, 41, is active in it. Berkshire's price on the date of each gift will determine its dollar value. Were B shares, for example, to be $3,071 in July, that was their close on June 23rd, Buffett's 2006 gift to the foundation, 500,000 shares, would be worth about $1.5 billion. With so much new money to handle, the foundation will be given 2 years to resize its operations. But it will then be required by the terms of Buffett's gift to annually spend the dollar amount of his contributions as well as those it is already making from its existing assets. At the moment, $1.5 billion would roughly double the foundation's yearly benefactions. But the $1.5 billion has little relevance to the value of Buffett's future gifts, since their amount will depend on the price of Berkshire's stock when they are made. If the stock rises yearly, on average by even a modest amount, say 6%, the gain will more than offset the annual 5% decline in the number of shares given. Under those circumstances, the value of Buffett's contributions will rise. Buffett himself thinks that will happen. Or, to state that proposition more directly, he believes the price of Berkshire, and with it the dollar size of the contributions, will trend upward, perhaps over time increasing substantially. The other foundation gifts that Buffett is making will also occur annually and start in July. At Berkshire's current price, the combined 2006 total of these gifts will be $315 million. The contributions will go to foundations headed by Buffett's 3 children, Susan, Howard, and Peter, and to the Susan Thompson Buffett Foundation. This last foundation was for 40 years known simply as the Buffett Foundation, and was recently renamed in honor of Buffett's late wife, Susie, who died in 2004 at 72 after a stroke. Her will bestows about $2.5 billion on the foundation, to which her husband's gifts will be added. The foundation has mainly focused on reproductive health, family planning, and pro-choice causes, and on preventing the spread of nuclear weapons. Counting the gifts to all 5 foundations, Buffett will gradually but sharply reduce his holdings of Berkshire stock. He now owns close to 31% of the company, worth nearly $44 billion in late June, and that proportion will ultimately be cut to around 5%. Sticking to his long-term intentions, Buffett says the residual 5%, worth about $6.8 billion today, will in time go for philanthropy also, perhaps in his lifetime, and, if not, at his death. Because the value of Buffett's gifts are tied to a future unknowable price of Berkshire, there is no way to put a total dollar value on them. But the number of shares earmarked to be given have a huge value today, $37 billion. That alone would be the largest philanthropic gift in history. And if Buffett is right in thinking that Berkshire's price will trend upward, the eventual amount given could far exceed that figure. So that's the plan. What follows is a conversation in which Buffett explains how he moved away from his original thinking and decided to begin giving now. The questioner is yours truly, Fortune Editor-at-Large Carol Loomis. I am a longtime friend of Buffett's, a Berkshire Hathaway shareholder, and a director of the Susan Thompson Buffett Foundation. Coming from you, this plan is pretty startling. Up to now, you haven't been famous for giving away money. In fact, you've been roundly criticized now and then for not giving it away. So let's cut to the obvious question. Are you ill? No, absolutely not. I feel terrific. And when I had my last physical in October, my doctor gave me a clean bill of health. Then what's going on here? Does your change in plans have something to do with Susie's death? Yes, it does. Susie was 2 years younger than I, and women usually live longer than men. She and I always assumed that she would inherit my Berkshire stock and be the one who oversaw the distribution of our wealth to society, where both of us had always said it would go. And Susie would have enjoyed overseeing the process. She was a little afraid of it in terms of scaling up, but she would have liked doing it and would have been very good at it. and she would really have stepped on the gas. By that you mean she always wanted to give away more money, faster than you did? Yes. She said that many times. As for me, I always had the idea that philanthropy was important today, but would be equally important in 1 year, 10 years, 20 years, and the future generally. And someone who was compounding money at a high rate, I thought, was the better party to be taking care of the philanthropy that was to be done 20 years out, while the people compounding at a lower rate should logically take care of the current philanthropy. But that theory also happened to fit what you wanted to do, right? He laughs, hard. And how? No question about that. I was having fun, and still am having fun, doing what I do. And for a while I also thought in terms of control of Berkshire. I had bought effective control of Berkshire in the early 1970s, using $15 million I got when I disbanded Buffett Partnership. And I had very little money, considerably less than the $1 million outside of Berkshire. My salary was $50,000 a year. So if I had engaged in significant philanthropy back then, I would have had to give away shares of Berkshire. I hadn't bought those to immediately give them away. Even so, you and Susie set up the Buffett Foundation way back in the 1960s, which means you obviously expected to be giving away money sometime. What was your thinking back then? Well, when we got married in 1952, I told Susie I was going to be rich. That wasn't going to be because of any special virtues of mine or even because of hard work, but simply because I was born with the right skills, in the right place, at the right time. I was wired at birth to allocate capital, and was lucky enough to have people around me early on, my parents and teachers and Susie, who helped me to make the most of that. In any case, Susie didn't get very excited when I told her we were going to get rich. She either didn't care or didn't believe me, probably both, in fact. But to the extent we did amass wealth, we were totally in sync about what to do with it, and that was to give it back to society. In that, we agreed with Andrew Carnegie, who said that huge fortunes that flow in large part from society should in large part be returned to society. In my case, the ability to allocate capital would have had little utility unless I lived in a rich, populous country in which enormous quantities of marketable securities were traded and were sometimes ridiculously mispriced. And fortunately for me, that describes the U.S. in the second half of the last century. Certainly neither Susie nor I ever thought we should pass huge amounts of money along to our children. Our kids are great, but I would argue that when your kids have all the advantages anyway, in terms of how they grow up and the opportunities they have for education, including what they learn at home, I would say it's neither right nor rational to be flooding them with money. In effect, they've had a gigantic head start in a society that aspires to be a meritocracy. Dynastic mega-wealth would further tilt the playing field that we ought to be trying instead to level. From the fact that you've given your kids money before to set up foundations and are planning to give them more now, I gather you don't think that kind of flooding them with money is wrong. No, I don't. What they're doing with their foundations is giving money back to society, just where Susie and I thought it should go. And they aren't just writing checks. They've put enormous thought and effort into the process. I'm very proud of them for the way they've handled it all, and I have no doubt they're going to keep on the right track. So what about the Susan Thompson Buffett Foundation and what all this means for it? As you know, because as a director you've seen it up close, Alan Greenberg, the foundation's president, has done an excellent and thoughtful job of running it. His results-to-cost ratio is as good as I've ever seen, and he'll keep on that same path now, not just with Susie's money, but with mine too. Actually, if I had died before Susie and she had begun to distribute our wealth, this is the foundation that would have scaled up to a much bigger size. Right now it has only 5 employees and become her main vehicle for giving. And the foundation anchored my plans, too. Until I changed my thoughts about when to give, this was to be where my fortune would go also. And what changed your mind? The short answer is that I came to realize that there was a terrific foundation that was already scaled up, that wouldn't have to go through the real grind of getting to a mega size like the Buffett Foundation would, and that could productively use my money now. The longer answer is that over the years I had gotten to know Bill and Melinda Gates well, spent a lot of time with them having fun, and way beyond that had grown to admire what they were doing with their foundation. I've seen them give presentations about its programs, and I'm always amazed at the enthusiasm and passion and energy they're pouring into their work. They've gone at it, you might say, with both head and heart. Bill reads many thousands of pages annually, keeping up with medical advances and means of delivering help. Melinda, often with Bill along, travels the world looking at how well good intentions are being converted into good results. Life has dealt a terrible hand to literally billions of people around the world, and Bill and Melinda are bent on reducing that inequity to the extent they possibly can. If you think about it, if your goal is to return the money to society by attacking truly major problems that don't have a commensurate funding base, what could you find that's better than turning to a couple of people who are young, who are ungodly bright, whose ideas have been proven, who already have shown an ability to scale it up and do it right? You don't get an opportunity like that ordinarily. I'm getting 2 people enormously successful at something, where I've had a chance to see what they've done, where I know they will keep doing it, where they've done it with their own money. So they're not living in some fantasy world, and where, in general, I agree with their reasoning. If I've found the right vehicle for my goal, there's no reason to wait. Compare what I'm doing with them to my situation at Berkshire, where I have talented and proven people in charge of our businesses. They do a much better job than I could in running their operations. What can be more logical, in whatever you want done, than finding someone better equipped than you are to do it? Who wouldn't select Tiger Woods to take his place in a high-stakes golf game? That's how I feel about this decision about my money. People will be very curious, I think, as to how much your decision and its announcement at this particular time is connected to Bill Gates's announcement in mid-June that he would phase out of his operating responsibilities at Microsoft and begin to devote most of his time to the foundation. What's the story here? I realize that the close timing of the 2 announcements will suggest they're related, but they aren't in the least. The timing is just happenstance. I would be disclosing my plans right now whether or not he had announced his move, and even, in fact, if he were indefinitely keeping on with all of his work at Microsoft. On the other hand, I'm pleased he's going to be devoting more time to the foundation, and I think he and Melinda are pleased to know they're going to be working with more resources. Does it occur to you that it's somewhat ironic for the second richest man in the world to be giving untold billions to the first richest man? When you put it that way, it sounds pretty funny. But in truth, I'm giving it through them, and importantly, Melinda as well, not to him. Some people say the Gates Foundation is bureaucratic, and bureaucracy is just about your number 1 dislike. So how do you react to that charge? I would say that most large organizations, though Berkshire is a shining exception, are bureaucratic to some degree. Anyway, what some people really mean when they claim that the Gates Foundation is bureaucratic is that big decisions don't get made by anybody except Bill and Melinda. That suits me fine. I want the 2 of them to make the big calls. What is the significance of your going on the board of the Gates Foundation? Not much. The biggest reason for my doing that is if they were ever to go down on an airplane together. Beyond that, I hope to have a constructive thought now and then, but I don't think I'm as well cut out to be a philanthropist as Bill and Melinda are. The feedback on philanthropy is very slow, and that would bother me. I'd have to be too involved with a lot of people I wouldn't want to be involved with, and have to listen to more opinions than I would enjoy. In philanthropy also, you have to make some big mistakes. I know that. But it would bother me more to make the mistakes myself, rather than having someone else make them who I trust overall to do a good job. In general, Bill and Melinda will have a better batting average than I would. Did you talk this huge decision over with other people before deciding to go ahead with the plan? Yes, I talked to my children, and Alan Greenberg, and to 4 Berkshire directors, including my son Howard and Charlie Munger. I got lots of questions, and some people had qualms about the plan initially because it was such an abrupt change from what they had been anticipating. But I'd say everybody, and that certainly includes Alan, who knows what a bear it would have been to scale up the Buffett Foundation, came around to seeing the logic of what I was proposing to do. Now all concerned can't wait to get started, particularly me. And frankly, I have some small hopes that what I'm doing might encourage other very rich people thinking about philanthropy to decide they didn't necessarily have to set up their own foundations, but could look around for the best of those that were up and running and available to handle their money. People do that all the time with their investments. They put their money with people they think are going to do a better job than they could. There's some real merit to extending that thought to your wealth, rather than setting up something to be run after your death by a bunch of old business cronies or a staff that eventually comes to dictate the agenda. Some version of this plan I've got is not a crazy thing for some of the next 20 people who are going to die with $1 billion or more to adopt themselves. One problem most rich people have is that they're old, with contemporaries who are not at their peak years and who don't have much time ahead of them. I'm lucky in that respect, in that I can turn to younger people. Okay. Now, what does that mean for Berkshire? I'd say virtually nothing. Anybody who knows me also knows how I feel about making Berkshire as good as it can be, and that goal is still going to be there. I won't do anything differently, because I'm not capable of doing things differently. The name on the stock certificates will change, but nothing else will. I've always made it clear to Berkshire's shareholders that my wealth from the company would go to philanthropy. So the fact that I'm starting the process is basically a non-event for them. And, though this may surprise some people, it's a non-event for me too in some ways. Ted Turner, whose philanthropic activities I admire enormously, once told me that his hands shook when he signed a $1 billion pledge. Well, I have 0 of that. To me, there's just no emotional downside to this at all. Won't the foundations that are getting your stock need to sell it? Yes, in some cases. The Buffett Foundation and the kids' foundations will have to sell their stock relatively soon after they get it, because it will be their only asset, and they'll need to raise cash to give it away. The Gates Foundation will have more options because it has lots of other assets, so it will have some flexibility to choose which it should turn into cash. Bill and Melinda will make the decisions about that. I'm going to totally insulate myself from any investment decisions their foundation makes, which leaves them free to do whatever they think makes sense. Perhaps they will decide to sell bigger portions of other assets and hang on to some Berkshire. It's a great mix of businesses and wouldn't be an inappropriate asset for a foundation to own. But I won't tie the foundation up in any shape or form. So it could be that all the shares you give annually will be sold in the market. Yes, that may well happen. And naturally, people are going to be interested in whether that selling could weigh down Berkshire's price. I don't think so in the least. And that's true even though the annual turnover ratio for Berkshire has been running only about 15% a year, which is extremely low for large-cap stocks. Let's say the 5 foundations sell all the stock they get this year. If trading volume continues as it has, their selling will raise turnover to less than 17%. It would be ridiculous to think that much new selling could affect the price of the stock. In fact, the added supply could even be beneficial in increasing the stock's liquidity and should make it more likely that Berkshire would eventually be included in the S&P 500. I'd say this: I would not be making the gifts if they would in any way harm Berkshire's shareholders, and they won't. This plan seems to settle the fate, over the long term, of all your Berkshire shares. Does that mean you're giving nothing to your family in straight-out gifts? No. What I've always said is that my family won't receive huge amounts of my net worth. That doesn't mean they'll get nothing. My children have already received some money from me and Susie and will receive more. I still believe in the philosophy, Fortune quoted me saying this 20 years ago, that a very rich person should leave his kids enough to do anything, but not enough to do nothing. Remember I said that way back when I was buying Berkshire I had less than $1 million in outside cash? Well, I've made a few decent investments with that money in the years since, taking positions that were too small for Berkshire, doing some fixed income arbitrage, and selling my interest in a bank that was split off from Berkshire. So I'm glad to say I've got quite a bit of cash now. Overall, I can, and will, use my Berkshire shares for philanthropic purposes and will have plenty left over to provide well for all those close to me. What the legends gave. Their philanthropies were immense, given the small economic worlds of their time, but Buffett's contribution is miles bigger. Philanthropist Andrew Carnegie, from 1902 to 1919, gave $350 million. In current dollars, $7.2 billion. John D. Rockefeller, from 1889 to 1937, gave $530 million. In current dollars, $7.1 billion. John D. Rockefeller, Jr., 1927 to 1960, gave $475 million. In current dollars, $5.5 billion. Fortune Table / Sources, American Philanthropy by Robert H. Bremner, Fortune Research. How Buffett's Giveaway Will Work, July 10, 2006, by Carol Loomis. The mind that built the fortune also came up with a complex plan to hand it off. Warren Buffett holds only Berkshire Hathaway A stock, 474,998 shares. But his gifts are to be made in Berkshire B stock, into which each A share is convertible at a ratio of 30-1. He will convert A shares to obtain the B shares he needs for his gifts. Buffett is earmarking a set number of B shares for each of the 5 foundations he has chosen to receive his gifts. In 2006, he will give 5% of the designated shares to each recipient. The next year, the gifts will be 5% of the residual shares, and so on, for every year until either Buffett's death or until certain conditions are no longer met at the foundations. At Buffett's death, his estate will distribute, in a way not yet definite, the remaining earmarked shares. Here are the recipients and the number of B shares to be allocated to them. Bill and Melinda Gates Foundation, 10 million shares. This foundation, the largest in the world, has around $30 billion of assets right now and has given away $8 billion in its 12 years of existence. Most of its money, typically funneled through partners, has gone to World Health programs and U.S. education. Buffett's gifts to this foundation will continue only as long as either Bill or Melinda Gates is alive and active in its work. Susan Thompson Buffett Foundation, 1 million shares. Once called simply the Buffett Foundation, the renamed in 2004 for Buffett's wife who died that year, this foundation has $270 million in assets. Most of its funds came from the estate of Susan T. Buffett, and $2.1 billion more is expected from that source. This foundation has focused on reproductive health, family planning, and pro-choice causes, and on preventing the spread of nuclear weapons. Susan A. Buffett Foundation, 350,000 shares. This philanthropy is named for and chaired by Buffett's daughter, 52, who lives in Omaha, and who has also chaired the Susan Buffett Thompson Foundation since her mother's death. The daughter's foundation, which today has $118 million in assets, has funded early education for children of low-income families. With her father's new gifts, Susan Buffett expects to continue that work and expand into public education and foster care grants. Howard G. Buffett Foundation, 350,000 shares. Now holding $129 million in assets, this foundation was set up by Buffett's older son, 51, who farms 840 acres outside Decatur, Illinois, and is on several corporate boards, including Berkshire's. His middle name, by the way, is Graham, for famed investor Ben Graham. This foundation's giving has been very international, taking in 42 countries, and often aimed at conservation goals, such as the protection of African wildlife habitats. But with its new money, the foundation plans to move much more heavily into clean water projects, food relief, the plight of children entangled in illegal immigration, and other humanitarian areas. Novo Foundation, 350,000 shares. Named for the Latin word novo, meaning I alter, this foundation is run by Peter Buffett, 48, a musician and composer, and his wife Jennifer, who live in New York City. Currently holding $120 million in assets, it has focused on funding individuals and organizations working to open up education opportunities, reverse environmental degradation, uphold human rights, and improve understanding and respect among various cultures and ethnicities. Would you like that $11 billion in 20s? July 24th, 2006, by Carol Loomis. On July 3rd, Warren Buffett drove himself downtown, walked into the cavernous and nearly deserted central branch of U.S. Bank in Omaha, descended a flight of steps, and opened his large safe deposit box. He took out a 1979 dated certificate for 121,737 shares of Berkshire Hathaway A stock, on that day worth about $11 billion, roughly 1/4 of his Berkshire fortune. Driving back to his office, he pondered the next step. Getting that certificate, and a few others, worth only tens of millions, to Wells Fargo in Minneapolis for conversion at a 30-to-1 ratio into around 3.75 million shares of Berkshire B stock. He considered FedEx and elected instead to turn one of the 16 people working at Berkshire headquarters into a courier. As Fortune first reported last month, Buffett has begun to give his money to charity. Converting the astoundingly valuable 1979 certificate is an initial step in that process. When it is switched over, Buffett will have the B stock he needs for handing out the 602,500 shares he has committed this year, the first of his huge philanthropic program to the Bill and Melinda Gates Foundation and 4 smaller foundations. Because of the size of that one certificate, he will also be up to his eyeballs in B shares, having manufactured enough to fill his giving needs for most of the next decade. He'll keep the excess shares in a brokerage account to be used as needed. Buffett says the whole exercise on July 3rd made him think of the time almost 70 years ago when he was 6 years old and his father, Howard Buffett, took him to the same bank to open a $20 savings account. The money was a gift. The bank was then called Omaha National, and the small passbook he got was maroon. After that, he says, it took him 5 years of gifts, chores, and money-earning schemes to build the account to $120. Having accrued this fortune, he bought, at age 11, his first stock, 3 shares of Cities Service Preferred for $114. Well, if you are going to amass $44 billion, you have to start someplace. Buffett to Gates. Spend It. March 19, 2007. By Jia Lin Yang. Last summer, Warren Buffett stunned the business world when he told Fortune that he would give away the bulk of his $44 billion Berkshire Hathaway fortune to charity. Now comes the news that in the latest Berkshire annual report, Buffett states strict rules about what should happen to any Berkshire shares he retains when he dies, rules that challenge the way most charitable foundations are run. As he previously said, these shares will go to charity, but the new stipulations are all about speed. Once his estate is closed, which he estimates will take 3 years, every dollar of his gifts must be used within 10 years. By establishing this timetable, Buffett has thrust himself into a long-running debate. Should foundations focus their spending on resources or perpetuating them? And because of his reputation and the scale of his wealth, Buffett's endorsement of the latter is a landmark moment in philanthropy. The vast majority of large foundations operate with the intent of lasting forever, and therefore rarely exceed the minimum spending ratio of 5%, calculated on an organization's asset value of the previous year, which they need to retain tax-exempt status. According to data compiled by Buffett's staff, 28 of the 30 largest foundations paid out less than 5% of assets in grants in 2005. They reached the 5% threshold by counting operating costs. But a small number of foundations, both past and current, have decided to follow a spend-down model. Why? Many want greater control over how their money is used. As Buffett writes in the Berkshire annual report, quote, I've set this schedule because I want the money to be spent more promptly by people I know to be capable, vigorous, and motivated. Buffett's gifts are going to the Bill and Melinda Gates Foundation, 3 foundations run by his children, and the Susan Thompson Buffett Foundation, named after his late first wife. The Gateses, too, have put a time limit on the spending of their donations, stipulating that their foundation must disperse all the money within 50 years of their death. Quote, as foundations grow over time, the risk of bureaucracy and mission drift grows, says Harvey Dale, director of New York University's National Center on Philanthropy and the Law. Dale is also the former president, CEO, and now director of Atlantic Philanthropies, an oft-cited modern example of a spend-down foundation. Adds Dale, spending down focuses the mind. But don't expect the Ford Foundation to go on a wild spending spree or to go out of business anytime soon. Quote, foundations set up in perpetuity aren't looking at this, says Gene Temple, executive director of the Center on Philanthropy at Indiana University. It's a lot more common with younger donors who are setting up new foundations. Or donors who are young at heart. Buffett is 76, and he's also overseeing a charitable obligation that's increasing in size. Last June, when Buffett unveiled his plan to give away 85% of his Berkshire shares, the gift was worth $37 billion. Since then, the stock has risen about 15%. Marking to Myth. September 3, 2007, by Warren Buffett. Fortune asked a baker's dozen of financial thinkers to share both their reactions to the tightening credit crisis and their insights about the road ahead. Here are Buffett's comments.
Many institutions that publicly report precise market values for the holdings of CDOs and CMOs are, in truth, reporting fiction. They are marking to model rather than marking to market. The recent meltdown in much of the debt market, moreover, has transformed this process into marking to myth. Because many of these institutions are highly leveraged, the difference between model and market could deliver a huge whack to shareholders' equity. Indeed, for a few institutions, the difference in valuations is the difference between what purports to be robust health and insolvency. For these institutions, pinning down market values would not be difficult. They should simply sell 5% of all the large positions they hold. That kind of sale would establish a true value, though one still higher, no doubt, than would be realized for 100% of an oversized and illiquid holding. In one way, I am sympathetic to the institutional reluctance to face the music. I'd give a lot to mark my weight to model rather than market.
The Oracle's Credit Crisis, March 31, 2008. By Telis Demos.
Warren Buffett may be the world's richest man, but you might have a better credit score. When the Berkshire Hathaway CEO recently checked his credit history, his FICO score in one report was 718, slightly below the U.S. median. "I've been telling my family for years that my credit was sort of shaky," Buffett insists. He's kidding, of course, referring to his self-proclaimed stinginess with his kids. In truth, the score may have been due to an impostor. The report cites 23 missed payments on a $294 loan at an HSBC branch in Nevada, where Buffett says he has never had an account. A 2004 study found that 25% of reports contain serious errors, which is why watchdogs say low scores shouldn't be cause to deny a loan. Fortunately for Buffett, he was able to pay for his last car, a Cadillac DTS, in cash.
What Warren Thinks, April 28, 2008, by Nicholas Varcheva. The tagline on this story read, "With Wall Street in chaos, fortune naturally went to Omaha looking for wisdom." And, with some twists, that describes the article's origins. Bear Stearns had just collapsed into the arms of J.P. Morgan Chase and the U.S. government, and the economy was shuddering. Fortune's managing editor, Andy Serwer, proposed to me that we seek out Buffett's views about the markets and the economic outlook. Knowing, as Andy himself did, that Buffett resists predicting the direction of stock prices and normally ducks macro questions about the economy, I was dubious about our ability to land that article. I instead suggested a different angle. Buffett's practice of holding Q&A sessions and then lunching with business school students who had trekked to Omaha for the occasion. One of those events was coming up. Why not, I said, have a fortune writer observe and then write about what Buffett told the students? We would be getting, I also argued, a picture of Buffett the teacher, the role for which he has said he would most like to be remembered. The resulting piece turned out to be a mix of Andy's idea and mine. Assigned at the 11th hour to the story, fortune writer Nick Varcheva raced to Omaha and listened in as Buffett spent 4 hours with 150 Wharton School students. Then Buffett, never quite totally keeping his eyes on the road, drove Nick and a fortune photographer back to Berkshire's headquarters for a straight-on interview. Recalling his impressions that day, Nick says he was struck by how freely and informatively Buffett talked to the students, and was amazed at his ability to crystallize issues. Nick also added a reporter's insight. I once spent days interviewing a businessman almost as smart as Buffett, and this guy never exhibited the slightest curiosity about my background or how I got to fortune. But before that car ride with Buffett was over, he had asked me one question after another about myself. You don't see that often among the people we interview. The 150 students that Buffett talked to on that April day were among 2,400 from 31 different schools who visited Berkshire in the 2007-2008 school year. By the 2011-2012 year, Buffett had faced up to the demands on his time and cut back to around 1,450 students. But that left him still devoting one Friday a month to a crowd, 160 students, split among 8 schools, each entitled to 20 slots. Having noted that his past visitors were overwhelmingly male and having suspected some gender bias, Buffett had by then put in a rule that the contingent from each school must be at least 1/3 female. One of his assistants was meanwhile keeping track of a wait list of more than 200 schools hoping to be chosen in 2012 and 2013. CL.
With Wall Street in chaos, fortune naturally went to Omaha looking for wisdom. If Berkshire Hathaway's annual meeting, scheduled for May 3 this year, is known as the Woodstock of capitalism, then perhaps this is the equivalent of Bob Dylan playing a private show in his own house. Some 15 times a year, Berkshire CEO Warren Buffett invites a group of business students for an intensive day of learning. The students tour one or two of the company's businesses and then proceed to Berkshire headquarters in downtown Omaha, where Buffett opens the floor to 2 hours of questions and answers. Later, everyone repairs to one of his favorite restaurants where he treats them to lunch and root beer floats. Finally, each student gets the chance to pose for a photo with Buffett. In early April, the mega-billionaire hosted 150 students from the University of Pennsylvania's Wharton School, which Buffett attended, and offered fortune the rare opportunity to sit in as he expounded on everything from the Bear Stearns bailout to the prognosis of the economy to whether he'd rather be CEO of GE or a paperboy. What follows are edited excerpts from his question and answer session with the students, his lunchtime chat with the Whartonites over chicken parmigiana at Piccolo Pete's, and an interview with fortune in his office. Buffett began by welcoming the students with an array of Coca-Cola products. Berkshire owns a little over 8% of Coke, so we get the profit on 1 out of 12 cans. I don't care whether you drink it, but just open the cans if you will. He then plunged into weightier matters. Before we start in on questions, I would like to tell you about one thing going on recently. It may have some meaning to you if you're still being taught efficient market theory, which was standard procedure 25 years ago. But we've had a recent illustration of why the theory is misguided. In the past 7 or 8 or 9 weeks, Berkshire has built up a position in auction rate securities, bonds whose interest rates are periodically reset at auction, of about $4 billion. And what we have seen there is really quite phenomenal. Every day we get bid lists. The fascinating thing is that on these bid lists, frequently, the same credit will appear more than once. Here's one from yesterday. We bid on this particular issue. This happens to be Citizens Insurance, which is a creature of the state of Florida. It was set up to take care of hurricane insurance, and it's backed by premium taxes, and if they have a big hurricane and the fund becomes inadequate, they raise the premium taxes. There's nothing wrong with the credit, so we bid on 3 different Citizen securities that day. We got one bid at an 11.33% interest rate. One that we didn't buy went for 9.87%, and one went for 6%. It's the same bond, the same time, the same dealer. And a big issue. This is not some little anomaly, as they like to say in academic circles every time they find something that disagrees with their theory. So wild things happen in the markets, and the markets have not gotten more rational over the years. They become more followed. But when people panic, when fear takes over, or when greed takes over, people react just as irrationally as they have in the past. Do you think the U.S. financial markets are losing their competitive edge? And what's the right balance between confidence-inspiring standards and between regulations and the Wild West? Well, I don't think we're losing our edge. I mean, there are costs to Sarbanes-Oxley, some of which are wasted, but they're not huge relative to the $20 trillion in total market value. I think we've got fabulous capital markets in this country, and they get screwed up often enough to make them even more fabulous. I mean, you don't want a capital market that functions perfectly if you're in my business. People continue to do foolish things no matter what regulation is, and they always will. There are significant limits to what regulation can accomplish. As a dramatic illustration, take two of the biggest accounting disasters in the past 10 years, Freddie Mac and Fannie Mae. We're talking billions and billions of dollars of misstatements at both places. Now, these are two incredibly important institutions. I mean, they accounted for over 40% of the mortgage flow a few years back. Right now, I think they're up to 70%. They're quasi-governmental in nature, so the government set up an organization called OFHEO. I'm not sure what all the letters stand for. Note to Warren, they stand for Office of Federal Housing Enterprise Oversight. But if you go to OFHEO's website, you'll find that its purpose was to just watch over these two companies. OFHEO had 200 employees. Their job was simply to look at two companies and say, are these guys behaving like they're supposed to? And, of course, what happened were two of the greatest accounting misstatements in history. While these 200 people had their jobs, it's incredible. I mean, 2 for 2? It's very, very, very hard to regulate people. If I were appointed a new regulator, if you gave me 100 of the smartest people you can imagine to work for me, and every day I got the positions from the biggest institutions, all their derivative positions, all their stock positions and currency positions, I wouldn't be able to tell you how they were doing. It's very, very hard to regulate when you get into very complex instruments where you've got hundreds of counterparties. The counterparty behavior and risk was a big part of why the Treasury and the Fed felt that they had to move in over a weekend at Bear Stearns. And I think they were right to do it, incidentally. Nobody knew what would be unleashed when you had thousands of counterparties with, I read someplace, contracts with a 14 trillion notional value. Those people would have tried to unwind all those contracts if there had been a bankruptcy. What that would have done to the markets, what that would have done to other counterparties in turn, it gets very, very complicated. So regulating is an important part of the system. The efficacy of it is really tough.
At Piccolo Pete's, where he has dined with everyone from Microsoft's Bill Gates to New York Yankees' Alex Rodriguez, Buffett sat at a table with 12 Whartonites and bantered over many topics. How do you feel about the election?
Way before they both filed, I told Hillary that I would support her if she ran. And I told Barack that I would support him if he ran. So I am now a political bigamist. But I feel either would be great. And, actually, I feel that if a Republican wins, John McCain would be the one I would prefer. I think we've got 3 unusually good candidates this time.
They're all moderate in their approach.
Well, the one we don't know for sure about is Barack. On the other hand, he has the chance to be the most transformational, too.
I know you had a paper route. Was that your first job?
Well, I worked for my grandfather, which was really tough in the family grocery store. But if you gave me the choice of being CEO of General Electric or IBM or General Motors, you name it, or delivering papers, I would deliver papers. I would. I enjoyed doing that. I can think about what I want to think. I don't have to do anything I don't want to do. It might be wonderful to be head of GE, and Jeff Immelt is a friend of mine, and he's a great guy. But think of all the things he has to do, whether he wants to do them or not.
How do you get your ideas?
I just read. I read all day. I mean, we put $500 million in PetroChina. All I did was read the annual report. Editor's note: Berkshire purchased the shares 5 years ago and sold them in 2007 for $4 billion.
What advice would you give to someone who is not a professional investor? Where should they put their money?
Well, if they're not going to be an active investor, and very few should try to do that, then they should just stay with index funds, any low-cost index fund, and they should buy it over time. They're not going to be able to pick the right price and the right time. And what they want to do is avoid the wrong price and the wrong stock. You just make sure you own a piece of American business and you don't buy all at one time.
When Buffett said he was ready to pose for photographs, all 150 students stampeded out of the room within seconds and formed a massive line. For the next half hour, each one took his or her turn with Buffett, often in hammy poses. Wrestling for his wallet was a favorite. Then, as he started to leave, a 77-year-old's version of A Hard Day's Night ensued, with a pack of 30 students trailing him to his gold Cadillac. Once free, he drove this fortune writer back to his office and continued fielding questions. How does the current turmoil stack up against past crises?
Well, that's hard to say. Everyone has so many variables in it. But there's no question that this time there's extreme leveraging and, in some cases, the extreme prices of residential housing or buyouts. You've got $20 trillion of residential real estate, and you've got $11 trillion of mortgages, and a lot of that does not have a problem, but a lot of it does. In 2006, you had $330 billion of cash taken out in mortgage refinancings in the United States. That's a hell of a lot. I mean, we talk about having $150 billion of stimulus now, but that was $330 billion of stimulus. And that's just from prime mortgages. That's not from subprime mortgages. So leveraging up was one hell of a stimulus for the economy.
If that was one hell of a stimulus, do you think the $150 billion government stimulus plan will make an impact?
Well, it's $150 billion more than we'd have otherwise. But it's not like we haven't had stimulus. And then the simultaneous, more or less, LBO boom, which was called private equity this time. The abuses keep coming back, and the terms got terrible and all that. You've got a banking system that's hung up with lots of that. You've got a mortgage industry that's deleveraging, and it's going to be painful.
The scenario you're describing suggests we're a long way from turning a corner.
I think so. I mean, it seems everybody says it'll be short and shallow, but it looks like it's just the opposite. You know, deleveraging by its nature takes a lot of time, a lot of pain, and the consequences kind of roll through in different ways. Now, I don't invest a dime based on macro forecasts, so I don't think people should sell stocks because of that. I also don't think they should buy stocks because of that.
Your OFHEO example implies you're not too optimistic about regulation.
Finance has gotten so complex with so much interdependency. I argued with Alan Greenspan some about this at Washington Post Chairman Don Graham's dinner. He would say that you've spread risk throughout the world by all these instruments, and now you didn't have it all concentrated in your banks. But what you've done is you've interconnected the solvency of institutions to a degree that probably nobody anticipated, and it's very hard to evaluate. If Bear Stearns had not had a derivatives book, my guess is that the Fed wouldn't have had to do what it did.
Do you find it striking that banks keep looking into their investments and not knowing what they have?
I read a few prospectuses for residential mortgage-backed securities, mortgages, thousands of mortgages backing them, and then all those tranched into maybe 30 slices. You create a CDO by taking one of the lower tranches of that one and 50 others like it. Now, if you're going to understand that CDO, you've got 50 times 300 pages to read. It's 15,000. If you take one of the lower tranches of the CDO and take 50 of those and create a CDO squared, you're now up to 750,000 pages to read to understand one security. I mean, it can't be done. When you start buying tranches of other instruments, nobody knows what the hell they're doing. It's ridiculous. And of course, you took a lower tranche of a mortgage-backed security and did 100 of those and thought you were diversifying risk. Hell, they're all subject to the same thing. I mean, it may be a little different whether they're in California or Nebraska, but the idea that this is uncorrelated risk and therefore you can take the CDO and call the top 50% of it super senior, it isn't super senior or anything. It's a bunch of juniors all put together, and the juniors all correlate.
If big financial institutions don't seem to know what's in their portfolios, how will investors ever know when it's safe?
They can't. They've got to, in effect, try to read the DNA of the people running the companies. But I say that in any large financial organization, the CEO has to be the chief risk officer. I'm the chief risk officer at Berkshire. I think I know my limits in terms of how much I can sort of process. And the worst thing you can have is models and spreadsheets. I mean, at Solomon, they had all those models, and they fell apart.
What should we say to investors now?
The answer is you don't want investors to think that what they read today is important in terms of their investment strategy. Their investment strategy should factor in that A, if you knew what was going to happen in the economy, you still wouldn't necessarily know what was going to happen in the stock market. And B, they can't pick stocks that are better than average. Stocks are a good thing to own over time. There's only two things you can do wrong. You can buy the wrong ones, and you can buy or sell them at the wrong time. And the truth is, you never need to sell them, basically. But they could buy a cross-section of American industry, and if a cross-section of American industry doesn't work, certainly trying to pick the little beauties here and there isn't going to work either. Then they just have to worry about getting greedy. I always say you should get greedy when others are fearful, and fearful when others are greedy. But that's too much to expect. Of course, you shouldn't get greedy when others get greedy, and fearful when others get fearful. At a minimum, try to stay away from that.
By your rule, now seems like a good time to be greedy. People are pretty fearful.
You're right. They are going in that direction. That's why stocks are cheaper. Stocks are a better buy today than they were a year ago, or 3 years ago.
But you're still bullish about the U.S. for the long term?
The American economy is going to do fine, but it won't do fine every year and every week and every month. I mean, if you don't believe that, forget about buying stocks anyway. But it stands to reason. I mean, we get more productive every year, It's a positive-sum game, long term. And the only way an investor can get killed is by high fees or by trying to outsmart the market.
Buffett's Big Bet, June 23, 2008, by Carol Loomis. This 10-year investment performance wager runs through 2017. And at year-end 2011, the last marker before this book went to press, the two sides were virtually tied. On one side is Protégé Partners, a New York asset management firm whose success in the bet rides on the average performance, after all fees, of 5 hedge funds of funds that Protégé carefully picked to carry its colors. On the other side is Warren Buffett, who cast his lot with a low-cost S&P 500 index fund, specifically Vanguard's Admiral shares. The basic issue, obviously, is costs. Still pushing the theme laid out in Cut Your Gains, Buffett believes that the management and incentive fees charged by funds of funds and the hedge funds arrayed beneath them typically leave their investors earning less than a market index fund does. Protégé believes that its funds of funds will perform well enough to provide investors a net return, after fees, better than the market. Through 2011, neither case was doing a whit for investors. The start-off of the bet was the year from hell, 2008, when Protégé's funds fell, on the average, by 23.9%, and Buffett's Admiral shares did abysmally worse, down 37%. Buffett was then quoted in Fortune as saying, "I just hope that Aesop was right when he envisioned the tortoise overtaking the hare." And that's close to the scenario that is played out. Buffett's side, aka the tortoise, won in each of the next 3 years, and at year-end 2011 was within crawling distance of the lead. But both sides, after their horrible start, were then still down. The Protégé funds were 5.89% and Admiral shares were 6.27%. In a sense, the only winners in this bet, at that juncture, were the managers of the funds of funds, who had been paid management fees even though their investors, their limited partners, had lost money. "Ouch," said Protégé partner Ted Seeds upon hearing that summation from this writer. He did point out, however, a possible qualifier. One or more of the 5 funds of funds that contributed to the average return, a minus, could have had a positive return that would have taken their investors out of the losing camp, and perhaps have made these folks feel better about having paid a management fee. The point, though certainly relevant, is not publicly provable because, by the terms of the bet, the names of the 5 funds of funds have never been publicly disclosed. It has always been assumed, though, that one of the 5 is a fund run by Protégé. Also relevant to this discussion is the fact that, in his early days, Buffett ran a hedge fund, Buffett Partnership, and was compensated by his limited partners. But he did not take the now standard 2 and 20 route, meaning an annual 2% of assets management fee and a 20% share of profits. Instead, Buffett charged no management fee at all and stipulated that the first 6% earned on capital each year would go entirely to his limited partners. After that, he received 25% of profits. And, as noted earlier, his hedge fund put together 13 straight years of profits before he decided to shut it down. The average annual return he delivered his limited partners, after they paid Buffett his 25% take, was 23.8%. CL. Will a collection of hedge funds, carefully selected by experts, return more to investors over the next 10 years than the S&P 500? That question is now the subject of a bet between Warren Buffett, the CEO of Berkshire Hathaway, and Protégé Partners, LLC, a New York City money management firm that runs funds of hedge funds. In other words, a firm whose existence rests on its ability to put its clients' money into the best hedge funds and keep it out of the underperformers. You can guess which party is taking which side. Protégé has placed its bet on 5 funds of hedge funds, specifically the averaged returns that those vehicles deliver net of all fees, costs, and expenses. On the other side, Buffett, who has long argued that the fees that such helpers as hedge funds and funds of funds command are onerous and to be avoided, has bet that the returns from a low-cost S&P 500 index fund sold by Vanguard will beat the results delivered by the 5 funds that Protégé has selected. We're way past theory here. This bet, being reported for the first time in this article, whose author is both a longtime friend of Buffett's and editor of his chairman's letter in the Berkshire Annual Report, has been in existence since January 1st of this year. It's between Buffett, not Berkshire, and Protégé, the firm, not its funds. And there's serious money at stake. Each side put up roughly $320,000. The total funds of about $640,000 were used to buy a zero-coupon treasury bond that will be worth $1 million at the bet's conclusion. That $1 million will then go to charity. If Protégé wins, it has asked that the money be given to Absolute Return for Kids, ARK, an international philanthropy based in London. If Buffett wins, the intended recipient is Girls, Inc. of Omaha, whose board includes his daughter, Susan Buffett. And who's holding the money, by way of owning the zero-coupon bond? That's an esoteric institution most readers of this article will never have heard of, the Long Now Foundation of San Francisco, which exists to encourage long-term thinking and combat what one of its founders, Stewart Brand, of the Whole Earth Catalog, calls the pathologically short attention span that seems to afflict the world. 6 years ago, the foundation set up a mechanism for, what else? Long bets. The foundation receives wagers as donations, oversees the bets until they are decided, and then pays off the winner's designated charity. For this work, the foundation normally gets a $50 fee from each side and then shares 50-50 with the charitable winner-to-be in the returns earned on the funds being held. In the Buffett-Protégé bet, however, there will be no such sharing. Each side simply made a $20,000 charitable gift to the Long Now Foundation. To see today's long bets listings, to which the following publication of this article, the Buffett-Protégé bet, will be added, go to www.longbets.org. Some bets cataloged there sound as though they were made in sports bars. Actor Ted Danson garnered $2,000 for a charity when the Red Sox won the World Series before a U.S. men's soccer team won the World Cup. On a more cosmic front, Lotus founder Mitchell Kapor, an inventor, and futurist Ray Kurzweil have a $20,000 bet on the proposition that by 2029, no computer or machine intelligence will have passed the Turing test, meaning that a computer won't have successfully impersonated a human. Kapor made that prediction. Kurzweil disagrees with it. Each man, following the rules of long bets, has supported his point of view with a brief statement that is posted on the website. Buffett's and Protégé's arguments will appear there as well, and follow in the sidebars below. Through 2007, the Kapor-Kurzweil bet of $20,000 was the largest on long bets. The Buffett-Protégé bet obviously vaults the stakes to the stratosphere. And to that there is a certain history, which began at Berkshire's May 2006 annual meeting. Expounding that weekend on the transaction and management costs borne by investors, Buffett offered to bet any taker $1 million that over 10 years and after fees, the performance of an S&P index fund would beat 10 hedge funds that any opponent might choose. Some time later, he repeated the offer, adding that since he hadn't been taken up on the bet, he must be right in his thinking. But in July 2007, Ted Seides, a principal of Protégé but speaking for himself at that point, wrote Buffett to say he'd like to make the bet, or at least some version of it. Months of sporadic negotiation ensued. The two sides eventually agreed that Seides would bet on 5 funds of funds rather than 10 hedge funds. Seides stepped way beyond his usual stakes, say the cost of a meal, suggested that he and Buffett make the bet for $100,000, which he noted was Buffett's annual salary. Buffett, not knowing then that long bets even existed, said that considering his age, he's now 77, and the complications that a 10-year bet might add to his estates being settled, he'd only be interested in wagering at least $500,000. Even then, he wrote Seides, "My estate attorney is going to think I am out of my mind for complicating things." If $500,000 seemed too steep to Seides, Buffett, for whom it's obviously more of a trifle, had no problem with Seides recruiting partners to help out. And that's what in effect happened, by way of Protégé Partners LLC making the bet rather than Seides. Protégé, which manages around $3.5 billion, is principally owned by Seides, 37, and 2 other men, CEO Jeffrey Tarrant, 52, and Scott Bessent, 45. Each has a strong investment background, and 2 of the 3 have worked with well-known market practitioners. Seides learned the world of alternative investments under Yale's David Swensen. Bessent worked with both George Soros and short seller Jim Chanos. Upon its founding in 2002 by Tarrant and Seides, Protégé set up a fund of funds and began recruiting the kind of sophisticated investors, both institutions and wealthy individuals, who put their money in such funds. Very aware that the Securities and Exchange Commission prohibits broad-scale marketing by hedge funds and funds of funds, neither Seides nor Tarrant will disclose the precise names of the funds they now run, much less their performance records. But a London publication, Invest Hedge, whose parent runs a hedge fund database, provided Fortune with several years of returns for the firm's flagship U.S. fund, Protégé Partners LP. From its inception in July 2002 through the end of 2007, the Protégé Fund gained 95% after all fees, soundly beating the Vanguard S&P 500 index fund's 64%. Protégé's performance was hugely helped by the fact that by mid-2006 the firm was extremely bearish on subprime mortgage securities, including CDOs, and had dispersed its investments in hedge funds to capitalize on that opinion. Most significant, it made an investment in Paulson & Company's hedge funds, under which John Paulson made a highly publicized killing in 2007 by short-selling securities linked to subprimes. All that's history, of course, so let's get back to the bet. Buffett and Seides agreed that they'd periodically disclose where the wager stood. Seides wanted this disclosure to take place whenever the market fell by 10%, because he believes that one of the virtues of hedge funds is their ability to weather tough times. Indeed, in the first quarter of this year, during a down market, Protégé Partners LP fell by only 1.9%, while the Vanguard fund dropped 9.5%. Buffett insisted, though, that the logical time for disclosure was at Berkshire's annual meeting every spring, and that was the final agreement. Just how much Buffett will have to say about the bet every year will be limited by one fact: the names of the 5 funds of funds that Protégé has selected are to be kept confidential. Of course, Buffett knows what the names are, because Protégé must supply him with the audited results of these funds every year. But other than that, the designated funds of funds saw no advantage, at least for now, to declaring their participation in the bet and agreed to go along only if confidentiality was promised. The first fund that Protégé tried to recruit, in fact, wouldn't sign up even then. Seides and Tarrant do have a few general things to say about the 5 funds picked. They are equity-oriented, favoring stocks over bonds, tend to invest in hedge funds that avoid in-and-out trading, and are run mostly by seasoned investment folk rather than tenderfoots. And we can probably assume that Protégé Partners LP is one of the 5, if only because its exclusion would leave the firm with the difficult job of explaining to its investors why the firm didn't care to bet on the success of its own hedge fund choices. As for the fees that investors pay in the hedge fund world, and that, of course, is the crux of Buffett's argument, they are both complicated and costly. A fund of fund normally charges a 1% annual management fee. The hedge funds it puts that money into charge an annual management fee of their own, which for funds of funds is typically 1.5%. The fees are paid quarterly by an investor and are figured on the value of his account at the time. So that's 2.5% of an investor's capital that continually goes for these fees, regardless of the returns earned during a year. In contrast, Vanguard's S&P 500 Index Fund had an expense ratio last year of 15 basis points, 0.15% for ordinary shares and only 7 basis points for Admiral shares, which are available to large investors. Admiral shares are the ones bought by Buffett in the bet. On top of the management fee, the hedge funds typically collect 20% of any gains they make. That leaves 80% for the investors. The fund of funds takes 5% or more of that 80% as its share of the gains. The upshot is that only 76% at most of the annual return made on an investor's money accrues to him, with the rest going to the helpers that Buffett has written about. Meanwhile, the investor is paying his inexorable management fee of 2.5% on capital. The summation is pretty obvious. For Protégé to win this bet, the 5 funds of funds it has picked must do better, much better, than the S&P. And maybe they will. Buffett himself assesses his chances of winning at only 60%, which he grants is less of an edge than he usually likes to have. Protégé figures its own probabilities of winning at a heady 85%. Some people will say, of course, that just by making this bet, Protégé has acquired some priceless publicity. But then, Protégé clearly wants to win, and it's up against a man who hasn't made a lot of losing bets in his life. Seides himself sees one strong ray of light. Quote, "Fortunately for us, we're betting against the S&P's performance, not Buffett's." The prediction and the arguments. Prediction. Over a 10-year period, commencing on January 1, 2008, and ending December 31, 2017, the S&P 500 will outperform a portfolio of funds of hedge funds when performance is measured on a basis net of fees, costs, and expenses. Warren Buffett, agree. A lot of very smart people set out to do better than average in securities markets. Call them active investors. Their opposites, passive investors, will by definition do about average. In aggregate, their positions will more or less approximate those of an index fund. Therefore, the balance of the universe, the active investors, must do about average as well. However, these investors will incur far greater costs. So, on balance, their aggregate results after these costs will be worse than those of the passive investors. Costs skyrocket when large annual fees, large performance fees, and active trading costs are all added to the active investor's equation. Funds of hedge funds accentuate this cost problem because their fees are superimposed on the large fees charged by the hedge funds in which the funds of funds are invested. A number of smart people are involved in running hedge funds, but to a great extent their efforts are self-neutralized, and their IQ will not overcome the costs they impose on investors. Investors, on average and over time, will do better with a low-cost index fund than with a group of funds. Protégé Partners, LLC, disagree. Mr. Buffett is correct in his assertion that, on average, active management in a narrowly defined universe like the S&P 500 is destined to underperform market indexes. But applying that argument to hedge funds is a bit of an apples to oranges comparison. Having the flexibility to invest both long and short, hedge funds do not set out to beat the market. Rather, they seek to generate positive returns over time regardless of the market environment. For hedge funds, success can mean outperforming the market in lean times, while underperforming in the best of times. Through a cycle, nevertheless, top hedge fund managers have surpassed market returns net of all fees while assuming less risk as well. We believe such results will continue. There is a wide gap between the returns of the best hedge funds and the average ones. This differential affords sophisticated institutional investors, among them funds of funds, an opportunity to pick strategies and managers that these investors think will outperform the averages. Funds of funds, with the ability to sort the wheat from the chaff, will earn returns that amply compensate for the extra layer of fees their clients pay. From What Obama Means for Business, July 2, 2008. An excerpt from an article by Nina Easton. Already Obama's circle of advisers has expanded beyond a small core of academics to include veteran capitalists inside the Democratic Party. He is frequently on the phone with billionaire CEO Warren Buffett. One of my favorite people, says Obama. He's just completely down to earth and as smart as they come. A critic of the financial industry and of tax breaks for the rich, who also happens to understand capital markets better than just about anyone. Buffett's Market Metric Says Buy, February 16, 2009, by Carol Loomis and Doris Burke. The stock market kept going down and down in the first days of 2009, and we decided at Fortune that it just might be time to update Buffett's market metric, the relationship of the total value of U.S. stocks to GNP. We had run a chart of that metric in late 2001 in Warren Buffett on the Stock Market. The message then was a clarion, "Don't buy." But this time, when my co-author on this piece, Doris Burke, ran the numbers, they showed that the market was definitely in Buffett's buying range. So we published this article and chart in an issue that reached subscribers around February 1st. Okay, this buy signal wasn't perfect. From February 1st, the S&P 500 viciously went down another 18% before bottoming on March 9. Even so, if you'd bought an S&P 500 total return ETF on that February 1st and held until mid-year 2012, you would have earned a 78% total return and been very happy that Buffett shared this metric. CL. Is it time to buy stocks? According to both this 85-year chart and famed investor Warren Buffett, it just might be. The point of the chart is that there should be a rational relationship between the total market value of U.S. stocks and the output of the U.S. economy, its GNP. Fortune first ran a version of this chart in late 2001. Stocks had by that time retreated sharply from the manic levels of the Internet bubble. But they were still very high, with stock values at 133% of GNP. That level certainly did not suggest to Buffett that it was time to buy stocks. But he visualized a moment when purchases might make sense, saying, quote, "If the percentage relationship falls to the 70% to 80% area, buying stocks is likely to work very well for you." Well, that's where stocks were in late January, when the ratio was 75%. Nothing about that reversion to sanity surprises Buffett, who told Fortune that the shift in the ratio reminds him of investor Ben Graham's statement about the stock market. Quote, "In the short run, it's a voting machine, but in the long run, it's a weighing machine." Not just liking the chart's message in theory, Buffett also put himself on record in an October 17th New York Times op-ed piece, saying that he was personally buying U.S. stocks after a long period of owning nothing, outside of Berkshire Hathaway stock, but U.S. government bonds. He said that if prices kept falling, he expected to soon have 100% of his net worth in U.S. equities. Prices did keep falling. The Dow Jones Industrials have dropped by about 10% since October 17th. So presumably Buffett kept buying. Alas, for all curious investors, he isn't saying what he bought. From Riders on the Storm, May 4th, 2009. An excerpt from an article by Adam Lashinsky.
Warren Buffett delights in telling an anecdote about Wells Fargo's banking relationship with his own company, Berkshire Hathaway. In 2001, when Berkshire and a partner bought Finova, a bankrupt lender, it solicited banks to become part of a loan syndicate. Wells wasn't interested, says Buffett, who is Wells's largest shareholder with 315 million shares or a 7.4% stake. The others offered to lend Berkshire money at the ultra-low rate of 0.2 percentage points above its cost. A loss leader intended to win follow-on investment banking businesses from Berkshire. Not Wells. I got a big kick out of that because that's exactly how they should think, says Buffett with a hearty guffaw. The real insight you get about a banker is how they bank. Their speeches don't make any difference. It's what they do and what they don't do. And what Wells doesn't do is what defines its greatness.
Buffett Takes Charge, April 27, 2009, by Mark Gunther. The headline on this story works as a pun, but does not exactly portray Buffett's behavior when a shareholder at the Berkshire annual meeting asks about the company's 10% ownership of the Chinese car and battery company BYD. At such moments, Buffett invariably hands off the question to Charles Munger, Berkshire's vice chairman. "Charlie is our expert on BYD," Buffett will say. In turn, Munger owes much of his expertise to Pasadena investment manager Li Lu, who was born in China and was a pro-democracy protester at Tiananmen Square in 1989. Berkshire made its investment of $230 million in BYD in late 2008, amid the financial crisis, at a price of about $1 per share, which is, to use the Hong Kong currency in which BYD share prices are commonly quoted, HK8. After Berkshire's entry into the picture, BYD's stock went into roller coaster mode, rising to HK77 by March 2010, and then falling to HK11 in May 2012, as prospects for electric cars worsened and BYD's profits fell. By September, the stock had risen to HK16. That price still leaves Berkshire having doubled its money, but clearly BYD has not so far prospered as Munger thought it would. Today, Munger says that he, quote, retains both great admiration for BYD's founder and CEO, Mang Chuang-fu, and high hopes for the company, yet is pessimistic about the speed of gain in sales for electric cars as a class. BYD's long-term prospects are good, Munger thinks, because the company has large and extremely modern facilities, talented employees, including many thousands of engineers, and low-cost operations that deliver products with few defects. The few defects would get an argument from some people who believe that BYD's cars are not made well. Munger, however, says that complaints about the company's products are themselves few and only a minor problem in BYD's picture. CL.
Warren Buffett is famous for his rules of investing. When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is usually the reputation of the business that remains intact. You should invest in a business that even a fool can run, because someday a fool will. And perhaps most famously, never invest in a business you cannot understand. So, when Buffett's friend and longtime partner in Berkshire Hathaway, Charlie Munger, suggested earlier this year that they invest in BYD, an obscure Chinese battery, mobile phone, and electric car company, one might have predicted Buffett would cite rule number 3 above. He is, after all, a man who shunned the booming U.S. tech industry during the 1990s. But Buffett, who is 78, was intrigued by Munger's description of the entrepreneur behind BYD, a man called Wang Chuang-fu, whom he had met through a mutual friend. This guy, Munger tells Fortune, is a combination of Thomas Edison and Jack Welch, something like Edison in solving technical problems, and something like Welch in getting done what he needs to do. I have never seen anything like it. Coming from Munger, that meant a lot. Munger, the 85-year-old vice chairman of Berkshire Hathaway, is a curmudgeon who frowns on most investment ideas. When I call Charlie with an idea, Buffett tells me, and he says, that is a really dumb idea, that means we should put 100% of our net worth into it. If he says, that is the dumbest thing I've ever heard, then you should put 50% of your net worth into it. Only if he says, I'm going to have you committed, does it mean he really doesn't like the idea. This time, Buffett asked another trusted partner, David Sokol, chairman of a Berkshire-owned utility company called Mid-American Energy, to travel to China and take a closer look at BYD. Last fall, Berkshire Hathaway bought 10% of BYD for $230 million. The deal, which is awaiting final approval from the Chinese government, didn't get much notice at the time. It was announced in late September as the global financial markets teetered on the abyss. But Buffett and Munger and Sokol think it is a very big deal indeed. They think BYD has a shot at becoming the world's largest automaker, primarily by selling electric cars, as well as a leader in the fast-growing solar power industry. Wang Chuang-fu started BYD, the letters are the initials of the company's Chinese name, in 1995 in Shenzhen, China. A chemist and government researcher, Wang raised some $300,000 from relatives, rented about 2,000 square meters of space, and set out to manufacture rechargeable batteries to compete with imports from Sony and Sanyo. By about 2000, BYD had become one of the world's largest manufacturers of cell phone batteries. The company went on to design and manufacture mobile phone handsets and parts for Motorola, Nokia, Sony Ericsson, and Samsung. Wang entered the automobile business in 2003 by buying a Chinese state-owned car company that was all but defunct. He knew very little about making cars, but proved to be a quick study. In October, a BYD sedan called the F3 became the best-selling sedan in China, topping well-known brands like the Volkswagen Jetta and Toyota Corolla. BYD also began selling a plug-in electric car with a backup gasoline engine, a move putting it ahead of GM, Nissan, and Toyota. BYD's plug-in, called the F3DM for dual mode, goes farther on a single charge, 62 miles, than any other electric vehicles and sells for about $22,000, less than the plug-in Prius and much-hyped Chevy Volt are expected to cost when they hit the market in late 2010. Put simply, this little-known upstart has accelerated ahead of its much bigger rivals in the race to build an affordable electric car. Today, BYD employs 130,000 people in 11 factories, 8 in China and 1 each in India, Hungary, and Romania. Its U.S. operations are small. About 20 people work in a sales and marketing outpost in Elk Grove Village, Illinois, near Motorola, and another 20 or so in San Francisco, not far from Apple. BYD makes about 80% of Motorola's Razr handsets, as well as batteries for iPods and iPhones, and low-cost computers, including the model distributed by Nicholas Negropont's One Laptop Per Child nonprofit based in Cambridge, Mass. Revenues, which have grown by about 45% annually during the past 5 years, reached $4 billion in 2008. In acquiring a stake in BYD, Buffett broke a couple of his own rules. "I don't know a thing about cell phones or batteries," he admits, "and I don't know how cars work. But," he adds, "Charlie Munger and David Sokol are smart guys, and they do understand it. And there's no question that what's been accomplished since 1995 at BYD is extraordinary." One more thing reassured him. Berkshire Hathaway first tried to buy 25% of BYD, but Wang turned down the offer. He wanted to be in business with Buffett to enhance his brand and open doors in the U.S., he says, but he would not let go of more than 10% of BYD's stock. This was a man who didn't want to sell his company, Buffett says. That was a good sign. We're lost in Shenzhen. I've flown 8,000 miles to meet Wang, and on the way to the interview, my driver pulls to the side of a dusty highway. He's yelling in Cantonese into his phone and frenetically sketching Chinese characters on the touchscreen of a GPS navigator. The PR woman beside me looks worried. "The GPS isn't working," she says. "Too many new roads." I can't blame the driver or the GPS, which, it occurs to me, was probably made nearby, since Shenzhen is the manufacturing hub of the global electronics industry, the place your cell phone, digital camera, and laptop probably came from. Just across the river from Hong Kong, Shenzhen is the biggest and fastest-growing city in the world that most Americans cannot find on a map. It's also the Chinese city most like America, because people who live here have come from elsewhere in search of a better life. When Deng Xiaoping designated Shenzhen as China's first special economic zone in 1980, inviting capitalism to take root, it was a fishing village. Today, it's a sprawling megacity of 12 million to 14 million people, most of them migrant workers who toil in vast factories like those run by BYD and earn about 1,300 renminbi, or $190 per month. When we find BYD's new headquarters, a silvery office building that would not look out of place in Silicon Valley, I'm given a tour of the company museum, which celebrates products and milestones from the firm's brief history, and then escorted into a conference room where plates of apples, bananas, and cherry tomatoes are spread on a table. Wang takes a seat across from me. He is 43, a smallish man with black hair and glasses, and begins, through an interpreter, to tell me his story. He started BYD with a modest goal: to edge in on the Japanese-dominated battery business. Importing batteries from Japan was very expensive, Wang says. There were import duties and delivery times were long. He studied Sony and Sanyo patents and took apart batteries to understand how they were made, a process that involved much trial and error, he says. Sony and Sanyo later sued BYD unsuccessfully for infringing on their patents. BYD's breakthrough came when Wang decided to substitute migrant workers for machines. In place of the robotic arms used on Japanese assembling lines, which cost $100,000 or more apiece, BYD actually cut costs by hiring hundreds and thousands of people. When I first visited the BYD factory, I was shocked, says Daniel Kim, a Merrill Lynch technology analyst based in Hong Kong, who has been to the fully automated production lines in Japan and Korea. It's a completely different business model. To control quality, BYD broke every job down into basic tasks and applied strict testing protocols. By 2002, BYD had become one of the top 4 manufacturers worldwide and the largest Chinese manufacturer in each of the 3 rechargeable battery technologies: lithium-ion, nickel-cadmium, and nickel-metal hydride, according to a Harvard Business School case study of the company. And Wang stresses that BYD, unlike Sony and Sanyo, has never faced a recall of its batteries. Deploying the armies of laborers at BYD is an office corps of managers and engineers who invent and design the products. Today, the company employs about 10,000 engineers who have graduated from the company's training programs. Some 40% of those who enter either drop out or are dismissed, and another 7,000 new college graduates are being trained. Wang says the engineers come from China's best schools. They are the top of the top, he says. They are very hardworking and they can compete with anyone. BYD can afford to hire lots of them because their salaries are only about $600 to $700 a month. They also get subsidized housing in company-owned apartment complexes and low-cost meals in BYD canteens. They're basically breathing, eating, thinking, and working at the company 24/7, says a U.S. executive who has studied BYD. Wang typically works until 11 p.m. or midnight, 5 or 6 days a week. In China, people of my generation put work first and life second, says the CEO, whose wife takes responsibility for raising their 2 children. This human resource advantage is the most important part of BYD's strategy, Wang says. His engineers investigate a wide array of technologies, from automobile air conditioning systems that can run on batteries to the design of solar-powered streetlights. Unlike most automakers, BYD manufactures nearly all its cars by itself, not just the engines and body, but air conditioning, lamps, seat belts, airbags, and electronics. It is difficult for others to compete, Wang says. If we put our staff in Japan or the U.S., we could not afford to do anything like this. Wang himself grew up in extreme poverty. His parents, both farmers, died before he entered high school, and he was raised by an older brother and sister. The train ride from the village where he grew up to Central South Industrial University of Technology, where he earned his chemistry degree, took him by Yellow Mountain, a popular destination for hikers and tourists. But he has never visited there. I didn't go then because we had no money, he says. I don't go now because we have no time. As for accumulating wealth, I'm not interested in it, he claims. He certainly doesn't live a very lavish lifestyle. He was paid about $265,000 in 2008, and he lives in a BYD-owned apartment complex with other engineers. His only indulgences are a Mercedes and a Lexus, and they have a practical purpose. He takes their engines apart to see how they work. On a trip to the U.S., He once tried to disassemble the seat of a Toyota owned by Fred Nye, an executive who was driving him around. Shortly after BYD went public, Wang did something extraordinary. He took approximately 15% of his holdings in BYD and distributed the shares to about 20 other executives and engineers at the company. He still owns roughly 28% of the shares, worth about $1 billion. The company itself is frugal. Until recently, executives always flew coach. He once told me he was appalled that he learned that Ford, which lost billions last year, had staged a gala at the Hotel George V during the Paris Auto Show. By contrast, the last time BYD executives traveled to the Detroit Auto Show, they rented a suburban house to save the cost of hotel rooms. This attention to costs is one reason that BYD has made money consistently even as it has expanded into new businesses. Each of BYD's business units, batteries, mobile phone components, and autos, was profitable in 2008, albeit on a small scale. Overall net profits were around $187 million. BYD, which is traded on the Hong Kong Exchange, has a market value of about $3.8 billion. That's less than Ford, $7 billion at the beginning of April, but more than General Motors, $1.3 billion. Near the end of our conversation, I asked Wang about the company name. It's been reported that BYD stands for Build Your Dreams, but he says he added that as the company motto only later. Others say that as Motorola, Apple, and Berkshire Hathaway have made their way to Shenzhen, the name has taken on yet another meaning: bring your dollars. When David Sokol toured BYD's operations last year, Wang took him to a battery factory and explained that BYD wants to make its batteries 100% recyclable. To that end, the company has developed a non-toxic electrolyte fluid. To understand the point, Wang poured battery fluid into a glass and drank it. "Doesn't taste good," he said, making a face and offering a sip to Sokol. Sokol declined politely, but he got the message. His focus there was that if we're going to help solve environmental problems, we can't create new environmental problems with our technology, Sokol says. Sokol, author of a slim volume on management principles called Pleased But Not Satisfied, sized up Wang during that visit and decided he was an unusually purposeful executive. Sokol says, "Many good entrepreneurs can go from zero to a couple of million in revenues and a couple of hundred people. He's got over 100,000 people. Few can do that." When he got back to the U.S., Sokol told Buffett, "This guy's amazing. You want to meet him." Even before visiting BYD, Sokol believed in electric cars. His people at Mid-American have studied clean technologies like batteries and wind power for years because of the threat of climate change. One way or another, Sokol says, energy companies will need to produce more energy while emitting less carbon dioxide. Electric cars will be one answer. They generate fewer greenhouse gas emissions than cars that burn gasoline, and they have lower fuel costs even when oil is cheap. That's because electric engines are more efficient than internal combustion engines, and because generating energy on a large scale in coal or nuclear plants is less wasteful than doing it on a small scale by burning gasoline in an internal combustion engine. The numbers look something like this. Assume you drive 12,000 miles a year. Gas costs $2 a gallon, and electricity is priced at 12 cents per kilowatt, about what most Americans pay. A gasoline-powered car that gets 20 miles to the gallon, say a Chevy Impala or a BMW X3, will have annual fuel costs of $1,200 and generate about 6.6 tons of carbon dioxide. Equip those cars with electric motors and fuel costs drop to $400 a year, and emissions are reduced to about 1.5 tons. The big problem is that they are expensive to make, and the single largest cost is the battery. Manufacturing a safe, reliable, long-lasting, and fast-charging battery for a car is a complex and costly undertaking. BYD claims to have achieved a breakthrough with its lithium-ion ferrous phosphate technology, but no one can be sure whether it will work as promised. Skeptics say that BYD's battery cannot be both more powerful and cheaper than those made by competitors, and the U.S. Department of Energy has purchased an F3DM to take the battery apart. Chitra Gopal, an analyst with Nomura Securities in Singapore who follows the company closely, says BYD is betting on entirely new technology, and the ability to produce it at scale and at low cost remains unproven. William Moore, publisher and editor-in-chief of EV World, an electric car website, says, "They need to persuade people that they are selling a reliable, durable, quality automobile." Even BYD's admirers say the fit and finish of the company's cars leave much to be desired. Their cars are way behind Toyota for sure, Sokol admits. BYD currently exports gasoline-powered cars to Africa, South America, and the Middle East, but they compete on price, not quality. BYD's first plug-in hybrid, called a dual-mode car, is designed to run primarily on electricity with an internal combustion engine for backup. Two all-electric cars, the E3 and the E6, will follow later this year. Both will be sold first in China, primarily to fleet users, the government, post office, utilities, and tax companies, all of which will build central fast-charging facilities. Europe, with its high gas prices, is the most promising export market for BYD's electric cars. Wang signed an agreement last year with AUDIOBOOK, a Dutch dealer group, to distribute its cars in the Netherlands and 5 Eastern European countries. The company hasn't yet decided whether it will enter the U.S. market, where the economics of electric cars are not as compelling. Sokol, who now sits on BYD's board, says BYD could instead become a battery supplier to global automakers. Some Americans, though, are eager to do business with BYD. The day after Fortune's visit to BYD, Oregon Governor Ted Kulongoski arrived to test drive an electric car and urged the company to import through the port of Portland. Meanwhile, BYD researchers are on to their next big idea, a product they call a home clean power solution. It's essentially a set of rooftop solar photovoltaic panels with batteries built in to store power for use when the sun's not out, all to be designed and manufactured by BYD. Solar is an endless source of energy, Wang says. With better technology, we can reduce the costs. Wang has also focused on building a stronger executive team to drive the company forward. The good news is he's 42 years old, Sokol says. The bad news is that he is clearly the brains behind the organization and the drive. He has to develop a team faster, but I think he knows that. Last winter, it was Sokol's turn to lead Wang on a tour of his home country. They started in Detroit, where BYD's cars generated buzz at the North American Auto Show, and wound up on the West Coast, where Wang met for the first time with Charlie Munger. In between, they stopped in Omaha. "How did BYD get so far ahead?" Warren Buffett asked Wang, speaking through a translator. "Our company is built on technological know-how," Wang answered. Wary, as always, of a technology play, Buffett asked how BYD would sustain its lead. "We'll never, never rest," Wang replied. Buffett may not understand batteries or cars, or Mandarin for that matter. Drive, however, is something that needs no translation.
From Who the Admired Admire, March 22, 2010. An excerpt from an article by Anna Bernasek. In its annual Most Admired issue, Fortune asked 6 CEOs heading admired companies to say what CEO each most admired. Ken Chenault of American Express picked Buffett, saying, He embodies this incredible blend of high intellect and business judgment with the ability to emotionally engage with people. Buffett's Mr. Fix-It, August 16, 2010, by Brian Dumaine. No one could have imagined when we published this laudatory 2010 article about David Sokol that less than a year later he would have resigned from Berkshire and come to be seen by many in the press as a bad actor. In fact, the article, in a picture display, described him as the man mentioned most often as Buffett's successor. The other 5 Berkshire executives pictured Greg Abel of Mid-American Energy, Ajit Jain of Berkshire Reinsurance, Tad Montrose of General Ray, Tony Nicely of Geico, and Matt Rose of railroad company BNSF. Sokol abruptly removed himself as a contender in March 2011, resigning by his own choice from Berkshire and telling Buffett he'd been planning to leave for some time because he wanted to do something on his own. But the same Buffett press release that disclosed the resignation and Sokol's explanation of it also revealed that Sokol had bought stock in Lubrizol just weeks before proposing to Buffett that it would be a good company for Berkshire to buy. Buffett took care in the release to point out that Sokol had bought the stock before presenting his idea to Buffett and with no knowledge of how Buffett would react. Even so, the facts about Sokol's buying, combined with the lift in Lubrizol's stock that accompanied Buffett's decision to indeed buy, put Sokol into disrepute for what some onlookers thought might be insider trading. The Berkshire press release that went out after the whole affair caused its writer, Buffett, reputational trouble as well. The release, issued March 30, 2011, is on Berkshire Hathaway's website. Much of the world thought the release was too soft on Sokol, and weirdly devoid of the outrage that Buffett had long said he would display if anyone at Berkshire lost the company a shred of reputation. Critics of Buffett also questioned why he did not bore in for information when Sokol told him at one point that he owned Lubrizol stock. The Sokol issue became not only a magnet for the press, but also topic A at Berkshire's 2011 annual meeting, held on April 30th. As one of the 3 journalists recruited to receive emailed questions from shareholders, and as the first scheduled to be at the mic, I read a question that wondered accusingly why Buffett had not reacted more harshly to what Sokol had done. Some applause followed my merely posing the question. Buffett then delivered a long answer that both called Sokol's behavior inexplicable and conceded that he himself might have handled some things better. He could have, he said specifically, asked more questions when Sokol said he owned Lubrizol stock. After the meeting, the Sokol affair largely dropped out of the news. Sokol himself moved from Omaha to the Jackson Hole, Wyoming area, where he set up an investment management business. The SEC is believed to have investigated Sokol's trading, but as of press time for this book, had brought no charges. Because the Sokol news hit very soon after Fortune had closed an issue, we did not publish a story about it in the magazine. But Brian Dumaine, who wrote the Sokol article that follows, put up a Fortune.com story about Sokol the day after Buffett's press release was issued. Brian did not use the word inexplicable, but that is what he regards Sokol's actions to have been. You can find a copy of that online story at fortune.com/BuffettBook. CL.
The day after Lehman collapsed in September 2008, David Sokol noticed that the stock of Constellation Energy, a Baltimore utility, was plummeting. He called his boss, Warren Buffett, and said, "I see an opportunity here." Buffett, who had noticed the same thing, replied after a brief discussion, "Let's go after it." Constellation held vast amounts of energy futures contracts that had gone sour, and the company appeared to be on the verge of bankruptcy. Sokol, as chairman of the Berkshire subsidiary Mid-American Energy Holdings, knew the utility industry and saw a chance to buy solid assets at a bargain price. The deal, however, had to be done within 48 hours, or the company would have to file for bankruptcy. Sokol phoned the office of Constellation CEO Mayo Shattuck III, who was in an emergency board meeting. When his assistant answered, Sokol told her he'd like to speak to him. The secretary replied that if she interrupted the meeting, she might lose her job. Sokol replied, "If you don't interrupt the meeting, you might lose your job." Sokol boarded a Falcon 50EX and sped to Baltimore. He met with Shattuck and struck a deal that evening to buy the company for $4.7 billion, staving off bankruptcy. Within weeks, before the acquisition was completed, Constellation's board received a competing bid from Électricité de France for about a 30% premium. The board liked the offer, and so did Sokol, who walked away with a $1.2 billion breakup fee for Berkshire. When investors think of Berkshire Hathaway, they of course think of Warren Buffett and his record as a hands-off, if highly attentive, CEO. He gives free rein to the heads of his large collection of companies, ranging from Geico to Dairy Queen to Benjamin Moore to the Buffalo News to NetJets. Yet, even in Buffett's empire, sometimes a CEO blows it, and his business needs to be fixed or a deal needs to get done fast. When that happens, Buffett's go-to guy is David Sokol. Of all Berkshire's lieutenants, Sokol, 53, is mentioned most often as Buffett's heir, although Sokol shrugs off such speculation. Buffett likes Sokol just where he is, getting deals done, boosting profits, and turning around ailing businesses. In the foreword to Sokol's book, Pleased but Not Satisfied, Buffett writes, "He brings the business equivalent of Ted Williams's .406 batting average to the field of business management." Buffett first met Sokol in 1999 when Berkshire was buying Mid-American, the Iowa utility. With longtime Buffett friend Walter Scott, Sokol had bought a small $28 million a year geothermal business in 1991 and built it into that utility powerhouse. Mid-American, headquartered in Des Moines, now represents an $11.4 billion slice of Berkshire's revenue, about 10%, and Sokol is its chairman. In 2007, Buffett asked Sokol to get Johns Manville, an underperforming roofing and insulation company, on track, and he did. He is now its chairman. In 2008, Charlie Munger, Buffett's vice chairman, asked Sokol to fly to China to conduct due diligence on BYD, a battery and electric car maker. Sokol liked what he saw, and Berkshire invested $230 million for 10% of the company. That stake is now worth around $1.8 billion. In April, when Buffett had concerns about a provision in the Senate financial regulation bill that would have required Berkshire and other companies to post billions of collateral on their existing derivatives, it was Sokol he sent to argue his case. Buffett's side of the argument won. Last summer, Buffett handed Sokol perhaps the biggest assignment of his career, turning around NetJets. The fractional ownership jet company last year lost $711 million before taxes, not the kind of performance that warms Buffett's heart. Today, the company is profitable, and Fortune got a rare, exclusive view of how Sokol did it, but more on that later. It's not hard to understand why Buffett likes this driven Midwesterner. Sokol complements his skills. While Buffett comes off as your favorite uncle, relaxed with a warm sense of humor, Sokol is always revving in high gear. An engineer by training, he is a tough, no-nonsense manager. He's up before 5 a.m. each day and jogs 5 miles and lifts weights 5 days a week, in part to keep his weight down, but also to survive a grueling schedule. He's on the road half the year, not counting the shuttling between his homes in Omaha and in Columbus, where NetJets is based. He and his wife, Peggy, have a grown daughter, Kelly. In his rare time off, he likes to fish and ski. He gets more done in a day, says Buffett, than probably I get done in a week, and I'm not kidding. Sokol has been richly rewarded for his hard work. He, Walter Scott, and Greg Abel, now CEO of MidAmerican, together owned, not in equal shares, a 19% chunk of that company worth about $300 million when Berkshire acquired the utility in 2000. On any given day, Sokol might be out rubbing shoulders with his employees or spending time with customers and business partners, looking for new opportunities in China, Brazil, Germany, or elsewhere. How can he spend so much time out of the office and still run 3 major businesses? Sokol has a formula, one that is laid out in Pleased but Not Satisfied. He hands out the self-published book to all his executives. The concise 129-page treatise expounds Sokol's 6 laws: operational excellence, integrity, customer commitment, employee commitment, financial strength, and environmental respect. Yes, they are management bromides, but Sokol drives them so hard and so consistently into every organization he touches, ruthlessly if need be, that time and again they get him the kind of results even a Warren Buffett could like. Another trick to running 3 businesses at once, Sokol says, is to hire first-class executive assistants and use them aggressively. Too many people use assistants just to make phone calls, type letters, and file, he says. At most, mine do that 1/3 of the time. He has 2 full-time assistants and 1 part-timer who, he says, know how I think. They give him an update once a week on all the goals he set for his businesses and for the executives who run them. His assistants also know he never likes to be late for a meeting. He believes it shows disrespect. They always build in extra time in case something goes wrong, but they also make sure he has work to do if he happens to show up a half hour early. Sokol's childhood offered little evidence that he would one day become a big success. He grew up in Omaha on what he calls the wrong side of town. At the University of Nebraska, he wanted to be a doctor, but the first time he saw a cadaver, he fainted and hit his head on the edge of a marble table. His father gently suggested that he follow in the footsteps of his older brother and study civil engineering. In 1982, 4 years after graduating, he was hired by Citicorp in New York City, where he advised clients on investing in big waste energy projects. He was soon lured away to run a waste energy business called Ogden Martin, which he built into a New York Stock Exchange company before joining Walter Scott at what was to become MidAmerican. Sokol's record is not unblemished. Even if you bat .406, you strike out sometimes. And what he now says was probably the biggest failure of his career. Sokol, in the early 2000s, decided to invest in a new method to remove zinc from one of MidAmerican's geothermal wells in California. The technology worked in the lab, but when applied in the field, it flopped, leaving MidAmerican with a $2 million loss. In retrospect, Sokol should have done more pilot testing. The worst mistake I made, he says, was that when I approved the project, in the pit of my stomach, I knew it was a mistake. I've tried to teach this to young executives ever since. Your gut instincts are extremely important to listen to, particularly when they are telling you not to do something. When he reported the bad news to Buffett, the boss simply said, "Don't make a habit of it." Sokol got stung again last April when an Omaha judge issued a $32 million ruling against MidAmerican, finding that the company had willfully and intentionally miscalculated future profits to force out minority stockholders in a hydropower project in the Philippines in the 1990s. Sokol strongly disagrees with the ruling, and the company is appealing. Such setbacks notwithstanding, Sokol is the Mr. Fix-It Buffett sends in when some parts of the Berkshire machine breaks down. What's it like when David Sokol parachutes in? Consider the NetJets story. In mid-August 2009, NetJets was losing money and customers. Founder and CEO Rich Santulli drafted a letter of resignation, and Buffett accepted it. The situation was painful for both men. Buffett liked Santulli as a friend, and in the 2003 Berkshire Annual Report, he had described him as an extraordinary CEO. An ex-Goldman Sachs banker, Santulli had created a fractional jet ownership industry in 1986. By 2009, NetJets had 842 aircraft, 3,500 pilots, and revenue of $3.1 billion. Santulli, who signed a non-disparagement agreement, chose not to comment for this article. Santulli came up with the notion of fractional ownership when he noticed that most owners use their jets only a couple of hundred hours a year. Why not split the heavy cost of ownership, he thought, and at the same time avoid the hassles of hiring pilots and maintaining the plane? Today, a NetJets customer typically buys a 1/8 share of a jet for, say, 5 years. He also pays around $5,000 an hour for operations. Because NetJets has a huge fleet, it can guarantee an owner a plane not necessarily his own, but an identical model, with only 4 hours' notice. Buffett and his family and many Berkshire executives have long been happy NetJets customers. Buffett is so fond of the company he likes to peddle the service to Berkshire shareholders at his annual meetings, where he sometimes puts jets on display. In his 2001 report, Buffett, whose company also owns Fruit of the Loom, wrote, "If you buy a fraction of a plane, we might even throw in a 3-pack of briefs or boxers." Yet, since Buffett bought NetJets from the entrepreneur in 1998 for $725 million, it has not come close to earning back Berkshire's investment. The fractional jet business is like running an airline, only exponentially more complicated. Imagine having to fly a customer to a destination on 4 hours' notice. Not only does the jet need to be available, but the pilots, flight attendants, maintenance crew, and catering services all have to be at the right place at the right time. NetJets spends $100 million a year alone on pilot training. Headquarters in Columbus has its own staff of meteorologists to track weather that might delay flights. And NetJets' well-heeled customers are used to getting what they want. One G5 owner drank his coffee only out of a white styrofoam cup, and crews would have to scramble to find the cups and put them next to his seat. A NetJets pilot recalls flying a passenger from Denver to LA for a haircut and then returning him to Denver. The passenger was a poodle. The flights cost $32,000. By August of last year, the financial meltdown had taken its toll on NetJets. Some top executives no longer wanted to be seen climbing into a $50 million Gulfstream. Those Detroit CEOs flying on private jets to the congressional bailout hearings didn't help. Others couldn't afford it. The NetJets contract guarantees buying back an owner's share at a fair market price. Squeezed Wall Street titans couldn't sell their houses, their art, or their horses. But they did have a guarantee that Berkshire would buy back their jets. Owners started selling shares back at a level that was unprecedented. One NetJets executive there at the time says, "We were looking into the precipice. The charts looked like the Superman roller coaster at Six Flags." NetJets was left holding on its books a large number of unsold aircraft worth, in some cases, 40% less than had been paid for them. As the situation worsened, Sokol replaced Santulli as CEO. When he had flown to NetJets' Columbus headquarters in early August to check things out, Sokol discovered 2 major problems with the company. First, it had bought too many new planes, causing its debt to skyrocket. Second, NetJet's management, according to Sokol, was too informally organized to be effective. Sokol began handing out copies of his management book. Before long, he realized that fixing NetJets was going to be far harder than he had imagined. Over the last quarter of a century, Santulli, a charismatic leader, had built a strong culture at NetJets. Many employees felt like family, willing to go the extra mile to make sure this complex business worked out day in and day out. If you needed help, you got it. Employees filled in for one another. Sokol's challenge was to radically change NetJets without ruining the esprit de corps that defined the company. But top management liked things just the way they were. At meetings, Sokol would propose selling planes or cutting costs, and executives would push back. Before long, Sokol grew frustrated. Says Bill Olson, who was at the time running NetJet's aviation and operating division, it was no secret that David was not open to suggestions, critical debate, or constructive criticism. Once you challenged him in a meeting, he'd give you a look to kill, and you'd fall very fast out of his favor. Olson left management and went back to being a NetJets pilot. Sokol responds, "That's just not true. My management style is collaborative." Despite the blowback, Sokol pushed ahead, canceling orders for new planes, selling off old ones, and reducing debt from $1.9 billion to $1.3 billion. He also cut some $100 million in costs, enough to make operations profitable. He started with low-hanging fruit. About $30 million of cost savings came from canceling the free use of airplanes. The old regime often let a movie star, singer, or friend of the company have free rides or upgrades for promotional purposes. Says Sokol, we might have been getting only $2 or $3 million in value for $30 million in costs on such promotions. Sokol also cut out an expensive Las Vegas poker tournament that the company put on each year for its clients. Next came layoffs. Santulli had already reduced headcount by about 4%. Sokol laid off another 5% and furloughed some 500 pilots, bringing the total headcount to 6,400. He says that because NetJets was flying fewer planes, the company didn't need as many employees. Many top managers disagreed fiercely with the depth of the cuts, arguing that service would suffer. Before long, about half the senior management team had been let go. The rest were reassigned or left on their own. Sokol argues that the company was long overdue for a shakeup. One thing that can be very nice in a dysfunctional management is that it's very hard to measure people, he says. So you have managers who are patting themselves on the back, saying they're doing great, while the reality is that there's no way to measure what they're doing. One NetJets executive whose sales region was losing money still received multi-million-dollar bonuses. Having purged senior management, Sokol elevated 3 NetJets executives from the next rung down to his new team and hired 3 from the outside. Says he, NetJets was top-heavy and lacked a good organizational structure. We needed to give employees responsibilities and goals that were clear and deliverable. We needed to make clear who was doing what. Under the old regime, service and costs had been measured to some extent, but not broadly throughout the organization. Explains Bill No, a longtime employee whom Sokol elevated to president of NetJets North America. In the old regime, you got everyone in top management in a room and said, here's our goal, here's what we're doing. But did the employee on the second floor of accounts receivable know what was going on? Probably not. Sokol has trained his team to measure every single thing the company does, from on-schedule service to bill collection to the quality of catering. When we make a mistake, he says, we analyze why we made the mistake, and if there's a way to fix it, we fix it by putting a system in place that solves the problem. Recently, a NetJets customer who was landing at a small private airfield in Fort Lauderdale said he needed a rental car at Fort Lauderdale International. His mistake, but the NetJets service rep didn't pick it up. Sokol's team has since adjusted the software system, so the service rep can't make that car reservation without the computer system pointing out that the car and airport don't match. Says he, in less than 0.5% of our flights do we make a mistake in making a reservation. If it's a half of 1%, it's still too many. Sokol has also brought customer service, sales, and marketing into one group, creating cross-functional teams that are much more familiar with an owner's needs. The service people, who are often in the field meeting and greeting owners, might find out that Mr. X likes caviar and Coke Zero and add that information to a master file the company keeps on each customer. Says Adam Johnson, NetJet's Senior Vice President. Just knowing the owner, knowing anniversaries and birthdays, helps to build strong relationships. The old entrepreneurial NetJet's culture, says Sokol, focused on immediate growth rather than long-term planning. He instituted a rigorous 5- and 10-year planning process that looks at everything from future demand for new planes to jet fuel prices, inflation, and new markets like China. Says Jordan Hansel, NetJet's General Counsel, you lay out a whole series of explicit assumptions about the economy, business planning, regulations. That forces you to ask yourself, what are the important factors that make you change some decisions? It helps reduce surprises. One thing that did surprise Sokol was the venom with which some ex-NetJet's managers have been waging a war of words against him, partly on Buffett biographer Alice Schroeder's website. Jim Jacobs, the co-founder of NetJets, is one of the harshest critics. Jacobs, who left his position as vice chairman in January, argues that Sokol's cost-cutting is sacrificing service, and that owners are complaining and many are leaving. He also claims that canceling orders for new planes is a big mistake. Says he, we were protecting the franchise value and the ability of the golden goose to keep laying eggs. We didn't panic and lay off pilots who cost a fortune to bring back on. We didn't cancel new planes to let our fleet get older and thus more expensive to run. We didn't shut down our influencer network. No one at NetJets now has a clue how to run it. Criticizing the staff cuts, Jacobs points out that most of the $711 million loss in 2009 was a non-cash charge, and says the company was headed toward being about $70 million cash flow positive in 2010, even if the company didn't sell another new fractional share. The cuts, he argues, have made NetJets a tiny shadow of what it was. Ludicrous, Sokol snaps back. And all the acquisitions and business turnarounds I've done, I've never seen senior people leave a company who then go out and try to spread rumors and call customers and try to be harmful to the business. It's a horrible thing to see, because the only people they are hurting are themselves and the employees of the company. The judgment that matters here, of course, is Buffett's, and he is pleased and satisfied. Dave is now making very good money, and not from selling planes, Buffett says. It looks like NetJets will earn $200 million pre-tax this year. It's as remarkable a managerial achievement as I have ever seen. When aviation picks up, it could be a company that could earn $500 million a year. Sokol feels that his turnaround is largely done. He hopes to elevate one of the 6 in his new management team to CEO, perhaps by the end of the year. The question now is, when the phone rings again from Omaha, where will he fly off to next?
The Giving Pledge. In June 2010, almost exactly 4 years after Warren Buffett announced his huge gift to the Bill and Melinda Gates Foundation and 4 other foundations, he and the Gateses returned momentously to the philanthropic scene with their announcement of the Giving Pledge, their drive to expand the thinking of billionaires about how much of their fortunes to give away to charity. Fortune did this cover article breaking the news. Attached to it was Buffett's personal pledge, which was simultaneously posted on the Giving Pledge's brand new website. 3 months before this pledge news was announced, and even before there was certainty as to how and when it would be, Bill Gates and Warren Buffett met for lunch near the Omaha airport to discuss the venture, which at that point lacked even a name. I knew a little about their plan to meet and thought it presented a photo op apt to be important. My managing editor, Andy Serwer, agreed when I told him about the philanthropic milestone in the making. And so it was that when we published the cover story in June, we had a lead-off shot of Warren and Bill eating lunch at a Hollywood diner outside Omaha that March, with Bill on a recess from a cross-country flight and Warren having driven himself from his office in the city. As of September 2012, there were 92 signers of the Giving Pledge, not including their co-signing spouses. Considering that a much larger collection of the very rich, namely the Forbes 400, were the targets Buffett and the Gateses had in mind, there are still plenty of prospects. But Buffett, for one, believes that the crowd already signed up makes the Giving Pledge a real success. Quote, "I would have defined success as a lot less than 92, he says, and I know that we have changed the minds of some people about how much to give, in a couple of cases by a lot." Furthermore, Buffett and Gates have organized and attended dinners in India and China that have spread the idea of the Giving Pledge to lands where philanthropy usually finishes a poor second to dynastic inheritances. The India dinner, in March 2011, attracted scores of business people and government officials. So there is no telling at this point how far the Giving Pledge philosophy can be extended. C.L. The $600 Billion Challenge, July 5, 2010, by Carol Loomis. Just over a year ago, in May 2009, word leaked to the press that the two richest men in America, Bill Gates and Warren Buffett, had organized and presided over a confidential dinner meeting of billionaires in New York City. David Rockefeller was said to have been a host, Mayor Michael Bloomberg and Oprah Winfrey to have been among those attending, and philanthropy to have been the main subject. Pushed by the press to explain, Buffett and Gates declined. But that certainly didn't dim the media's interest in reaching for descriptions of the meeting. The Chronicle of Philanthropy called it unprecedented. Both ABC News and the Houston Chronicle went for clandestine. A New York Magazine parody gleefully imagined George Soros to have been starstruck in the presence of Oprah. One radio broadcaster painted a dark picture. "Ladies and gentlemen, there's mischief afoot, and it does not bode well for the rest of us." "No, no," rebutted the former CEO of the Bill and Melinda Gates Foundation. Patty Stonecipher, who had been at the meeting and had reluctantly emerged to combat the rumors. The event, she told the Seattle Times, was simply a group of friends and colleagues discussing ideas about philanthropy. And so it was. But that discussion, to be fully described for the first time in this article, has the potential to dramatically change the philanthropic behavior of Americans, inducing them to step up the amounts they give. With that dinner meeting, Gates and Buffett started what can be called the biggest fundraising drive in history. They'd welcome donors of any kind, but their direct target is billionaires, whom the two men wish to see greatly raise the amounts they give to charities, of any and all kinds. That wish was not mathematically framed at the time of the New York meeting. But as two other U.S. dinners were held, though not leaked, Buffett and Gates and his wife Melinda set the goal. They are driving to get the super rich, starting with the Forbes list of the 400 wealthiest Americans, to pledge, literally pledge, at least 50% of their net worth to charity during their lifetimes or at death. Without a doubt, that plan could create a colossal jump in the dollars going to philanthropy, though of what size is a puzzle we'll get to. To begin with, A word about this article you are reading. It is the first public disclosure of what Buffett and Melinda and Bill Gates are trying to do. Over the past couple of months, Fortune has interviewed the three principals as the project has unfolded, as well as a group of billionaires who have signed up to add their names to the Gates-Buffett campaign. In a sense, this article is also an echo of two other Fortune stories, both featuring Buffett on the cover. The first, published in 1986, was, "Should you leave it all to the children?" To that query, Buffett emphatically said no. The second article, which appeared in 2006, disclosed Buffett's intention to gradually give away his Berkshire Hathaway fortune to 5 foundations, chief among them the world's largest, the Bill and Melinda Gates Foundation. For Buffett's thinking on the disposition of his wealth, see his pledge that follows this article. Since then, in 4 years of contributions, Buffett has given the foundation $6.4 billion, not counting the 2010 gift to be made this summer. The foundation, in turn, has in that same period combined Buffett's money and its immense gifts from the Gateses to raise its level of giving to about $3 billion a year, much of it for world health. One small example, the Medicines for Malaria venture, heavily funded by the Gates Foundation, has worked with pharmaceutical company Novartis to develop good-tasting malaria pills and distribute them to millions of children, the principal victims of the disease, in 24 countries. Another fact about the 2006 Buffett article is that it was written by yours truly, Carol Loomis, a senior editor-at-large of Fortune. Besides that, I am a longtime friend of Buffett's and editor of his annual letter to Berkshire's shareholders. Through him, my husband John Loomis and I have also come to know Melinda and Bill Gates socially. The Loomis team has even occasionally played bridge against Warren and Bill. All that said, the question of what philanthropy might gain from the Gates-Buffett drive rests, at its outset, on a mystery: what the wealthiest Americans are giving now. Most of them aren't telling, and outsiders can't pierce the veil. For that matter, the Forbes 400 list, while a valiant try, is a best guess estimate both as to the cast of characters and as to their net worth. Buffett says he knows of 2 Berkshire shareholders who should be on the list but have been missed. As Bill Gates sums it up, the list is imprecise. Those qualifiers noted, the magazine stated the 2000 net worth of the Forbes 400 to be around $1.2 trillion. So if those 400 were to give 50% of that net worth away during their lifetimes or at death, that would be $600 billion. You can think of that colossal amount as what the Buffett and Gates team is stalking, at a minimum. Leaving aside the Forbes 400 and looking simply at Internal Revenue Service data for both annual giving and estate taxes, we can piece together a picture of how far the very rich might be from a figure like that $600 billion. Start with an admirable fact about Americans as a whole. The U.S. outdoes all other countries in philanthropic generosity, annually giving in the neighborhood of $300 billion. Some of that gets reported as charitable deductions on the tax filings made by individuals. But taxpayers at low income levels don't tend to itemize, taking the standard deduction instead. At higher income levels, charitable gift data begin to mean something. To take one example for 2007, the latest data available. The 18,394 individual taxpayers having adjusted gross income of $10 million or more reported charitable gifts equal to about $32.8 billion, or 5.84% of their $562 billion in income. And billionaires? Here, the best picture, though it's flawed, emerges from statistics that the IRS has for almost 2 decades been releasing on each year's 400 largest individual taxpayers, a changing universe, obviously. The decision of the government to track this particular number of citizens may or may not have been spurred by the annual publication of the Forbes list. In any case, the two 400 batches, though surely overlapping, cannot be identical. For one reason, because the IRS data deal with income, not net worth. The IRS facts for 2007 show that the 400 biggest taxpayers had a total adjusted income of $138 billion, and just over $11 billion was taken as a charitable deduction, a proportion of about 8%. The amount deducted, we need quickly to add, must be adjusted upward because it would have been limited for certain gifts. Among them very large ones, such as Buffett's $1.8 billion donation that year to the Gates Foundation. Even so, it is hard to imagine the $11 billion rising, by any means, to more than $15 billion. If we accept $15 billion as a reasonable estimate, that would mean that the 400 biggest taxpayers gave 11% of their income to charity, just a bit more than tithing. Is it possible that annual giving misses the bigger picture? One could imagine that the very rich build their net worth during their lifetimes and then put large charitable bequests into their wills. Estate tax data, unfortunately, make hash of that scenario, as 2008 statistics show. The number of taxpayers making estate tax filings that year was 38,000. And these filers had gross estates totaling $229 billion. 4/5 of those taxpayers made no charitable bequests at death. The 7,214 who did make bequests gave $28 billion. And that's only 12% of the $229 billion gross estate value posted by the entire 38,000. All told, the data suggest that there is a huge gap between what the very rich are giving now and what the Gateses and Buffett would like to suggest is appropriate, that 50% or better of net worth. The question is how many people of wealth will buy their argument. The seminal event in this campaign was that billionaires' gathering in May 2009, the First Supper, if you will. The Gateses credit Buffett with the basic idea that a small group of dedicated philanthropists be somehow assembled to discuss strategies for spreading the gospel to others. The Gateses proceeded to arrange the event. Bill Gates says with a grin, "If you had to depend on Warren to organize this dinner, it might never have happened." In his office, meanwhile, Buffett scrawled out a name for a new file: Great Givers. The first item filed was a copy of a March 4th letter that Buffett and Gates sent to the patriarch of philanthropy, David Rockefeller, to ask that he host the meeting. Rockefeller, now 95, told Fortune that the request was a surprise, but a pleasure. As a site for the event, he picked the elegant and very private President's House at Rockefeller University in New York City, whose board he has been on for 70 years. He also tapped his son David Jr., 68, to go with him to the meeting. The event was scheduled for 3 p.m. on Tuesday, May 5th, a day urgently desired by Bill Gates, who wanted to fit the meeting into a short U.S. break he'd be taking from a 3-month European stay with his family. Because Melinda elected to remain in Europe with their 3 children, she did not attend the first dinner, but lined herself up for any that followed. The Gateses have considered this campaign to be a personal matter for them, not in any way a project of the Gates Foundation. Melinda also insisted from the start that both husbands and wives be invited to the dinners, sure that both would be important to any discussion. Her reasoning, quote, "Even if he's the one that made the money, she's going to be a real gatekeeper." and she's got to go along with any philanthropic plan because it affects her and it affects their kids. The letter of invitation, dated March 24th, went to more people than could come. But the hosts and guests who arrived on May 5th certainly had enough economic tickets to be there. A combined net worth of maybe $130 billion, and a serious history of having depleted that amount by giving money to charity. Leaving aside the semi-observers, Patty Stonecipher and David Rockefeller, Jr., there were 14 people present, starting with the senior Rockefeller, Buffett, and Gates. The local guests included Mayor Bloomberg, 3 Wall Streeters, Pete Peterson, Julian Robertson, and George Soros, and Charles Chuck Feeney, who made his money as a major owner of duty-free shoppers and has so far given away $5 billion through his foundations, called Atlantic Philanthropies. When Feeney was dropped from the Forbes 400 in 1997, the magazine explained his departure in words not often hauled out for use, quote, gave bulk of holdings to charity. The out-of-towners included Oprah, Ted Turner, and 2 California couples, Los Angeles philanthropists Eli and Edith Broad, and Silicon Valley's John and Taisha Morgridge, whose fortune came from Cisco Systems. Both the Broads and the Morgridges had equivocated over whether to accept the invitation, regarding the trip as an inconvenience. But there were the signatures at the bottom of the letter, from left to right: Rockefeller, Gates, Buffett. Impressive, Eli Broad thought. So on the appointed day, the Broads found themselves seated with everyone else around a big conference table, wondering what came next. They mainly got that message from Buffett, whose quick sense of humor left him playing, says David Rockefeller, Jr., quote, the enlivener role. He remembers Buffett as keeping the event from being too somber and too self-congratulatory. Buffett set the ball rolling by talking about philanthropy, describing the meeting as exploratory, and then asking each person, going around the table, to describe his or her philosophy of giving and how it had evolved. The result was 12 stories, each taking around 15 minutes, for a total of nearly 3 hours. But most participants whom Fortune had talked to found the stories riveting, even when they were familiar. David Rockefeller Sr. described learning philanthropy at the knees of his father and grandfather. Ted Turner repeated the oft-told tale of how he had made a spur-of-the-moment decision to give $1 billion to the United Nations. Some people talked about the emotional difficulty of making the leap from small giving to large. Others worried that their robust philanthropy might alienate their children. Later, recalling the meeting, Buffett laughed that it had made him feel like a psychiatrist. The charitable causes discussed in those stories covered the spectrum: education, again and again, culture, hospitals and health, the environment, public policy, the poor generally. Bill Gates, who found the whole event amazing, regarded the range of causes as admirable. Quote, the diversity of American giving, he says, is part of its beauty. At the dinner that followed, the conversation turned specifically to how giving by the rich could be increased. The ideas advanced included national recognition of great philanthropists, presidential medals, for example, or a film, or a philanthropy guidebook, or a conference of the rich. There was no talk of a pledge. Of the dinner, the junior Rockefeller says, the most important thing my dad and I came away with was that increasing giving would take work by many in that room, delicate and probably prolonged one-on-one work. The dinner, of course, had its unexpected coda: the leak. The leaker, with little doubt, was Chuck Feeney, and the leakee was his longtime friend Niall O'Dowd, the New York publisher behind the grandly unknown IrishCentral.com. Fortune did not succeed in reaching Feeney. Of our account, O'Dowd said, "I can't confirm that." On May 18, 2 weeks after the meeting, irishcentral.com posted an article of 14 short paragraphs, headlined, "Secret Meeting of World's Richest People Held in New York." With that, the fame of the website spiked, as the rest of the press picked up the news and ran with it. The Irish Central article exhibited some confusion about which Rockefeller starred at the dinner, or was even there, but otherwise provided the names of all the participants, with the notable exception of Feeney, who apparently didn't realize he looked more conspicuous to the others by being left out. Feeney, however, appears to have been quoted anonymously in the piece, once as an attendee who thought Gates the most impressive speaker of the day, Turner the most outspoken, surprise, and Buffett the most insistent on his agenda for change. In a second instance, Feeney was a good bet to have been the odd participant who extolled his fellow guests. They were all there, the great and the good. The main effect of the leak was to place a cone of silence, that's a description from the Gates camp, over everything that transpired in the giving campaign over the next year. But there was certainly action, including a few small dinners abroad. Bill and Melinda Gates hosted a dinner in London, and Bill held a few others in India and China. Raising the philanthropic bar in foreign countries is a special challenge. Dynastic wealth is widely taken for granted. Tax laws do not commonly allow deductions for gifts to charity. A paucity of institutions and organizations ready for gifts makes knowing whom to give to just not that obvious. Nonetheless, were the Gateses and Buffett to succeed in their campaign in the U.S., they would probably take it overseas. But as last summer and fall progressed, Buffett and the Gateses did not even have a plan for how the campaign was to be structured. In this vacuum, the idea of a pledge took hold and gained strength. It helped that more dinners were to be held. At them, says Melinda, the three principals would float the pledge idea to see if it would fly. There then occurred the second and third U.S. dinners, most of whose guests have not been publicly outed because of the cone of silence. Secrecy, a Gates spokesman says, is partly about two moguls who have been exposed to the philanthropic sales pitch, but would be embarrassed to have been identified in case they chose not to step up to the challenge. In any event, the names of some of the participants are known. The noted philanthropists at the second dinner held at the New York Public Library in November last year included New York investment banker Kenneth Langone and his wife Elaine, and H.F. Jerry Lenfest and his wife Marguerite from Philadelphia. Lenfest got rich when he sold his Pennsylvania cable television company to Comcast in 2000, netting $1.2 billion for himself and his family. He promptly vowed that he would give most of it to charity in his lifetime. Now 80, he has so far meted out $800 million, a good part of it to schools he attended, Columbia Law School, Washington and Lee, Mercersburg Academy. Lenfest's favorite moment at the November dinner was Buffett's declaration that Marguerite Lenfest had put forward the best idea of the evening when she said that the rich should sit down, decide how much money they and their progeny need, and figure out what to do with the rest of it. Says Lenfest, the value of Buffett and Gates is that they're going to make people sit down and think these things through. The third supper, held in December in Menlo Park, California at the Rosewood Sand Hill Hotel, is known as the Bay Area Dinner but drew from all over the state, including its entertainment precincts. In attendance were some veteran philanthropists, including venture capitalist John Doerr of Kleiner Perkins and his wife Anne, and the Mortgages, who had selected the meeting site. This dinner was somewhat different from the other two, says Melinda Gates, because a few people there were relatively new to huge wealth and were still forming their opinions about giving. Talk went on for hours, so long that the beef being prepared for dinner became somewhat overcooked. This is reported to have dismayed Rosewood's management, which may have noticed that the crowd in the dogwood room was worth having back. The dinner also brought out some of the fears that people have about philanthropy. What does going public with big gifts do to the peace in your life? Won't pleas from charities be unending? How do you deal with giving internationally, which too often seems like throwing money down a hole? These are valid concerns, say the Gateses, the kind raised by people who want to feel as smart about giving as they were about making their money. But the questions didn't stop the two from plugging the satisfactions of philanthropy. At those dinners, says Bill, no one ever said to me, "We gave more than we should have." Nor did the idea of a pledge get shot down at those dinners. It, quote, floated nicely, in other words. So as 2010 arrived, a pledge became the strategy. The idea of aiming for a 50% slice of net worth was pragmatically pulled from the sky, being less than the principals would have liked to ask for, but perhaps as much, at least initially, as they can get. The pledges, meanwhile, were never envisioned as legal contracts, but rather moral obligations to be both memorialized in writing and taken very seriously. They are, in fact, to be posted on a new website, givingpledge.org, whose construction Melinda Gates oversaw. The 99% pledge that Buffett is making is likely to be the #1 document on the website, if he is not beaten out by his Seattle friends. Enthusiastic about leading the search for great givers, the Gateses and Buffett nonetheless have wanted a phalanx of strong supporters. Already committed to at least a 50% pledge are the Broads, the Doers, the Lenfests, and the Mortgages. With the online publication of this article, moreover, the three principals will send emails and make calls to other billionaires judged likely prospects. A bit later, all of the pledgers may join in sending a letter to a large number of other billionaires, asking them to join the growing crowd. In the fall, there may even be a Great Givers Conference. The definition of success in this venture may take years to figure out, but each of the principals has reflections about the matter. Buffett knows that everyone rich has thought about what to do with his or her money. Quote, they may not have reached a decision about that, but they have for sure thought about it. The pledge that we're asking them to make will put them to thinking about the whole issue again. He warns, most of all, against the rich delaying the decision of what to do with their money. Quote, if they wait until they're making a final will in their 90s, the chance of their brain power and willpower being better than they are today is nil. Bill Gates regards the 50% as a low bar, encouraging high participation. People, he thinks, may be drawn in by that proportion and then surprise themselves and find that they are giving at higher levels. Quote, this is about moving to a different realm, he thinks, and it will take time for everything to sort out. Melinda Gates separates the near term from the far. There are so many reasons that rich people don't give, she says. They don't want to plan for their death. They worry that they'll need to hire someone to help with the work. They just don't want to take the time to think about it all. So the initial goal of the pledge campaign, she thinks, must be simply to cut through that and get them moving in the direction of giving. And eventually, quote, 3 to 5 years down the road, we need to have a significant number of billionaires signed up. That would be success. Society cannot help but be a beneficiary here, by virtue of at least some dollars and perhaps many. Nor will it be just the very rich who will perhaps bend their minds to what a pledge of this kind means. It could also be others with less to give, but suddenly more reason to think about the rightness of what they do. My Philanthropic Pledge, July 5, 2010, by Warren Buffett.
In 2006, I made a commitment to gradually give away all of my Berkshire Hathaway stock to philanthropic foundations. I couldn't be happier with that decision. Now, Bill and Melinda Gates and I are asking hundreds of rich Americans to pledge at least 50% of their wealth to charity. So I think it is fitting that I reiterate my intentions and explain the thinking that lies behind them. First, my pledge. More than 99% of my wealth will go to philanthropy during my lifetime or at death. Measured by dollars, this commitment is large. In a comparative sense, though, many individuals give more to others every day. Millions of people who regularly contribute to churches, schools, and other organizations thereby relinquish the use of funds that would otherwise benefit their own families. The dollars these people drop into a collection plate or give to United Way mean foregone movies, dinners out, or other personal pleasures. In contrast, my family and I will give up nothing we need or want by fulfilling this 99% pledge. Moreover, this pledge does not leave me contributing the most precious asset, which is time. Many people, including, I am proud to say, my 3 children, give extensively of their own time and talents to help others. Gifts of this kind often prove far more valuable than money. A struggling child, befriended and nurtured by a caring mentor, receives a gift whose value far exceeds what can be bestowed by a check. My sister Doris extends significant person-to-person help daily. I've done little of this. What I can do, however, is to take a pile of Berkshire Hathaway stock certificates, claim checks, that when converted to cash can command far-ranging resources, and commit them to benefit others who, through the luck of the draw, have received the short straws in life. To date, about 20% of my shares have been distributed, including shares given by my late wife, Susan Buffett. I will continue to annually distribute about 4% of the shares I retain. At the latest, the proceeds from all of my Berkshire shares will be expended for philanthropy purposes by 10 years after my estate is settled. Nothing will go to endowments. I want the money spent on current needs. This pledge will leave my lifestyle untouched and that of my children as well. They have already received significant sums for their personal use and will receive more in the future. They live comfortable and productive lives, and I will continue to live in a manner that gives me everything that I could possibly want in life. Some material things make my life more enjoyable. Many, however, would not. I like having an expensive private plane, but owning a half-dozen homes would be a burden. Too often, a vast collection of possessions ends up possessing its owner. The asset I most value, aside from health, is interesting, diverse, and long-standing friends. My wealth has come from a combination of living in America, some lucky genes, and compound interest. Both my children and I won what I call the ovarian lottery. For starters, the odds against my 1930 birth taking place in the U.S. were at least 30-1. My being male and white also removed huge obstacles that a majority of Americans then faced. My luck was accentuated by my living in a market system that sometimes produces distorted results, though overall, it serves our country well. I worked in an economy that rewards someone who saves the lives of others on a battlefield with a medal, rewards a great teacher with thank you notes from parents, but rewards those who can detect the mispricing of securities with sums reaching into the billions. In short, fate's distribution of long straws is wildly capricious. The reaction of my family and me to our extraordinary good fortune is not guilt, but rather gratitude. Were we to use more than 1% of my claim checks on ourselves, neither our happiness nor our well-being would be enhanced. In contrast, that remaining 99% can have a huge effect on the health and welfare of others. That reality sets an obvious course for me and my family. Keep all we can conceivably need, and distribute the rest to society for its needs. My pledge starts us down that course.
A New Buffett Takes Beijing, October 17, 2011, by Bill Powell. "The kids are all right," said a 2010 movie. The same line works for Warren Buffett's three kids, Susie, 59, Howard, 57, and Peter, 54. Graduates of Omaha's public schools and familiar from an early age with their parents' strong opinions about not giving it all to the children, they long ago grew up to be solid citizens with careers of their own. True, all three today run foundations funded with their parents' money, an occupational niche reserved for the privileged. But the three attack that work seriously, knowing the job of giving away money wisely to be extraordinarily hard. Susie's foundation has primarily supported early education in Omaha, where she lives. Howard, who works a farm outside his Decatur, Illinois home, has focused on bettering the lives of Africa's rural poor. And New Yorkers Peter and his wife Jennifer have sought to improve the lot of women around the world. Peter Buffett became the subject of the Fortune article reprinted here because of the smashing Chinese success of his 2010 book, Life is What You Make It. Translations of the book had sold 320,000 copies in China, where this article was published, and the count in mid-2012 was up to 400,000. Warren Buffett's reputation in China clearly didn't hurt. He is known there as the god of stocks, and his every move is catalogued. But something about Peter's dropping out of prestigious Stanford and going off, without loads of money, to pursue an uncertain career, well, that grabbed the minds of China's young people, many of them unable to imagine how he could possibly have taken that risk. Howard Buffett is right now writing a book, set to be published in 2013, about his tumbling into a farming career and later becoming an expert on Africa's agricultural challenges. Susie Buffett is not writing a book, not now at least. From her post in Omaha, she is the family's most effective communicator with her father about all things important, say, personal security systems. Warren has no patience for their details nor even their existence. Susie takes over, and the security job gets done. C.L.
It is, and this is putting it mildly, sometimes difficult to generalize about a nation of 1.3 billion people. But let's go out on a limb and say there aren't many who would quibble with the description of China as money-obsessed. This is a nation in which, arguably, the most important phrase ever attributed to its transformational leader, Deng Xiaoping, was to get rich is glorious. In China, they call Warren Buffett the god of stocks, and whenever he visits, the Chinese media cover his every move and utterance. There have been over 40 books about Warren Buffett translated into Chinese, which makes it very interesting that Peter Buffett, Warren's unassuming 53-year-old son, has recently become a rising star in China in his own right. It's not because everyone thinks Warren's investment acumen has been handed down via DNA. Peter Buffett is a successful musician and a composer, writing scores for television and film. The Dances with Wolves soundtrack is one of his prominent credits, and performing his new-agey music in concert. He played most recently in August at Beijing Tanglewood, a gorgeous new outdoor concert space in the shadow of the Great Wall. But Beijing isn't exactly Marin County. In today's China, New Age music will take you only so far. The reason Buffett has piqued the interest of a lot of Chinese, students and young professionals in particular, is that he has taken to dispensing life advice along with his music. And if part of his core message, in essence, that money isn't everything, seems rather counterintuitive in China these days, that's precisely the reason he has struck a chord. Warren Buffett's rock star status tells us something about what China is today. Peter's success might tell us something about where it's going. Earlier this year, a publisher in Beijing decided to capitalize on the Chinese demand for all things Buffett and translate a book Peter had written in 2010 titled Life is What You Make It. Find Your Own Path to Fulfillment. It sold modestly in the U.S. and was released in China in March, carrying the Chinese title Be Yourself. By the end of August, the book had sold 320,000 copies, a huge number even in a country of 1.3 billion. Through much of the spring and summer, says Zhang Haiyou, editor-in-chief of New World Press, Buffett's Chinese publisher, they were selling 1,000 copies a day online. We obviously had hoped for the best, but honestly, we were stunned, says Zhang. Buffett did a 4-city promotional tour this past spring in which, as he often does in the States, he paired his music with his message. Concert and Conversation, the events are called. He did 25 press interviews with the electronic and printed media, national and local, including a web chat on what, for students and young professionals, has become the most important media site of them all, Sina.com's microblog, the Chinese version of Twitter. It was only his second visit to China, and though he was aware of his father's status in the country, he hadn't quite grasped the magnitude of it. Sitting in a Beijing hotel in August, a day before his Great Wall concert, Buffett says he was taken aback by the intensity of the reception. It wasn't quite what I was expecting, he says, laughing. It was like a presidential campaign or something. There were reporters everywhere. You have to remember that while Peter Andrew Buffett may be the second son of the god of stocks and the late Susan Buffett, his mother died in 2004, he is not used to the star treatment. Far from it, in fact. He and his wife, Jennifer, have a place in New York City, but spend much of their time in quiet Ulster County, New York, 90 miles north of the city. The couple have no children. In addition to pursuing his music career, he, like his 2 older siblings, runs his own charitable foundation, which his father has funded generously with Berkshire Hathaway stock. His sister Susie still lives in Omaha and focuses on her philanthropic work. His brother Howard owns a farm in Decatur, Illinois. Above all, the key thing about Peter Buffett is that he appears to be absolutely and completely normal. It hardly seems possible, but there it is. Well-grounded, affable, nary a twitch of neuroses or insecurity about him. Oh yeah, he says, I get that all the time. You're Warren Buffett's son, and you're so normal. Audiences everywhere are inevitably curious as to how exactly that came to be. But in China, the curiosity is off the charts. One of the things Buffett likes to remind audiences of is that when he was growing up, long before Dad became America's economic oracle, advisor to presidents, and writer of op-eds reassuring a depressed nation that all was not lost, his father was a supremely successful but largely anonymous investor. He was a regular guy who was known and revered only by the kind of folks who go to sleep with a copy of Graham and Dodd under their pillow. And he's basically the same guy now. The curiosity in China is fed by the fact that when Peter's father announced he was giving away his considerable wealth to a foundation run by another supremely rich guy, Bill Gates, a lot of folks there had a single thought. Why would he do that to his kids? Mostly lost in translation was the fact that the elder Buffett was acting in accordance with his long-articulated position that he would give his kids enough money so that they would feel they could do anything, but not so much that they could do nothing. But curiosity alone wouldn't have resulted in the sale of 320,000 books. Something about Buffett's message is definitely resonating with many young Chinese, says Zhang, his editor. That message is inextricable from Peter's biography. He tells audiences that from the time he can remember, he always loved music. My mother said I sang before I spoke, he told an interviewer for CCTV last spring. His dad has been known to play a little ukulele. A good student, he got into Stanford University, but was not particularly career-focused or interested in Graham and Dodd. For the first year and a half of college, he says, I took everything that ended in 101 or ology. Then, and here is where a young Chinese audience leans in, not quite believing what they are hearing, he dropped out. He decided that he wanted to pursue a career in music. It was right in front of my nose my whole life, he says. So he took a small inheritance from my grandfather, bought an apartment in San Francisco, and tried to make a go of it. And his parents, he tells most stunned audiences, were fine with it. They were encouraging, but also made it clear that if you blow it, well, good luck, says Buffett. Within 2 years, he was confident he'd made the right choice. By then, I knew I could make a living in music. The point Buffett repeats in all his appearances in China is that by quitting Stanford and trying to make a go of it in music, he was doing the same thing his father did. My father knew early on what he loved to do, and he did it. And he's doing it to this day, he says. So I tell audiences in China that my father and I do, in fact, do the same thing for a living. We both do what we love. To American ears, this can sound trite. The cynic says, okay, come on. It's a lot easier to do whatever you want to do if Warren Buffett is your dad. But that's not how most Chinese audiences react. Most audiences in China are gobsmacked, and for reasons that are perfectly understandable. The outside world sees China as a rising economic power, a nation with seemingly irreversible economic momentum. That may be true enough, but for all its gaudy economic statistics, on the inside, the country is also an economic pressure cooker. Children with aspirations for college put in 14 to 18 hours a day studying, desperate to get accepted to a good university. If they get in, they have to pick a major early. They're on an up escalator, which, true enough, is better than not being on one, and they can't get off. If a student graduates and lands a desirable job, he or she often doesn't get paid particularly well and has to put in long hours. To top it off, many of today's younger workers are children of China's one-child policy, which means that they alone are responsible for taking care of their parents when they retire. In short, says Edward Bell, an executive at Ogilvy and Mather in Shanghai, who has studied the 20-something Chinese in depth, this is a generation that has to sprint just to stay even. I call it generation stress. It's precisely that angst that Peter Buffett taps into. That's why Tianli Feng, like a lot of Chinese young professionals, isn't particularly surprised by its success. He graduated from business school a year ago in Beijing, a finance major who now works for the Bank of Communications in China, a large state-owned bank. A big fan of Peter's father. I think I've read all the books about him, he says. He went to see Peter Buffett speak this past spring, not quite knowing what to expect. I was touched, he says, particularly when he spoke about leaving Stanford to pursue his music. Shaking his head, he adds, such a prestigious school. Buffett understands that the experiences he writes about and the impulses that drove his career are uniquely American. He is also self-effacing and secure enough to acknowledge that if his name were Smith or Jones, no one in China would be interested. But China, novice or not, when he says that It seems as if this place is moving at such light speed that a lot of young people don't get a chance to have a second thought. He's right. I don't think my parents would ever let me do what he did, says Tian, the banker. But maybe someday, he adds softly, my own child can have that choice. If so, Peter might leave as rich a legacy in China as his dad.
A Nation Grapples with Charity, October 17, 2011. A sidebar by Bill Powell.
Last year, Warren Buffett and Bill Gates visited Beijing for what they thought would be the least controversial of reasons. They had arranged to have a private dinner with a group of rich, successful Chinese businessmen and to talk with them about a subject that seemed innocuous, philanthropy. The Chinese blogosphere caught wind of the dinner and erupted in chatter. And not all of it, acknowledges Peter Buffett, was positive. That's putting it mildly. The subject of rich folks giving away their money to charity might be uncontroversial in the United States, but in China, it's not. In fact, Peter says, when he comes to China to perform and speak to groups of students and young professionals, the subject of second-generation wealth always comes up. They always want to talk about it. There are two reasons philanthropy gets people riled up in China. First, a fair number of rich folks there believe giving it away is antithetical to Chinese values, which stress family above all. It's why some Chinese were upset when they heard, mistakenly, that Buffett and Gates were coming to tell rich Chinese how to give away their wealth. Many young Chinese were stunned when Buffett said he was giving most of his wealth to the Gates Foundation. But the second reason wealthy Chinese haven't been racing to donate more of their money, particularly this year, is less obvious. Charitable foundations in China are dogged by the whiff, and sometimes more than that, of corruption. Management fees for charities in China are often up to 10% of donations collected, compared with around 3% in the West. Earlier this year, the mere photograph on the web of a young woman identified as a manager of the Red Cross in China sent the blogosphere into a frenzy. The reason? The photo showed her driving a fancy car and carrying a Hermes purse. The agency insisted that the woman in question did not, in fact, work for the Red Cross in China. She was the girlfriend of what the agency murkily called a business partner. The denials didn't matter. Donations to RCIC in the first half of 2011 plummeted and, according to some Chinese press reports, slowed considerably to the charitable sector as a whole. That pointed to the lack of trust that extends to the charitable sector in China. Several prominent Chinese businessmen and philanthropists, led by Cao Dewang, owner of one of the largest glassmaking companies in China, have now publicly insisted that the domestic charities they donate to have to become more transparent and cost-effective. This doesn't have anything to do with values, Western or Chinese, Cao has said. To increase charity now in China is a matter of trust.
Why Stocks Beat Gold and Bonds. February 27, 2012. An excerpt from Buffett's letter to shareholders in the 2011 Berkshire Hathaway Annual Report. Gold is a barren asset. Bonds are seldom rewarding to investors. Well-chosen productive assets like common stocks and land are the logical prospects to deliver superior returns. Those are the messages of the article that follows, which is an excerpt, carrying a Fortune title, from Warren Buffett's letter in Berkshire's 2011 Annual Report. Those are also the principles by which Buffett has led his investing life. So this piece seems a perfect way to close the book on our 46-year Buffett expedition, this business biography as played out in the pages of Fortune. But we need also to add up what Buffett has accomplished, both as investor and businessman, in those 46 years. In 1966, he was the proprietor of an unfamous hedge fund, Buffett Partnership Limited, and the controlling shareholder and de facto CEO of a small New England textile company, Berkshire Hathaway, with $49 million in annual revenues. By 2011, Berkshire was number 7 in the Fortune 500, with $144 billion in revenues. That leap, largely unrecognized, even Buffett was surprised to learn he had the distinction about to be noted, is extraordinary. No other man has within his lifetime taken a company from obscurity to the top 10 of the 500. Buffett would say that doesn't matter much, revenues not being that important. Market value is something he respects much more, and for 2011, Berkshire ranked 9th in the 500, with $202 billion. Soaring in front of that measurement was another company built by one man in his lifetime, the late Steve Jobs of Apple, a company whose market value was at the same point a colossal $569 billion. The two men had gotten to know each other decades ago, when both were members of the Grinnell College Board. They talked rarely after that, but Buffett just happens to remember that once, not too long ago, Jobs called to ask about ideas for dealing with Apple's excess cash, and then went away and did nothing that Buffett had suggested. That hedge fund in Buffett's life, Buffett Partnership Limited, disappeared long ago, closed at the end of 1969 because Buffett could not stomach the speculation that had entered the market. But the $100 million it then had in investments was the seed, so to speak, of $86 billion in equity investments that Berkshire had a few months ago in June. Buffett's big stakes were spread across the American economy. Berkshire then had $15.6 billion in Coca-Cola, $13.7 billion in Wells Fargo, $13 billion in IBM, and $8.8 billion in American Express. In 2012, all of Berkshire's financial feats were overshadowed by two pieces of Buffett news. First, a bit earlier in August 2011, the New York Times ran an op-ed Buffett had written under the headline, "Stop Coddling the Rich." Buffett compared the low tax rate he was paying, 17%, to the rates of the 20 other people in his office, 33% to 41%. And called for tax increases for anyone earning more than $1 million. In the election year of 2012, the Obama administration both embraced and expanded that proposition, backing a Buffett rule, immediately and hugely controversial, of course, that would impose higher taxes on everyone with taxable income above $250,000. Cracked Buffett, "I always wanted to have a tax named after me." In the second news item, Buffett announced by press release on April 17th that he had been diagnosed with stage 1 prostate cancer, a label denoting, among other specifics, a cancer that has not spread outside the prostate gland. As I write this in mid-September, Buffett has just completed 2 months of radiation at an Omaha hospital. During this treatment, he experienced the fatigue that normally accompanies it and consequently elected on some days to work from home. Buffett, now 82, has every confidence that he will survive this disease and live for many more years to come, as a high percentage of men having it do, and that it will not for more than a very brief time interfere with his tap dancing to work. C.L.
Investing is often described as the process of laying out money now in the expectation of receiving more money in the future. At Berkshire Hathaway, we take a more demanding approach, defining investing as the transfer to others of purchasing power now, with the reasoned expectations of receiving more purchasing power after taxes have been paid on nominal gains in the future. More succinctly, investing is foregoing consumption now in order to have the ability to consume more at a later date. From our definition, there flows an important corollary. The riskiness of an investment is not measured by beta, a Wall Street term encompassing volatility and often used in measuring risk, but rather by the probability, the reasoned probability, of that investment causing its owner a loss of purchasing power over his contemplated holding period. Assets can fluctuate greatly in price and not be risky as long as they are reasonably certain to deliver increased purchasing power over their holding period. And as we will see, a non-fluctuating asset can be laden with risk. Investment possibilities are both many and varied. There are 3 categories, however, and it's important to understand the characteristics of each. So, let's survey the field. Investments that are denominated in a given currency include money market funds, bonds, mortgages, bank deposits, and other investments. Most of these currency-based investments are thought of as safe. In truth, they are among the most dangerous of assets. Their beta may be 0, but their risk is huge. Over the past century, these instruments have destroyed the purchasing power of investors in many countries, even as these holders continue to receive timely payments of interest and principal. This ugly result, moreover, will forever recur. Governments determine the ultimate value of money, and systemic forces will sometimes cause them to gravitate to policies that produce inflation. From time to time, such policies spin out of control. Even in the U.S., where the wish for a stable currency is strong, the dollar has fallen a staggering 86% in value since 1965, when I took over the management of Berkshire. It takes no less than $7 today to buy what $1 did at that time. Consequently, a tax-free institution would have needed 4.3% interest annually from bond investments over that period to simply maintain its purchasing power. Its managers would have been kidding themselves if they thought of any portion of that interest as income. For tax-paying investors like you and me, the picture has been far worse. During the same 47-year period, continuous rolling of U.S. Treasury bills produced 5.7% annually. That sounds satisfactory. But if an individual investor paid personal income taxes at a rate averaging 25%, this 5.7 return would have yielded nothing in the way of real income. This investor's visible income tax would have stripped him of 1.4 points of the stated yield, and the invisible inflation tax would have devoured the remaining 4.3 points. It's noteworthy that the implicit inflation tax was more than triple the explicit income tax that our investor probably thought of as his main burden. In God we trust may be imprinted on our currency, but the hand that activates our government's printing press has been all too human. High interest rates, of course, can compensate purchasers for the inflation risk they face with currency-based investments, and indeed rates in the early 1980s did that job nicely. Current rates, however, do not come close to offsetting the purchasing power risk that investors assume. Right now, bonds should come with a warning label. Under today's conditions, therefore, I do not like currency-based investments. Even so, Berkshire holds significant amounts of them, primarily of the short-term variety. At Berkshire, the need for ample liquidity occupies center stage and will never be slighted, however inadequate rates may be. Accommodating this need, we primarily hold U.S. Treasury bills, the only investment that can be counted on for liquidity under the most chaotic of economic conditions. Our working level for liquidity is $20 billion. $10 billion is our absolute minimum. Beyond the requirements that liquidity and regulators impose on us, we will purchase currency-related securities only if they offer the possibility of unusual gain, either because a particular credit is mispriced, as can occur in periodic junk bond debacles, or because rates rise to a level that offers the possibility of realizing substantial capital gains on high-grade bonds when rates fall. Though we've exploited both opportunities in the past and may do so again, we are now 180 degrees removed from such prospects. Today, a wry comment that Wall Streeter Shelby Cullum Davis made long ago seems apt. Bonds, promoted as offering risk-free returns, are now priced to deliver return-free risk. The second major category of investments involves assets that will never produce anything, but are purchased in the buyer's hope that someone else, who also knows that the assets will be forever unproductive, will pay more for them in the future. Tulips, of all things, briefly became a favorite of such buyers in the 17th century. This type of investment requires an expanding pool of buyers who, in turn, are enticed because they believe the buying pool will expand still further. Owners are not inspired by what the asset itself can produce, it will remain lifeless forever, but rather by the belief that others will desire it even more avidly in the future. The major asset in this category is gold, currently a huge favorite of investors who fear almost all other assets, especially paper money, of whose value, as noted, they are right to be fearful. Gold, however, has two significant shortcomings, being neither of much use nor procreative. True, gold has some industrial and decorative utility, but the demand for these purposes is both limited and incapable of soaking up new production. Meanwhile, if you own 1 ounce of gold for an eternity, you will still own 1 ounce at its end. What motivates most gold purchasers is their belief that the ranks of the fearful will grow. During the past decade, that belief has proved correct. Beyond that, the rising price has, on its own, generated additional buying enthusiasm, attracting purchasers who see the rise as validating an investment thesis. As bandwagon investors join any party, they create their own truth, for a while. Over the past 15 years, both internet stocks and houses have demonstrated the extraordinary excesses that can be created by combining an initially sensible thesis with well-publicized rising prices. In these bubbles, the army of originally skeptical investors succumbed to the proof delivered by the market, and the pool of buyers, for a time, expanded sufficiently to keep the bandwagon rolling. But bubbles blown large enough inevitably pop. And then the old proverb is confirmed once again: what the wise man does in the beginning, the fool does in the end. Today, the world's gold stock is up about 170,000 metric tons. If all this gold were melded together, it would form a cube of about 68 feet per side. Picture it fitting comfortably within a baseball infield. At $1,750 per ounce, gold's price, as I write this, its value would be about $9.6 trillion. Call this cube Pile A. Let's now create a Pile B, costing an equal amount. For that, we could buy all U.S. cropland, 400 million acres with output of about $200 billion annually, plus 16 ExxonMobils, the world's most profitable company, one earning more than $40 billion annually. After these purchases, we would have about $1 trillion left over for walking around money. No sense feeling strapped after this buying binge. Can you imagine an investor with $9.6 trillion selecting Pile A over Pile B? Beyond the staggering valuation given the existing stock of gold, current prices make today's annual production of gold command about $160 billion. Buyers, whether jewelry and industrial users, frightened individuals, or speculators, must continually absorb this additional supply to merely maintain an equilibrium at present prices. A century from now, The 400 million acres of farmland will have produced staggering amounts of corn, wheat, cotton, and other crops, and will continue to produce that valuable bounty, whatever the currency may be. ExxonMobil will probably have delivered trillions of dollars in dividends to its owners and will also hold assets worth many more trillions. And remember, you get 16 Exxons. The 170,000 tons of gold will be unchanged in size and still incapable of producing anything. You can fondle the cube, but it will not respond. Admittedly, when people a century from now are fearful, it's likely many will still rush to gold. I'm confident, however, that the $9.6 trillion current valuation of Pile A will compound over the century at a rate far inferior to that achieved by Pile B. Our first two categories enjoy maximum popularity at peaks of fear. Terror over economic collapse drives individuals to currency-based assets, most particularly U.S. obligations, and fear of currency collapse fosters movement to sterile assets such as gold. We heard cash is king in late 2008, just when cash should have been deployed rather than held. Similarly, we heard cash is trash in the early 1980s, just when fixed dollar investments were at their most attractive level in memory. On those occasions, investors who required a supportive crowd paid dearly for that comfort. My own preference, and you knew this was coming, is our third category: investment in productive assets, whether businesses, farms, or real estate. Ideally, these assets should have the ability in inflationary times to deliver output that will retain its purchasing power value while requiring a minimum of new capital investment. Farms, real estate, and many businesses such as Coca-Cola, IBM, and our own See's Candy meet that double-barreled test. Certain other companies, think of our regulated utilities for example, fail it because inflation places heavy capital requirements on them. To earn more, their owners must invest more. Even so, these investments will remain superior to non-productive or currency-based assets. Whether the currency a century from now is based on gold, seashells, shark teeth, or a piece of paper, as today, people will be willing to exchange a couple of minutes of their daily labor for a Coca-Cola or some See's peanut brittle. In the future, the U.S. population will move more goods, consume more food, and require more living space than it does now. People will forever exchange what they produce for what others produce. Our country's businesses will continue to efficiently deliver goods and services wanted by our citizens. Metaphorically, these commercial cows will live for centuries and give ever greater quantities of milk to boot. Their value will be determined not by the medium of exchange, but rather by their capacity to deliver milk. Proceeds from the sale of milk will compound for the owners of the cows just as they did during the 20th century when the Dow increased from 66 to 11,497 and paid loads of dividends as well. Berkshire's goal will be to increase its ownership of first-rate businesses. Our first choice will be to own them in their entirety, but we will also be owners by way of holding sizable amounts of marketable stocks. I believe that over any extended period of time, this category of investing will prove to be the runaway winner among the three we've examined. More important, it will be by far the safest.
Final note from the editor. When Fortune first mentioned Warren Buffett in 1966, Berkshire's stock, today's Class A, was about $22. In mid-September 2012, it was $133,000. CL.